minha frente que eu quero passar, pois o samba está animado, o que eu quero é samba. Este samba que é misto de maracatu, é samba de preto veio, samba de preto tudo. Mas que nada, um samba como este tão legal, você não vai querer que eu chegue no final. Sai da minha frente que eu quero passar, pois o samba está animado, o que eu quero.
All right. Hey, John. How are we doing? Okay, everybody. Good to see everybody's hanging out, getting to know one another, and that is the name of the game. Having been at a few events around the world and around my life during my life here, I've come up with this thing, I call it a cheat code for kind of getting the most out of an event. All right? So here's our cheat code number one. I'm going to share it with you with one of my classic vintage photos right there from the ladies, of course, getting a little bit of sailing on. The first cheat code of the day is you do not always have to have an opinion about everything. Uh-huh. Now, how novel does that sound? Does it? Who recognizes what I'm speaking of here? Yeah? Oh, of course Alex does, right there. That's right. Now, what am I referring to? I'm talking about getting the most out of our experience here and together as a community, but also being open and learning from one another. And, of course, I'm all about it, too. Most of my life, I came up as an engineer and whatnot, and I thought I was right about pretty much darn everything until I kind of woke up a little bit, or I've gotten better and better, thanks to for people like that and all of you in the room, about recognizing that it's wasting my energy, it's consuming bandwidth, and you know what? It's downright getting right in the way of doing, being present and being open to what it is that I'm learning. Okay? And sometimes it'd be maybe wiser to just simply say, isn't that interesting? You know? And to be able to just absorb the information. And then, you know, you can make your determinations later like we all do, of course. So here, I would like you all to practice it with me right now and say, isn't that interesting? See, it's kind of good. You don't have to really make a big judgment about it. You don't have to be right about how wrong they are or whatever, or dominate the information. You can just take it on. Now this time let's do it a little bit more assertive, like, isn't that interesting? Exactly. All right. Now we got that cheat code out of the way to help you maximize your experience here today. We're going to move into our first big panel of the day. What's it about? Well, taxes, trust practices, the new era. That's what we're all about. And of course, I can't think of anybody better, of course, to help us tackle this problem than a very unique person, of course, that's been part of our community for a few years now. And of course, she over from Miami. She runs a high-end Miami-based CPA firm known for cryptocurrency, international business, technology startups, and an incredible list of things. And her and the panel today are going to tackle this situation, tax strategies, of course. And, of course, you're all going to say it with me. Isn't this about to be interesting? It is. All right, everybody, welcome Bette Hochberger and the rest of our panel. And I said it that way because we're going to allow them to introduce. Is that okay? Yeah. That's right. All right.
Is the mic working? Boop. Can you hear me? Yeah?
Check.
Okay, so I will tell you guys that even though we're talking about taxes, John did ask me, please make it exciting. So we definitely have an exciting panel for you. You guys want to all take a minute or so and introduce yourselves?
Hi there. My name is Sam Saman. I'm the managing director of the Strategic Wealth Group. We're a 10-person private wealth management team, multifamily office team, really 3 minutes away in Mercado. So join me for coffee afterwards and maybe some drinks. I think that's me. I think that's somebody else. Started my career in a single-family office after a liquidity event, then went on to a couple of years investment banking, mergers and acquisitions. Actually, Joe is from my old firm, PCE Investment Bankers in Winter Park, and then started this wealth management practice in my 20s. I'm now in my 40s, so we deal with multifamily office type work, investment management, trust and estate planning, and I'm sure we'll get into a little more of that shortly.
My name is Matt McClintock, and I got to tell you, if you don't think that trusts and taxes are interesting, you are doing it wrong and you're paying too much in tax. I am Matt McClintock, founder and chief executive officer of a wealth management group called Bespoke Group. I'm a recovering estate planning attorney with about 25 years under my belt, and started building family offices around a handful of ultra-high net worth clients who just happened to have bought a whole lot of Bitcoin back in 2010, 2011, and 2012, and so that's the company that I now run.
Hi, my name is Eric Collins. I'm an attorney. I'm the managing partner of Ice Miller's office here in Naples, which is right across the street in the PNC Bank building. Very happy to be here. Spoke last year with Matt and Sam as well. And kind of work I do business structuring, tax, estate planning, but our niche is the family office market, setting up structures, management companies, holding companies, dealing with the IRS, dealing with unique assets that our ultra high net worth individuals have, both domestically and offshore. And when I'm not busy, I'm also an adjunct professor at our local law school, Ave Maria Law School, teaching a trust and estates course.
Hey, good morning. My name is Jordan Guess. I'm a partner at Trusted Advisor CPA firm out of Louisville, Kentucky, and also co-founder of a Bitcoin accounting and tax software called Bitmint. And happy to be here and happy to discuss some of the topics today.
All right, thank you, everybody. Is this one working? Yeah. Off and then on. How about now? Oh, okay. Now it's working. Okay, well, so thank you, everybody, on our fantastic panel here. So the first thing we're going to talk about is probably, for us, the most exciting thing, or one of the most exciting things that happened this year, the One Big Beautiful Bill. So I will tell you, in my practice, we work a lot in real estate. So we were very excited about 100% bonus depreciation. So, gentlemen, if each of you could talk a little bit about what excites you about the One Big Beautiful Bill and your practices and how it's affecting the planning that you're doing.
Sure. Turn it off and then on. The tech solution to 90% of tech problems. The big thing for us is, so basically what happened with the One Big Beautiful Bill is it made permanent the 2017 tax cuts. So a lot of these things were already in place. The one thing that we focused on is the exemption raised to $15 million per person, and that's now going to be benchmarked to inflation. That made that permanent. A lot of our clients in the previous regime were scrambling to get assets inside of trusts and setting up dynasty trusts around the previous exemption. And you may recall, for those of you that don't follow this very closely, it used to be 5 million indexed to inflation, and at one point it was under 1 million. And so just to level set, what does that mean? For a lot of our clients, anything they leave inside of their estate gets taxed at a 40% tax above that exemption amount. And so when I was actually at our old investment bank many years ago, one of the things our valuation firm did was set up these family limited partnerships where we could discount assets into these entities to be able to get as much out of our clients' estates as possible at a discount. And so that's something that we've always kept an eye on. And there's other little provisions around charitable contributions, looking at 529s, the salt cap was raised, but there's a phase out. But really the big thing for us was the estate tax.
Yeah, I think the estate tax is probably going to steal most of the headline on this because, as Sam mentioned, under the prior tax act, the baseline exemption was $5 million per taxpayer. That would have sunset at the end of this year, so we would have gone back from a 13.99 million exemption all the way back to 5 million plus some indexing for inflation. The new floor under this One Big Beautiful Bill, the new floor is $15 million. So that's the permanent baseline now. So it will continue to index upwards for inflation. But there is no sunset on the new $15 million estate tax exemption. Sam mentioned something else, though, that I want to really zero in on, and that is this the charitable contribution limitation that starts to take effect in January. Charitable contributions will not be deductible below a 0.5% AGI floor. So you're not going to get as much juice out of your charitable gifts in 2026 and forward than you will get under this presently expiring law. So those of you who are looking for charitable deductions, this is the time to plan. You've got about 6 weeks to really nail some effective charitable contributions, subject to a 5-year carry forward on your deductions. So this is a great time to maximize your philanthropy planning. One thing else I want to mention before I steal all the thunder to Eric and Jordan, I got nothing left, man, sorry. One of the things that is interesting now is, $30 million for a married couple sounds like a lot of money, and it is a lot of money. For the ultra-affluent clients, discounting regimes are relevant, like Sam is talking about, whether you're using limited liability companies or limited partnerships. Fun fact, you can do the same type of planning with Bitcoin and other digital assets that you can do with everything else. We've been doing it for years. And income tax planning is now a big part of the game using non-grantor trusts, which you might want to lean in on, Eric. The ability to create multiple income tax payers, even in a zero income tax state like Florida, so you can take advantage of federal exemptions and federal deductions using non-grantor trusts.
Yeah, I kind of overemphasize too. I mean, they both mentioned the federal estate tax exemption being made permanent, 13.996 this year, 15 million next year, and how important that was. When I first started practicing in Chicago in '99, before I moved here 5 years ago, the exemption amount was $680,000. That was a home back then. That was a nice home back in 1999, actually. Plus, Illinois had its own estate tax. So clients have to be aware of this gift, this opportunity to do it and put it into dynasty trust, generation to generation. In Florida, it's 1,000 years a trust can exist. I've never seen I'll never see that, obviously, but it's nice that they're trying to make these dynasty trusts actually work for potential generations to come. With regards to what Matt was talking about on the SLAT side and what I call a slant, which is spousal access non-grantor trust, if you want to put certain stock in there with regards to 1202 stock especially, is key component. That's a gift. And a few years ago, that was $10 million of capital gains amount that could just be forgiven. It wasn't taxable to you. So what we do, under the right circumstances, I had a client who did a media company. He wanted to keep 1/3 to his kids, 1/3 to a third party. He has 5 kids. We created 3 slant trusts, non-grantor trusts, filled them up with 1/3 of the interest of the corporation so that each one of those trusts has the potential to have the benefit of $10 million of capital gains exclusion. It's an asset protection play as well. It gets it to the next generation. And right now, that's been increased to $15 million. So the opportunities right now with regards to 1202 stock are big. You have to be the right type of business. There are a lot of requirements and everything, but well worth looking into. We also have opportunity zones, which a number of my clients deemed got a lot of benefit from over the past few years. They are going to permanently make those into 10-year tranches, which I think they start in 2026, 2027. But the basis increase on most of those will be an increase of basis of 10%, unless you're in a rural area. Then you can increase your basis up to 30%. What's going to happen in the rural areas? What's happening now? Power generation, things of that nature. Good opportunity on the opportunity zone side. I don't want to take all the time up here, but bonus depreciation is key, charitable planning. I'm telling my clients, if you don't you have to make some sort of plan this year. Otherwise, you're losing on 0.5% of your potential amount. And so put it in a DAF, donor advised fund, get it out of your estate, give it to the people later, but I don't want to take up all the time here, so let's hear something from Jordan.
No, that sounds good. I think what I would jump into, all of those are amazing points. Something we're seeing in our firm a lot is specifically on the bonus depreciation side. And in our firm, we're partnered up with several hosted Bitcoin mining companies that are sending us referrals of high-income earners that are looking to get exposure to Bitcoin mining and the depreciation that comes along with that. And if it's structured correctly and we can make a strong case that it's active losses, then we can take that against active income. And so that's something that I am seeing come across my desk a lot these days. And then one last thing to mention is that we have seen some interest on some joint ventures between high-income people who are getting together and doing these joint ventures with oil and gas, where the investor side of the deal will put up the money to buy Bitcoin miners, and the oil and gas will put up money for the generators. And then they are essentially using those tax benefits to justify taking flare gas that used to just be wasted energy, and now they are monetizing that through Bitcoin mining. So those are a few of the things that are coming through our office. That's mainly on the Bitcoin side, but the bonus depreciation specifically has really increased the call volume for all that kind of stuff. So,
yeah, that 15 million is going to be huge, and like I said, bonus depreciation that comes from the CPAs. So, whenever Congress makes changes, there's an intention, but there's also unintended consequences. Do any of you see any or foresee any unintended consequences that are going to result from the One Big Beautiful Bill?
Well, it leads to a broader question about deficit spending and debt and all the things that everybody wants to talk about. But I don't see anything significant that's going to change the way that we're approaching investments. I think the big thing for us, like I said, is utilizing the exemption. And then the other thing on the exemption, a lot of clients say, well, I'm not really that worried about it, or I'm right there on the cusp, or I'm not even at that level. The one big benefit of irrevocable trust planning is the asset protection component that often gets overlooked. There was a story here in Naples. A guy was leaving Mercado, where our office is, and it's actually his wife was leaving Mercado, and she had a couple of drinks. This was a few years ago, and unfortunately hit somebody and killed them, and it was horrific. But they got wiped out in that scenario. There was another scenario in Mediterra where a guy was driving his car under the speed limit, hit a biker who had veered into his lane, didn't even really hurt him that much, but it was a multi-million-dollar lawsuit. And so the idea is we live in a very litigious society, so if you can put asset protection around the assets that you've worked so hard for through the use of irrevocable trust planning, and have some backdoor access to these trusts to where you're not just giving them completely away with good planning attorneys like Eric and others who can do this type of planning, I think it makes a lot of sense beyond just the minimizing the estate taxes.
Yeah, I think those are all good points. I want to get back to Beth's question specifically around second order effects of the One Big Beautiful Bill, and tax exemptions unlike anything we've ever seen before. I do not recall seeing a commensurate cut in spending to go along with a cut in revenue. United States debt is at all-time highs. We are printing more money than we've ever seen. The U.S. dollar has lost 15% of its purchasing power year to date against much more stable currencies like the Swiss franc. I think part of why we see Bitcoin rise in value is because we see the dollar buying less as it goes along. And so we are hearing this from our clients, that they are concerned about the trajectory of the United States dollar to not hold its value. Concerns about buying up millions upon millions upon millions of Argentine pesos with U.S. dollars seems like it's pretty foolhardy from a monetary policy perspective. And so clients increasingly turn to investments that are not denominated in the United States dollar. This gets us into places like Switzerland, where they can get access to Swiss investments that are denominated in the Swiss franc and that pay dividends in the Swiss franc. Similar with Singapore, looking for havens of more sound monetary policy so that your fiat is not losing purchasing power simply by the runaway politicized taxing and spending regime. And this is not meant to be a partisan statement. I think that there's culpability to go around Washington. And so I think that some of the knock-on effect of this One Big Beautiful Bill is going to be that when the bills come due, where will the revenue come from?
Yeah, one of the unintended consequences, very indirectly related to the Big Beautiful Bill, but more directly related to the current administration, is dealing with the IRS. So I'm going to say something very controversial here. I actually think we need more IRS agents because I work in this field, and I get in the morning, dial up the number, wait for a few hours for somebody to respond. I don't bill that, I do other work, so. But realize that right now there are no IRS agents really working. There's a skeleton crew, basically.
Wait, hold on, Eric. Before the government shutdown, before Doge, how long did it take you to get through? Because it still took the same many hours, no?
Yeah.
I haven't seen a big change. I actually have a line cutter. If you want, I can share that with you. But
Sometimes I actually call it the Spanish line and get in
wait,
that
do you
way.
speak Spanish?
No, I don't. And I say, no.
No hablo.
Yeah, and you can get it a little faster if I'm desperate. Yeah, por favor. But anyway, right now I hear the problem is everybody thinks, a lot of my clients are saying, Eric, there's no IRS. We can be more aggressive. We can do these types of things. I mean, I'm thinking, what are you talking about? Do you think this is a short-term plan? Well, statute of limitations is 3 years on tax returns, right? Yeah, unless you have what's called a substantial understatement, which is only 25% understatement, which lasts 6 years statute of limitations. And if they put it under the definition of fraud or not paying your taxes, there is no statute of limitations.
And what happens if you don't fully support or fully substantiate your return?
If you don't fully substantiate your return, you lose. The burden is on the taxpayer. And the statute doesn't start. Yeah, statute doesn't start, depending on what you disclose in the first place. Exactly, good point. But with regards to what people should be doing, you have to think about what the IRS is going to look like in 4 to 8 years. Who's the administration going to be there? We have no idea. Is the IRS going to be built up more? And what's this I hear about AI? Who is AI going to help the most out of anybody here? Well, hopefully, I don't think there are any IRS agents here.
I think it's us, actually. It's
well,
gonna be.
The IRS
Because we're going to have to
agents,
call the IRS to fix what their AI wrongly
yeah.
did to our clients.
Yeah, well, the AI is going to catch all the red flags. Right now, the IRS can't possibly look at all the returns. They hope to look at a small segment of them. So AI is going to flag a lot of things. So have a great CPA, tax attorney, good structure, and watch out because their lives are going to become much easier on the IRS side.
Yeah, I think those are both really good call-outs here because, if you just take a step back and you look at where the government is and where it's going from a fiscal standpoint, and then you pull in AI, right? They are in a situation where, in all likelihood, they're going to have to raise taxes, to actually continue to keep this train running. And so if they're needing to raise taxes, get more aggressive on collections, and then they're able to utilize AI in order to fast track that, it's one of those things where you should ensure that you have everything buttoned up and working with qualified professionals on all of that. One other quick thing, it's not specifically a Big Beautiful Bill, but what we're seeing specifically on digital assets is the segregation of different wallets, and if you're going to sell any amount of your Bitcoin, that you are tying that to a cost basis of a specific unit held in that wallet. And so that's something else that we're dealing with on the firm side and on the software side, in the same way that if you had a Fidelity account and a Charles Schwab account, and you wanted to sell a stock over here, but you wanted to try to pull the more favorable cost basis from this other brokerage account, well, you can't do that, right? And so we're trying to figure out how to make sure we're staying compliant on the digital asset side to match the cost basis with the actual units of Bitcoin, UTXOs as they're called technically, to ensure that we're being compliant, because we're having those same conversations with our clients. It's like, yeah, things, in Bitcoin world, people are feeling good about the administration, but that can change at a moment's notice, and so we want to be prepared for the long term for that.
Thank you. Segueing into my my next question beautifully. So, in a world where things can change overnight, right? Policy shifts, administration shifts. How do we build flexibility into plans, especially when you're looking 4 years, 8 years out, when the rules can change out from under you overnight?
Yeah, that's a great question. And a lot of people think estate planning or tax minimization strategies, they're all created equal. And on all estate planning attorneys, all advisors, all accountants are created equal, and they all have the same skill set. And that's just not true. We see it in healthcare, right? And we see it with estate planning. So one of the benefits of where I sit, and I've been at Merrill since my 20s, and now I'm in my 40s. But one of the benefits is we basically act as a clearinghouse of some of the country's best ideas around estate planning, around tax minimization strategies. And I think having flexibility in the estate plan, whether it's through swap provisions or whether it's through, I call it a backdoor access to these plans where maybe Eric can collapse the plan, or even decanting a trust. We just had a situation earlier this year where we looked at an irrevocable trust for a potential new client, and we dug into it and said, this really doesn't make sense, but we can decant it, and here's a great estate planning attorney that can decant it for you. So having that flexibility enables you to really be creative around estate planning. And that's, so what, for example, another situation last week that we're working with, we have an irrevocable trust for a client's daughter, and that trust was set up when he had a privately held business that had substantial losses that he was able to use. So there's a multi-million-dollar tax loss carry forward there. And he has some significant appreciated stock inside of his taxable estate. So one thing I mentioned to him was, let's just swap some assets into that trust so we can get the step up and use those, so we can get the step up on your estate assets, but more importantly, use that tax loss. So it's thinking creatively around some of these structures, and really our job is to be experts on a lot of these areas for our clients and advise them on it, because they're not going to, a lot of times their accountants are going to be a little more reactive, or their attorneys drafted some trust 10 years ago and they really haven't looked at it. So our job is to really act more as a clearinghouse of these ideas and bring them to our clients.
A couple of thoughts come to mind. I mean, Sam, you've mentioned this a couple of times about irrevocable trusts, and I want to just really disabuse people of the notion that irrevocable means you can't change it. Irrevocable trusts can be changed dramatically. You can move them from one jurisdiction to the next. You can have specific powers that allow a trust protector or somebody else to modify how an irrevocable trust works. An irrevocable trust is just one type of ownership regime that allows you to get certain tax advantages, privacy advantages, asset protection advantages, wealth structuring advantages, and you have to kind of change your relationship with the property, but there's so much creativity that you can bring in trusts that are irrevocable. So absolutely irrevocable trust planning. One of the things that we want to really zero in on too, and I kind of forecasted this a second ago, is the global nature of wealth. And we have a tendency to be kind of homers when we do planning. I'm from Colorado. I have never done Colorado-based planning because Colorado law is pretty crappy, frankly. But Floridians often use Florida law. People on the East Coast often use Delaware law. People out west will use Wyoming or Nevada. You have the ability to not only use the laws of any jurisdiction within the United States, you also have the power to use the laws of any jurisdiction in the world. So families with significant amounts of wealth should not only be diversifying their ownership in various types of irrevocable trust structures, different types of limited liability companies or other ownership regimes selectively within the United States, but we should also be looking abroad, using powerful jurisdictions like the Cayman Islands or Nevis or Switzerland or Belize or the Cook Islands. These jurisdictions that can provide even higher levels of privacy, higher levels of asset protection, and easier access to global markets. So you can also diversify from the dollar into other currencies. Our perspective is if you're a person of significant wealth, then diversification not only applies to your investment regime, except you should probably buy more Bitcoin, and you should have multiple strategies in multiple jurisdictions in multiple countries.
Yeah, I mean, that's straight on a perfect asset for an asset protection trust is Bitcoin, for sure. One of the procedures we use are SLAT trusts, which are spousal access trusts. So what you do is you basically have husband and wife. Husband has the ability to take out of the trust that the wife sets up. Wife has access to the husband's trust potentially as a beneficiary, even though it's out of their estate. So we have a lot of clients put a lot of money in there for the future generations and everything. But the nice step that they can take is if at any point they feel like they gave away too much money during their lives, they can pull that money back into their estate. So that gets rid of some of the estate tax planning, but at the same time, isn't it nice to have a plan B if you think you gave away too much money or the wrong asset? Right now, we have a divorce for a family office, smaller one, a virtual family office, about $120 million, and they're going through a divorce. So you have to have provisions in there so that the one spouse can't just go in and rate it. So we have provisions in our trust that say once divorce filings are filed, that no longer works. But during the process, divvying up the assets, you may want to work around that and actually pull some assets out of those trusts, because that's a major life change is what it comes down to, is a divorce, or maybe there's a death in the family or some other economic change. Also, PPLI, private placement life insurance, you're probably hearing more and more about that, is a great way to increase asset value in a non-taxable, for income tax purposes, environment. And and offshore asset protection trust, if you want to do one of those, I suggest to all of my high net worth and ultra high net worth clients to do that now when there are no events that are potential creditor events. Because once you have a creditor event, it's called a fraudulent transfer if you want to do that. So I usually recommend Nevis, Cook Islands like Matt. You don't keep the assets there, you keep them in Singapore or Switzerland or some other environment. But it's a great way to have a backup plan in case you need that money, because with the technology that's coming out, it's going to become easier and easier to freeze assets from people. And once those assets are frozen, how do you hire an attorney to defend yourself? How do you pay for your housing expenses? How do you pay for that private jet and all those types of things? So it's important to actually do this type of planning when there's nothing wrong and nothing happening in your life.
No, those are all great points. I would honestly just come in and say that the Big Beautiful Bill really did give us stability in the planning, because I would say earlier this year, or even if you go back to about this time last year, right, we really didn't know what the tax law was going to be if you fast forwarded to right this moment. And so I think that's just been huge, at least in our office, to have the stability to know, okay, this is what the law is going to be for the next several years. We can plan around that, and then we can always make adjustments in the future. So.
Cool. So a couple of you brought up Bitcoin, right? So digital assets, alternative investments. How are these products changing how you're working with your clients and the conversations you're having with them?
So of our approximately 1.7 billion in assets that we manage as a team, we're at 0% crypto, and we're probably over allocated. I'm saying that at this conference, so I get a bunch of stares back, right?
Oh, no.
That's
careful,
the one
Sam.
controversial statement.
Now, isn't that interesting?
But we, and I do think though that alternative investments have always played an important role in client asset allocations. And if you look across the large firms, so my background was in the family office where we did a lot of private equity investments, which is the area I focused on. And when I transitioned to private wealth, like I said, in my late 20s, it was amazing how underallocated high net worth investors were to alternatives in general. And so we are much more allocated to alternative investments than our peers. So just to give you some statistics, if you look at the large firms like a Merrill Lynch or a Morgan Stanley or a UBS, they're about 3% in alternatives as a total percentage of AUM, and that includes private equity, private credit, hedge funds, managed futures, all of these various asset classes. If you look at the large endowments, the Harvards, the Yales, they're closer to 60 to 70% allocated in alternatives. That includes private real estate. And so and one of the things that I've been doing for a few years now is Merrill has me go around and speak to other advisors around the country on how to incorporate alternative investments, whether it's private equity or private credit, as a source of diversification into client portfolios. So we're much more allocated than the typical sort of investment advisor, certainly at the larger firms. But there's still a lot of room to go in terms of traditional alternatives. I got to refer to alternatives now. I used to call them AI, but I can't call it AI anymore because AI stole the original AI, the OG of AI. Yeah.
Yeah, I'm exactly on the opposite side of this with Sam, because we built our family office around people with Bitcoin, and so they were 90% allocated to Bitcoin, and for them that was just right. And I can't argue with that success of the balance sheet of the past decade. I think it's worth maybe kind of zeroing in on the definition of alternatives, because we don't identify Bitcoin as an alternative asset. We see Bitcoin as a real asset that is a store of value. It is a pristine store of value. It is perfectly liquid. You have price transparency 24 hours a day, 365 days a year. You can trade it globally. You can move it in an instant. Confirmation on chain in 10 minutes. I mean, that is not an alternative investment in our perspective. When I hear alternative investments, I often think of private investments. Somebody's got a fund, and I'm going to pay them a 2% management fee and a 20% carry for now some highly illiquid asset. That's an alternative asset in my book. And we've seen endowments like Yale have to sell billions upon billions of dollars at a fire sale because they're over allocated to these private investments that are just unraveling underneath them. We are big fans of liquidity. We don't have any funds. We don't have any alternatives that we offer to the market. We have clients who come to us with their alternative investments, their fund investments, and they want us to take a look under the hood and see what they really have bargained for in the trade. And in the Bitcoin space in particular, I think you can extrapolate this across the broader crypto space and probably across the broader technology space and other investment regimes. We believe that the best investment theses can currently be expressed in liquid public markets. We think that privates are oversold. We think that publics are underbought. Once you get outside of the Mag 7, again, zoom out, think globally, we think there are a lot more ideas that are investable where you don't have to give up your liquidity. You don't have to give up your price transparency. And so when the market moves, you can move with it.
Yeah, we have a client that's worth hundreds of millions of dollars in Bitcoin. We have some clients that allocate maybe 2 to 5%, 10% to their portfolio. Then we have clients in the middle that say, I'm not touching that stuff. It's a pyramid scheme and all this stuff that's wrong, but you can't convince them, and that's fine. It's their money. But it's an asset that we have to deal with. Matt and I were actually just up in Nashville speaking on some of these family office events with regards to Bitcoin in particular. And it's just amazing. We're at Bitcoin Park in Nashville. They also have one in Austin. And just the upper echelon of people in the Bitcoin world were there. And then there was an Imagine If event after that with regards to, we had 2 senators from Tennessee there, as well as Kathy Wood from ARK Invest just up the road in Tampa, who is a big Bitcoin proponent. And you just see where it's going. And we have to keep up with that as estate planning attorneys and family office attorneys to figure out what's the best way to hold it. With our one client that has a lot of it, he actually came from the investment world before, so he had fiat currency within his 401k. So he said, I don't want fiat currency, I want something else. So what you do is you figure out a structure. You set up a self-directed IRA that owns an LLC, appoint somebody that can be custodian of that LLC, turn it all into Bitcoin, and it's worked really well for him. And you're going to see all of these smaller organizations really popping up that are willing to custody it, that are really stepping up to do so, because a lot of the regulated larger organizations just can't do it. I think they'll get there. It's just regulatory. It's law. And with the current administration being so pro-Bitcoin, I think you're going to see a lot of changes, and in 2 years, it's just going to be a different world with regards to it.
Yeah, no, it's a very interesting world out there with Bitcoin. We're seeing it with a lot more business clients that are holding it on the balance sheet, whether they just sweep some profits into it, or a lot of clients now are getting set up where they're invoicing and providing an option to either pay in dollars or pay in Bitcoin. And so we're having to make sure on the back end from the tax firm side that we're tracking all of that. And a lot of the current software is just not equipped to track those lots. And I mean, that's the big thing is like everyone generally would just rely on Fidelity to do all the reporting for them, right? At the end of the year or in January, you get your reports. It shows your cost basis, your proceeds. If you're transacting in Bitcoin, you're having to track all of that on your own. And so there's that piece. The other piece that I did want to bring up is with the bank failures that happened in the last, I guess, 3 years now, we're seeing businesses hold Bitcoin on the balance sheet solely for an emergency where, for whatever reason, their bank is, in going through tough times and they still need to meet payroll, like was pointed out earlier. I mean, if your employees or contractors have a Bitcoin address that they can share with you, you can send them funds basically immediately, right? In 10 minutes on chain, or actually immediately if you do it over the Lightning Network. So those are a couple of things that, that we're seeing on our end, specifically with businesses holding it on the balance sheet. Yeah, we could get into the Bitcoin ETFs. I don't know if you all have any clients that are doing any kind of options trading. Like, there's this whole kind of Bitcoin yield, I guess, topic that's come about this year specifically. I don't know, are you all doing any kind of put strategies or calls, depending on if you're on the cash side or on the stock side with IBIT?
We have we have usually seen that unwind quite unfortunately for some clients. We've seen them kind of get called out and be forced sellers because the market's just moved against them in an options trade. And so we didn't bring that to clients. Clients came to us with that and said, look at this lovely mess I've made, and we watched it just kind of unwind in a really unfortunate way. But we do have a bit of a nuanced approach when it comes to Bitcoin and its role in somebody's family generational wealth. And I apply this, I mean, just at the interest of, at the expense of maybe being a little bit too transparent, I've applied this to me and my family as well. It's like, we've got Bitcoin that is Bitcoin. And that is an asset that I'm probably, if I'm being totally honest, I'm probably emotionally attached to that asset. And so that is very difficult. I know it's very difficult for me to want to actually sell that Bitcoin. But when I have loose cash available and I'm looking for something to invest in, especially for a fairly short time horizon, like call it 12 to 18 month cash needs, I'm not going to go park that in a CD someplace and get a couple of % on the dollar while the dollar's value goes through the floor. I'm going to put that in something like IBIT or some other Bitcoin ETF so I can at least get exposure to the price of Bitcoin, because I have high conviction in the long-term trajectory of Bitcoin. And so usually that works out. It doesn't always work out, but it gives me the ability to remain highly liquid to the price of Bitcoin without having to actually say, oh, I really don't want to sell this Bitcoin. So it's things like that, and strategy. I know Michael Saylor's going to be here this afternoon. Strategy has rolled out a lot of kind of stock derivative type of options that are really interesting. And so we see clients kind of experimenting with those types of things. But our clients have so much exposure to Bitcoin as a part of their underlying wealth, that just kind of becomes mad money. Let's see what happens in that space. But our clients are usually looking to allocate out of Bitcoin in ways that are tax advantaged, in ways that are aligned with their worldview, and find other investments that perform in a way that's not correlated to Bitcoin, and ideally not correlated to the devaluation risk of the dollar.
Okay, so we're talking about technology, new technologies, and Sam, you mentioned AI, so we have to go there, right? The number of clients that come to me with whatever ChatGPT told them about tax, it's through the roof. So for all of your practices, how is AI changing how you work with clients or what you're doing, for better or for worse, either direction?
Yeah, so you can't get through a day without talking about AI. And Nicholas and I, who works on my team, we were just at a conference on the East Coast, a Merrill conference. We had about 52 asset managers, including like Phil Lafont from Code2 and some other products that we're looking at. And certainly AI is going to change the way we do business. As a company, we've incorporated some AI into our daily work life. So we have Copilot now, and you can drop some trust documents in there and say compare and contrast, or you can do different things. But I'm still waiting to see massive productivity gains. We've been promised all of these massive productivity gains that are going to come as a result of AI and all these layoffs, and we'd love to be able to see significant productivity gains. Internally, we're just not quite there yet. Certainly, there's some aspects of it that help. As an organization, if you go on your Bank of America app, Erica is in there. That's all AI driven. We get daily insights into clients, things that are happening in client accounts that we need to be aware of. That's all AI driven. But in terms of these massive productivity gains, we're still sort of in wait and see mode, and I think that's the case for a lot of these big companies that are publicly traded.
I think that from an investment perspective, our general thesis is that AI is overbought. Like the big names are kind of overbought, and the easy money's been made there. So I think that from an investment perspective, I would probably say that I'm a bit short-term bearish and long-term bullish after some major shakeout and some change. We do use AI extensively, though, within my company. We've built our own large language model, LLM, that is running on a platform called Meridian that helps us ingest thousands upon thousands of different companies' financials and analyze them deeply. We look at geopolitical trends that are happening all across the world. How are these things informing? What are people talking about? Help us kind of project forward what this might mean in industries that might be emerging or industries that are overbought or underbought. And so we use it there. We don't use it in the Bitcoin or crypto space, but we're also now starting to build our own large language model around estate planning strategies, legal research, things like that, to try to take, the gray hairs of guys who graduated law school in 1999 and 2000 and start to kind of suck this into an AI brain. So now younger people inside the company can get a head start on learning some of the techniques that we've used.
I still
for so
use
long.
the books when I go to the library. I'm kidding. I'm kidding. Yeah, we also use AI much in the same way that they were speaking of earlier. I find that it's great for administrative work, maybe to get you started. But with some of the planning that we have, it's especially on the tax side, you're dealing with federal tax, you're dealing with local tax, you're dealing with state tax, you're dealing with foreign tax. Pulling all that together in an understandable way and getting to what the client needs, we're just not close to being there yet. I have a client that on the outbound transaction, U.S. citizen, that has a beautiful boutique hotel in Tuscany that's an operating company. Okay, we have to do his estate plan with regards to the U.S. side. And what does the Italian law say? They have an inheritance tax. We have an estate tax, their income tax, their capital gains rates, all of that. And then we have this thing stuck in the middle called a tax treaty that's really old, and there aren't many of them. And how does that come into play? So pulling all those things together, it's just not there yet. It's great with regards to AI, is great with regards to getting a start on something, but I'm finding so many mistakes. And there's not a week that goes by that I don't hear of an instance out in the United States where an associate or a partner files something in the court and there's a hallucination and it's referencing cases that don't exist or saying the exact opposite of the case. And they're starting to get in more and more trouble for that. It's a great place to start, but it's not a great place to end. You have to still check your sources.
Yeah, and that I think the takeaway there is that the off-the-shelf retail kind of commercial AIs they're generalists. They're not ready for prime time in highly technical, specialized industries. It takes truly tailored training. You have to build these language models with the data that you want, so the system can then start to learn off of that data. If it's just looking at the whole universe of what has appeared on Twitter, then that's going to not get you the greatest outcome.
TikTok's not the right source, or data.
I'm not going to throw shade on TikTok or X or anybody else like that, but just understand that you're dealing with a pool of generalized information. We believe that if you really want to get curated outputs, you've got to provide curated data to then train the system on.
Yeah, I can confirm Matt's TikTok account has a lot of great content on it. So I was telling me I have no idea. Yeah, someone's impersonating you with AI probably. I was just going to point out where we have a lot of conversations about AI with our clients, but the main headwinds we see with it is data privacy and data security. And so I generally don't think that we're in a place right now where it's extremely helpful, unless you are using, I've heard like Copilot, they do have a lot of great standards in place. But when you talk to a true-blooded Bitcoiner, right, they don't trust these closed systems that they can't go verify the code. And so we end up having to, in a lot of cases, make trade-offs for efficiency versus privacy. And so I'll just point out the tool that I end up using a lot and our firm uses is Maple AI. And I know the guys in Austin who are the co-founders. Turn it off, turn it on. There you go. There we go. All right. And so we're using that mainly because it's more of a privacy focus, but best case is that you're running your own LLM right this moment, just because we legit don't know what's going on in the back end with that data, how it's being sold potentially to third parties. And then if you do get into the whole legal realm, there might be a world where OpenAI is subpoenaed and forced to hand over some of those conversations that you're having. And so
They're already doing it voluntarily.
Okay.
Yeah.
Yeah. So it's one of those things where, yes, it's an incredible tool, to your point, for administrative things and to get things started. But we're trying to make sure we do it in a way that our clients feel comfortable with any kind of situations that we're describing. So
Yeah, to that point, make sure that you understand the licensing terms, what your provider is doing with that data. Another one I would throw out there is very privacy driven. It's still in the process, but Venice AI is a kind of a Bitcoin maximalist focused, privacy first, open source AI. That's actually pretty good. But if you're using ChatGPT or anything else, make sure you understand the terms and conditions and what OpenAI or other providers can do with your data, because they will exploit that.
All right, thank you guys. I think hopefully everyone got something important to take away from this panel, and we'll all be around for at least a little while if you have any questions. Thank you very much.
Back there. Thanks. That's fine. Thank you. Hey, nice work. Well done. Good to see you guys, man. Hi. Great conversation. All right. Thanks, Jordan. Yeah, nice to see you. All right. Thank you, Bet, and everyone on that panel. So could we have used a little bit more question and answer to kind of go through that? Was that the kind of session that could have used a little more discussion from the room? What do you say? Huh? Yeah. So, okay, well, good. I'm glad to hear it. Obviously, feel free to make friends and follow up any of the questions you have. All of the people on that panel, everyone in the room, of course, quite accessible, friendly, and here to share the love. All right, I got another, and this one is kind of an odd duck, but that's okay. We're going to throw it out there. It goes like this. You're under no obligation to be the same person you were 5 minutes ago. Aaron, what on earth am I talking about? You don't even have to be the same person as when you walked in the door. All right, now this one might be a little controversial because I know everybody's really wrapped up in let's say their identity. They've got a very curated resume and all the data, of course, is tip-top. All the TikTok things are nice and straight. But really, there's something about, like, say, the way a child, right, will instantly be a dragon in one moment, a race car driver next, and then, boom, they're an astronaut, and somehow they can instantly play and be open to that kind of transformation. Well, it's kind of a trick, of course, that I would encourage all of you to kind of keep in mind as you meet each other and discover new information, because really, the whole personality and everything about life evolves, and you don't need me to tell you that. All right, we're going to move right into our next exciting topic where you don't have to be the same person you were 5 minutes ago. Bitcoin basics and investment strategies. And this, of course, is a fascinating topic. We've already been touching on quite a bit of it. But I can think of no one better, of course, than one of our local experts. He's an OG in the cryptocurrency space, blockchain tech.
Everyone should be able to save and protect their wealth across generations. We built this company so billions of people around the world can take control of their financial lives. We've reimagined savings and protection from the ground up with digital money and modern technology. We're the world's first Bitcoin life insurer. For the first time, people can save, protect, and pass on their wealth entirely in Bitcoin. 4 years ago, we started working directly with individuals. Today, as the Bitcoin economy has grown, some of the world's largest and most conservative institutions are joining us in our vision. Every economy is built on patient, long-term capital. Bitcoin is the foundation of the next phase of global finance. We're not just building a Bitcoin company.
I promise not to tell you guys we need more new IRS agents. That's the one promise I make.
AI is not going to replace that?
We have an incredible panel here. Operators, allocators, and infrastructure builders who live in Bitcoin every day. This audience represents billions in deployable capital. We've got 40 minutes to give you some frameworks you can actually use. Let's kick it off. Why doesn't everybody take a moment to introduce themselves? Might want to turn it on.
Hi, let's try that again. I'm Chantel. I'm the VP of Operations at Bitcoin Well. We're a self-custody by default publicly traded Bitcoin platform. Essentially what we do is we have two different services. We have our retail portal, which allows people to buy and sell Bitcoin completely self-custody, meaning that you're in complete control from the moment that you utilize our platform. And then we also have our Bitcoin Well Infinite division, and that's where we help complete larger transactions and complete more of a consulting service. So we can make sure that your family office or your estate is set up for success when you're purchasing Bitcoin through us. And really the difference from us from a different platform is that we do not hold your Bitcoin. So again, you're in complete control from the moment that you purchase it from us.
Chris Sullivan, co-founder and portfolio manager for Hyperion Decimus. We are one of the first hedge fund companies in the space.
CJ Constantinos, founder of People's Reserve. We specialize in financial engineering, transforming Bitcoin from digital gold to pristine collateral.
Good morning. My name is Mark Henley. I'm the CFO of HB Management. That is a Naples-based family office.
Mark, my first question here is for you. You told me recently in the past week that when you joined your family office, they had less than 1% exposure to Bitcoin, and your principals called Bitcoin garbage. Fast forward to today, you're over at 10% and growing. Can you walk us through the journey of education, myth debunking? How do you frame Bitcoin's value proposition to your principals now? And how did you get them from garbage to a 10% allocation?
Yeah, so Matt, thank you for that question. I think to simply and shortly answer the question, I think on a journey like this, you have to begin the journey and stay for a long period of time in the truths of Bitcoin to create conviction. Once you've established that, then you begin over time to layer in the theologies of Bitcoin. And I'll unpack that in a minute, but I want to set just a quick context and framework for this conversation. So my family office is a single-family, first-generation family office. The entire wealth creation event was created when through the scaling and the exit of a home services platform roll-up. So think plumbing, electric, HVAC. That journey biases all of our capital and investment allocation, blue collar, hard work, real world assets, and also how we value capital allocation. Traditional cash flows, EBITDA, expanding margins, et cetera. Nothing in our portfolio would scream to you high spec or high beta, right? As one example, even for us, when we go way out on the risk curve and we do a venture capital SaaS deal, the applications of that software are still in traditional manufacturing type businesses. So at a high level, that's where we started. So enter Bitcoin, right? No P&L, no cash flow, no EBITDA. I mean, what is it? Even if we thought that Bitcoin was a commodity play, I can't store bars of Bitcoin in a safe, and I can't go to Texas and drill Bitcoin out of a well and put it into a barrel, right? It's literally computer code in digital cyberspace,
John, hi.
right?
I'm Jack. Yeah.
So what happens? How do you journey from that starting point that really lenses over all the capital allocation to a Bitcoin allocation? In my opinion, and this is universal, the most effective way to break down and break through FUD, which is fear, uncertainty, and doubt, or misunderstandings about Bitcoin, is not price. Price is fickle, price is time-bound, and price is communicated or expressed in a perpetually debased fiat currency. In my opinion, universally, the most effective way to do the journey is to spend time in the sacred, infallible source text of Bitcoin, where you find the truths, which is the Bitcoin white paper. Self-custody, fixed supply, decentralization, privacy. if you can get your head around or begin conviction or create high conviction, which is the hurdle for any of our capital investments, you can then evolve into the theologies, right? And so that's where the journey begins. And I'll quickly kind of just run through some of the signposts that mark what that journey actually looks like that you asked. So one, Bitcoin becomes, or it's viewed as a vehicle, not just to grow wealth, but also to preserve wealth. When you think about a family office in the context of generations, you don't view Bitcoin in years, you view it in decades or in centuries. So within the context of trust beneficiaries and generational wealth, Bitcoin plays an incredible part on a large generational arc of your investment thesis. Number two is you actually, because you now have conviction rooted in the truth and not in what some professional line drawer on Twitter shows you with a bunch of red candles or a bunch of 100x levered perps dump on some Asian-based exchange, you don't sell. You actually step in and buy because your conviction isn't rooted in price. It's rooted in decentralization, scarcity, fixed supply. And the last thing I would say for a signpost would be you begin to question the TradFi industrial complex. And this is where some of the theologies of Bitcoin really, can I swap this? So when you begin to question, as a signpost, the TradFi industrial complex, this is where you start to layer in Bitcoin theologies. And I could go on for hours about the theologies, but I'll pick just three of my personal favorites that I think always resonate with my principles. Number one, there are more Wall Street sell-side analysts who cover Procter & Gamble than cover Bitcoin. Even though Bitcoin's $2 trillion market cap is 600% larger than Procter & Gamble. Literally diapers and toilet paper. Why? Right? Question number two, one of my favorites. Despite being the single greatest performing asset class of the last 3, 5, and 10 years, when I call our global niche, white glove, family office, global money center, wealth advisor broker, I can't buy spot Bitcoin, but I can buy Procter & Gamble. Why? And I'll end with this, and this is my last point. Over the next 20 years, $60 trillion is going to flow from baby boomers to heirs. Are those heirs going to be buying Procter & Gamble or be buying Bitcoin? Act accordingly. And with that, just in summary, start with truth, later in theologies.
Wow, it's a banger. CJ, you're on deck. This one's for you. So to build on that, you describe Bitcoin as the most pristine collateral. For an audience that understands real estate, art, and securities as collateral, what does pristine mean in this context? And why is that a fundamental concept high net worth investors must understand?
Yeah, so I like to think about where we came from, where we're at now, and where we're going. And where we came from was gold was the underlying equity foundation of the entire system. And gold was a good collateral because it's hard, right? There's costs to pulling it out of the ground. You can't expand it infinitely. But there were a lot of problems with gold. You have to secure it. You have to transport it. And that creates friction within settlement. And that creates time. And time is money, right? So what do? We take a treasury and we say, we can fix this problem because now we have an interbank system that allows you to use a treasury as collateral and you're getting T+2, T+3 settlement. And we can fix that problem. But they created a new problem, which was we lost the hardness of gold, right? And the problem is with the treasuries, you can expand them infinitely. Maybe I'll try it like this. We can expand them infinitely. So we lose the hardness of gold, but we get the easiness of settlement. Enter Bitcoin. What does Bitcoin do? It gives you the best of both worlds. It upgrades the hardness of gold to absolute digital scarcity. There's only 21 million of them, and you cannot expand that supply. But at the same time, you get the best of the treasuries. Actually, it's an upgrade because it's not 2 or 3 days. It's actually 10 minutes. So now you get this quick, easy, secure settlement along with the hardness. And that's what makes Bitcoin, man, I'm not even kidding. That's what makes Bitcoin, that's what makes Bitcoin pristine collateral. Now, there's one more thing I want to add to this, and that is that in traditional markets, you all know this, the longer the term that you borrow the money, the higher the term premium, right? Because there's duration risk. So because it's proof of promise. So the longer the promise, the greater the chance that promise is broken. But what we're finding out with Bitcoin is that it flips that side. Because of the volatility of the asset class, short-term borrowing actually is higher risk. But because we're looking at an engineered money that was strategically designed to leverage the natural laws of economics to drive value into the network, over the long term, you get value accrual. So Bitcoin as pristine collateral takes duration risk and turns it into duration benefit. It is actually going to be Bitcoiners who are going to be the low-risk borrowers in the marketplace, not those who have the ability to tap into the printer and expand the collateral ad infinitum. And that is what we do at People's Reserve. I think that's what's really exciting about digital credit and Bitcoin-powered finance. There's a new equity layer foundation that creates a sustainable mechanism for lower interest rates without stating them or anchoring or having to perform yield curve control. Because the collateral itself reduces the duration risk. You don't need a third party to step in and inject liquidity.
Could I just thank John and Jack for having us all here? What they just said, the two of them just gave you one of the most dynamic, consolidated synopsis of pure, raw alpha in the description of what Bitcoin can be for all of us. That I really want to get a round of applause for John and Jack for doing this. I mean, I've probably done over 1,000 of these between podcasts and speaking, and that was as good as I could ever have said it myself or that I've ever heard. And I just want to jump in on the pristineness. Do you realize that part of the way you can tell how good collateral is a person's willing to lend on it, right? And then, because that's a private negotiated market, not a commanded or mandated rate from above or below, depending on your view, then you can really gauge the quality of that collateral. As a QIB, both for my family office and the hedge funds, guess how much it costs me to borrow dollars against Bitcoin? Anybody? 20%. Nope, not even close. 0. Who said 0 first? Gabe. Yeah, so does that not enhance or prove the pristineness of that collateral? And so I just wanted to add to all of what both Mark and CJ were saying to show you a real-world market application of humans transacting free of mandate to determine who the transaction itself and the interest rate. So just want to point that out.
Wow, we got to talk after this. 0%. It's pretty
for
solid.
me, maybe not for you.
Oh, not for me. Chantel, this one's for you. Your firm's mission is preserving generational wealth through self-custody Bitcoin. This is a stark departure from how ultra-high net worth families typically hold assets. Walk us through the philosophical and practical case for self-custody versus institutional custodians. What does self-custody mean for Bitcoin? Why is that part of the balanced strategy?
When we talk about preserving generational wealth or creating generational wealth, it doesn't only mean preserving the number go up aspect or preserving the value of it. What it means is preserving access to generational wealth. And so that's why self-custody becomes so important and why it is a stark contrast to what we're typically used to. However, it removes all of the counterparty risk. When you have the ability to set up a multi-signature strategy and policy within your family trust and make sure that your team is on your side and you're not having to rely on any custodians or subjecting yourself to risks such as bankruptcy and what happens to my assets if there's bankruptcy or if there's theft within the exchange. There's been so many different instances in history, not only from, say, a custodian exchange perspective, but even going back to gold. I mean, everyone thought that gold was theirs, and then obviously that turned out to be, there's a policy change, and then that is not yours anymore. And so if you're looking to preserve your generational wealth, you have to take the steps into learning how to self-custody your assets. And Bitcoin is the first asset that we have the ability to self-custody. We finally have the ability to become our own banks, and it's our responsibility to learn how to do that. You know what, there are a lot more steps, of course, and it's going to be some more education in regards to learning how to do this properly. But one of the things that we do at Bitcoin Vault Infinite is make sure that you and your family are set up for success so that you are in complete control and you don't have to trust us with managing your assets. There are still going to be roles for custodians in the market, but if you are looking at typical allocation, like allocate majority of the Bitcoin that you want to consider that as the generational wealth layer in self-custody. And then, you know, maybe if you need some for liquidity purposes, then leave it with a custodian. But if you are leaving it with a custodian, do your research. Look at their terms and conditions. If they go bankrupt or if there's an insider risk, make sure that your assets are not held up in that. Make sure that they are truthfully yours. And so why we think it's so important to self-custody is, again, because you have to make sure that if you want to create generational wealth, that your family in the future has access to it. And if you leave it with a custodian, you can't guarantee that that's going to happen.
Fantastic. Chris, this one's for you. As our panel's chartered market technician with a background at Morgan Stanley, you're deep into trading and modeling. I know many on the panel here would advise a buy and hold strategy, and I'm sure you do advise that as well in some capacity, but you offer other opportunities when it comes to trading to create some alpha. How do you advise a family office to get involved in that, and how do you use your technical analysis skills to model its famous volatility? And how do you analyze its correlation when it acts like a tech stock one day and a crisis hedge the next?
That's going to take a while. Let's reverse engineer and the unpacking of that. How do we harness volatility? It's through quantitative methods. TA is one quantitative method. Essentially, the maths you can parse out second, third derivatives, rate of change, volatility, contraction, expansion. There's a lot of factors you can code up that you can monetize in many different factions. For example, markets tend to trend. So if I'm running a quant fund, which I do, then I'm going to overweight my exposure to trending systems, right? To monetize the majority of the trend to the nth degree as a profit seeker, right? Then what I do with those profits, which is where part of the question you asked, is redeploy them into additional spot. So what we're doing is doing a best of kind of both worlds. We definitely are, if your allocation plan is I'm going to do a percent of crypto or Bitcoin, which should be Bitcoin, you need to go and just buy it. What Chantal just said, this is not only a generational opportunity, but this has never occurred in human history. Never occurred in human history. There's not even 21 million, there's 19.2 million. Is the reality. So in the United States, I believe there's 58 million millionaires. Well, who doesn't want at least one? And what our recommendation, because this is what we do at my family office, is at least one per person in your family. And that will protect you in a way that nothing else will, by sort of relitigating whether you should even have a counterparty control your assets at all. You know, some of you might be old enough to have received stock certificates where you actually had the material property rights to stocks. Currently, you don't have those. So this is a super unique, I would say, still early opportunity. But just to get back to the more dynamic parsing out of strategies, when you look at how to monetize something with what was 180 vol, now it's more like a 40 vol, you're trying to pair alphas to be accretive as one portfolio. So you want essentially each strategy to be orthogonal. What does that mean? Non-correlated to one another. So common phrases that people use to describe this stuff is mean reversion, momentum, stat arb, trend following, market neutral. So what we do is start with that discipline, and then we overweight or underweight based on market conditions and rebalance real time algorithmically with a macro overlay. So why do we do that? Because we want strategies that can win in any and all environment because you can't fully predict the future, we might have a big chop range. Well, that means trend and momentum are not going to perform well, so we need stat-R, mean reversion, or market neutral. If we're in a giant volatile bear market, we want long-short momentum. So the way that we approach it with the backdrop of always building more spot. So one side of the fund is constantly adding. The other side is constantly producing. And that blend kind of smooths out the ride of Bitcoin over time. And we've been doing it. This is our 8th year as a hedge fund, and have been able to outperform Bitcoin by hundreds of percentage points.
Mark, once an office decides to allocate, the next question is how? From your SFO, single family office perspective, what's the due diligence framework? Do you stick to passive vehicles like an ETF, hold the asset directly, or do you consider a more active productional approach, like vertically integrating through Bitcoin mining? Obviously, this is an area I'm deeply involved in, and it's known for its huge information asymmetry. Also, obviously, huge tax benefits, 100% depreciation right now. How does a family office even begin to diligence that option and its potential arbitrage, acquiring Bitcoin at its cost of production? Is it worth the complexity?
That's a good question, and there's a lot there. I'll answer the question this way. When you consider Bitcoin miners, things like that, digital asset treasuries, let's put all those things in the bucket of Bitcoin or crypto adjacent opportunities. Fact. Over the last 3 years, there's been tremendous alpha versus spot Bitcoin in those buckets. For example, not financial advice, this is just math. Over the last 3 years, Robinhood, Coinbase have vastly outperformed spot Bitcoin. There's this other company called like MicroStrike. I'm sorry, MicroStretch. No, it's a software company, and they do something with Bitcoin, and it's done pretty well. I'm sorry, don't poke the goat, right? So the truth is, you can move outside spot Bitcoin and find tremendous alpha. Our problem is really a Sharpe ratio problem, right? Since the Bitcoin ETF launch, spot Bitcoin Sharpe ratio went from 2.7, which is a measure of vol to risk, down to 1.4. So we've seen a 50% drop in Sharpe ratio in Bitcoin post ETF. We like that. Most of the public miners, and you can just Google this, trade north of a 3 Sharpe ratio. Again, going back to what I said before, when you still have, or you view yourself as a relatively conservative allocator, plus 3% Sharpe ratios just do not fit our model. And so I would say maybe in phase 2 of the journey, we say, can we do some +2, +3, some hedge funds that will outperform? But for us, it's just a Sharpe ratio problem at the moment, going outside spot Bitcoin.
Makes good sense. CJ, for families who have been sitting on the sidelines, what framework should they use to determine entry points? Should they be dollar cost averaging, waiting for specific on-chain signals, or thinking in lump sum deployments? How do you advise they avoid the psychological trap of waiting for the bottom?
Well, thank you for the opportunity for me to give financial advice, Maddie. I appreciate that.
Everybody's accredited here, so you're good.
So I think, the number one thing that we should be looking, here I go again, the doubles. The number one thing I should be looking at, I think, is Bitcoin's cost of production. So if you're looking for an entry point, and there's 2 parts to this answer. If you're looking for an entry point, you should understand cost of production. And if you need advice on that, go to Matty, because he knows cost of production. But I think right now, would you agree, Matty, it's around like 70 to 75 on average, right? And it
really depends where you're at.
Yeah, if you're in Ethiopia, it's way down. But on average, it's around 75,000. So when you look at the market price and you put it relative to the cost of production, that gives you a good idea whether or not you're going to get a premium or a discount, right? And that's very easy to relate to real estate. Everybody in here understands that if you see the price of real estate below the replacement cost, it's like, wow, yeah, we really have to take a deeper look at this opportunity because we're getting big value here. And if the price is too far above the replacement cost, it's like, well, are we chasing this opportunity here? What defines this premium? Why are we paying this premium? So if you're looking for an entry point, that's where I would start. Look at the market price relative to cost of production to understand whether you're going to be paying a premium or a discount. Now, the second part here is, and I think this is what's so exciting about the future of Bitcoin, is that it's no longer just solving the store value problem. With what you see Saylor doing at micro stretch or something like that. What do you see Saylor doing, right? We have the honor of seeing him speak later today. It's going to be amazing. Amen. But with digital credit and Bitcoin-powered finance, Bitcoin is now solving other problems. So we're no longer just solving the store of value problem when you hold Bitcoin spot. We are now seeing financial engineering and plugging Bitcoin into different products and services that create cash flow and guaranteed access to affordable credit, or if you're Chris, free credit. So that is really amazing because you can answer different portions of your portfolio, right? Everybody loves to talk about the investing side of their portfolio, but everybody also has a lending side of their portfolio. So you have diversification within your investments. What about diversification within your lending? Are you just lending your money to the government? Because there's other people you can lend to. And by the way, they don't have the ability to print the collateral. So remember, you can get access to Bitcoin through many different methods, and now it's solving multiple problems. So through strategies, multiple preferred offerings, you can now have a cash flow vehicle secured by Bitcoin, right? So you're not looking for massive upside. You're looking for cash flow that is going to continuously produce. And by the way, it's going to produce at a rate that creates a positive real rate of return, right? It properly incentivizes saving over investing. Right now, if you believe the government, I'm sorry, but CPI is not 2%. It's not. Everybody in this room knows that price costs are going up much higher than that. So even at a 4% rate, I think the real rate of return is negative. So the price you're paying for that cash flow is a negative real rate of return. To me, that's unacceptable because the laws of economics would tell you, hey, when the rate is negative, you should be spending or investing, not saving. But now we see a structured product that takes Bitcoin's engineered design and creates a cash flow from it. So that's really amazing. And then you say, well, what else? What other reasons could I have besides storing value and generating cash flow at a real positive rate of return? Well, access to credit. Because now you're talking about a commodity credit. It's no longer proof of promise. It is an equity layer foundation that eliminates risk for the lender. So at People's Reserve, we have a Bitcoin-powered mortgage. One of the reasons we're able to offer rates that are the lowest in the world for home buyers is because when you come to us to buy your home, you are posting Bitcoin collateral, so the loan is secured by the property title and the collateral itself. LTVs usually start around 50%. So from the lending perspective, we don't need to package this together and sell it off to Fannie and Freddie because it's high risk and it's a long-term proof of promise. There is an equity component to the debt, and that secures the debt. So if you need something on your balance sheet that you want to leverage, it's much better to be able to leverage against Bitcoin and take a little risk here and there. It's much better to add Bitcoin to create cash flows with these preferred offerings. And of course, there's no better way to store value than Bitcoin. But that's what's so interesting right now. It's not just about using it as a store of value. Now we can hit cash flow. Now we can hit affordable access to cheap credit. And for those three reasons, who really cares about what the premium is, right? If you can capture a discount, capture it. But if it's trading at a premium, that's why it's trading at a premium. Because you can now do these multiple things with it that it's so new, we've never seen it before. So the whole world is kind of just flabbergasted right now. And if you feel 100,000 to 75,000 is a justified premium, that's kind of like saying the MNAV on strategy right now is justified. It's not. When you see what they're building and what they're building towards and the liquidity that's going to flow in and how that value accrues to shareholders, because they only have to pay out the 10%, but we have, 60% CAGR? They are arbing that. That's their profitability. That goes back into the company. So take advantage of the misunderstanding in the marketplace right now and understand it's not just a store of value. With financial engineering, it's a cash flow product and it's access to the cheapest credit in the world.
That was good. Some good alpha there. Chantel, this one's for you. Let's get practical here. How does Bitcoin Well operationally onboard a high net worth family office that wants to self-custody? What does the actual playbook look like there? Are you walking them through multi-sig, geographic distribution of keys, succession planning? How would you onboard somebody?
Yeah, absolutely. Thanks. So one of the first steps when onboarding any family, any individual, any trust is first off setting a meeting with them and getting a really good understanding of what are their goals, what are your knowledge, or where's your knowledge in Bitcoin. Have you ever set up a self-custody wallet before? And once we have that meeting with them, we really get a good understanding as to, okay, should we be helping you or advising you to set up a trust, or are you going to be buying this through your business? Then we get all the stakeholders involved, say if we're going to be setting up a multi-sig structure within their organization or within their trust. We make sure that everybody completely understands what it means to hold your private keys, how to safely, securely store them, manage them, make sure that there's redundancy built so that you're not ever losing access, and then just being there to essentially answer any questions and make sure that they leave that meeting itself with enough confidence so that there will be no mistakes of, say, key loss. And after that, that's when we would really help them actually design the actual strategy of the multi-sig setup. So helping them get hardware wallets, going through the process of testing out transactions before we're purchasing a large sum of Bitcoin on their behalf. And then once all of that testing is done, the governance plan is essentially created for them. That's when we would move forward with the actual transaction itself. When we're transacting, essentially a customer would send us over a wire transfer. We would buy that Bitcoin right then and then send them Bitcoin to their self-custody wallet that is in their complete control. And one of the things that's very important to be doing is consistent follow-up, making sure that, in every quarter, do you still have access to your keys? Do we need to be testing everything out, signing a transaction, making sure that the hardware wallets are still working? And if not, let's get those keys imported into a new hardware wallet so that if there's an emergency situation and you need to move everything very quickly, then you're not stuck, stressed, panicking, and nothing's working. Let's just start proactively planning any emergency drills so that you can always have access to your Bitcoin.
Well said. We've got about 9 minutes left, so I'm going to ask a question for the next 4 minutes, and we can all kind of opine on it a little bit, and then maybe we'll do 5 minutes of Q&A at the end. We'll start with you here, Mark. Let's address two elephants in the room for every family office: regulation and volatility. Mark, from your time at Cogent Bank, how did you diligence regulatory risk for a chartered bank? How are things changing with subjective terms like reputational risk?
I did not share in my bio earlier that prior to the family office, I worked for years building within a regulated FDIC bank, a crypto digital asset friendly bank within a commercial bank, which is how I met some of the folks that are here today. So at that time, keep in mind, when I was there, to your point, this is pre-FTX, pre-Celsius, pre-everything. And that's such a complex question. All I would say very simply is when you read articles now about the pro-crypto administration, what that really means is clarifying rules that have been unclear or highly biased against non-traditional assets for decades. When I was trying to build the crypto bank within the FDIC structure, I met with the FDIC regulators out of Atlanta, who was our primary regulator. They didn't even know what Bitcoin was. You cannot write policy or guardrails when you don't even understand what you're doing, let alone the KYC, AML, FinCEN, et cetera. So there's a lot there. What I would say is there's huge progress, clarity, all the laws on the books. And I think this administration, relative to the framework, will literally usher in a very different dynamic. But when I was there, it was brutal. Choke point, all the things you heard about, it's all true. Like, it's not just a bunch of like the moon is flat, or I'm sorry, never went to the moon. Earth is flat. No, my bad.
The moon was made of cheese.
Yeah, no, my bad.
The moon was cheese.
There's a lot there, but I just generally speaking, there's a lot of really good things happening right now within that space, and I think as it evolves, it's good for obviously adoption and obviously price appreciation.
I think I understood the question. No. I think I'll go with this, though. Let's say we're going to invest $1 trillion to expand our infrastructure, and we want to have a good reputation. So what do? Oh, here we go. I am the best. Something about my voice, guys. I don't know. So we want to invest $1 trillion in infrastructure, and we want to have a good, strong reputation. So what do? We beg the government to backstop our private credit, right? Oops. Yeah, okay. Do you hear anybody in Bitcoin begging for a bailout? That nothing went wrong. They're already begging for backstops with this AI movement, right? What is the problem with the traditional system and what has wrecked their reputation? Socialism. Socialism for the extremely wealthy and the extremely rich who don't care about other people and only care about themselves. And what that has done, it has introduced a problem into the natural market cycle. With that type of reputational risk, like we don't want to fail, we don't want to learn from our failures, we want to get bailed out, we are missing the credit destruction part of the cycle. That's what's happening. So the traditional system is not allowed to fail. It's too big to fail. And what happens is you have to print through it. But when you look at a business cycle, failure is a must. Could you imagine if FTX was still around today? Because they got bailed out because they were too big to fail? What does that mean for the industry? So I think Bitcoin comes in and says, you know what? Let's have a natural market cycle. Let's let the over-leverage, the mismanage, and the fraud fail. Let's not ask for a bailout. And in that way, we'll develop our own reputation, a reputation for true free market. And you have regulators and, yeah, they're trying their best. And we're fighting against China, and we're fighting against Russia, and we're fighting against people who can print and invest. Chris and I were talking about that backstage. So you got to play the game. But the best way to play the game is to let the free market do its thing. Because when you wash out the leverage, and that's what happens in Bitcoin. If you're over-leveraged or mismanaged in Bitcoin, with no mercy, you are destroyed. And what happens? We build from a stronger foundation. That's why we look at Bitcoin, and we don't really care about the highs. If you've been Bitcoin for a long time, who cares about the highs? It's about the lows. And they keep going up by design, because when you get that over-leverage, when you get that speculative bubble, when it comes back down to reality, when you get the reversion to the mean, all of that gets washed away. And when it gets washed away, you build from a stronger foundation. And you know what? In the long term, it's easier to regulate an industry that allows failure. It's easier to regulate and build an industry that builds from a strong foundation of rock rather than a weak foundation of sand and walls and bailouts and printing. And I think for that reason, in the long run, the regulation will actually become easier. And then the market will be empowered by true free market dynamics rather than what we call now capitalism, maybe socialist capitalism. And we can move into a true free market capitalist market with real price discovery, regulations that actually protect investors, and then washouts that actually get rid of the bad ideas, get rid of the bad managers who are underperforming, and most importantly, get rid of the fraud.
Great answer.
I'll try and go a little faster to address all of the above. One, without the ending of the central banking system, there is no such thing as free markets. So we're not in one. We've never actually been in one, except if you go pre-1812, and then maybe a brief period after Andrew Jackson killed the bank. But otherwise, it has not been a free market. Then in terms of volatility, if you are concerned about volatility, you're doing it wrong and should go home. Volatility is your opportunity, not your risk. Then on regulation, I've worked with FBVA, Bitcoin Bay guys since 2017. We've actually passed 4 pieces of legislation here in Florida. I was recently in DC, literally on Capitol Hill the day before the shutdown, which was fun, advising on the market structure, 2 days before the shutdown, discussing and advising on the market structure bill, crypto market structure bill. I can tell you with faith, having also gone to law school, there is no such thing as a good regulation. Regulations are written and designed by those who want to stifle out competition. So a family office should not consider any regulatory overshoot or undershoot and should invest with only alpha production in mind.
All right, what do you got, Chantal?
Yeah, I guess I just echo that sentiment as to what Chris had said. I don't think that, we cannot be regulating the markets and, oh, sorry. Is that one working? Oh, all of them? Okay, both of them at once. Yeah, sorry. I think that, as regulation goes in, I do completely agree that it is going to be stifling innovation in a lot of senses. Going back to what you had said about, about the, sorry, can you repeat? Sorry.
I'll repeat the question here. So, how do we address the two elements in the room here for family offices, regulation and volatility? Obviously, you have a publicly traded company, so you know a lot about the former.
Yes. Okay. Sorry about that, guys. Restarting. So when we have to look at regulation, I think that what is important to evaluate when you're entering the market is looking at who you're partnering with from a regulatory standpoint. So you don't want to be, say, if you're purchasing Bitcoin and you're dealing with a company that is unregulated, it's going to put a ton of risk on your family office. And so you have to be looking at back to what you had said about, it's the MTL registrations. Are they doing KYC? Are they doing KYB on you? I think it's important to make sure that you're following the correct procedures and that the business that you're dealing with or purchasing the Bitcoin through or the custodian that you're dealing with is going to be regulated so that you're not putting your family office at risk. In terms of the volatility itself, again, I think that the volatility is a feature and not a bug. The volatility gives you that opportunity to be getting in at a lower market. And what it also does is the volatility creates interest with the general market, which increases adoption. A lot of times, when the number goes up, that's when people start talking about Bitcoin again. And I think that as Bitcoin becomes further adopted and as that number is going up, it's just going to be obviously beneficial for everybody's investments.
I'm told we've run a little bit over, so we're not going to do a Q&A session, but if you do have questions, come talk to us in the hallways. I just want to thank all of you for coming today and giving such a great panel, such a great speech. Thank you, guys.
Yeah, I think.
So you guys can just line up here. You get in the middle.
Oh!
You're on the...
And we'll be right back up with a very special presentation.
Good job.
Bye.
La-di-da. You to meet stage right now. Sullivan, the guy that was kind of slouching. Tall guy? Yep. All right. As a friendly reminder, everybody, this event today, Naples Symposium, our third annual event, is actually being live streamed. And I believe you can catch the feed out on LinkedIn. Search for the Naples Symposium, as well as, a YouTube channel. Simple as that. So, for those of you following along at home, you can tune in, watch the live stream, again, out on YouTube and LinkedIn. And, of course, we'll have that replay up probably for a little bit, and then look forward to some curated vignettes selected from the day's activities. All right. Oh, look at that, Mia. The clicker's not clicking. There it went. Always with the technology, huh? All right, everybody. Okay, so we've got a fascinating presentation coming up, and brought to us by our esteemed and generous partners, Vault Insurance. And then we're going to do this. We'll have another segment, and lunch will be served very soon, right after that. So I know everybody's, of course, getting antsy, getting hungry, but the information that you're about to see, of course, is a fascinating tale of really an OG. Scott, can I call you an OG in the insurance industry? No, like an original gangster. That's what the OG means. Scott Carmellani, of course, Scott Carmellani, excuse me, he's a chief executive officer and the executive chairman of Vault Insurance. And of course, they provide quite a unique package and product and services for, well, affluent folks that, of course, that realize that their needs and insurance coverage and whatnot doesn't just typically fit in your average little cozy box. And of course, without me trying to explain it, we're going to have Scott come up here and give us a proper shakedown. Scott, please welcome to the stage. Everybody give him a nice round of applause, please.
Okay, where are they based?
All right. You look comfy right there.
Not yet. Try that. That works. Good morning. I realize I am. What do you want?
He says go back to that.
Go back to that? Yes? No? Maybe?
Roll it forward.
Oh. How about I do this? No? Yeah. Okay. Higher. All right, I'll just hold on to it. Good morning, everybody. I realize I'm the intermediary before lunch. I learned a lot this morning. I got a few handouts from the earlier presenter, which I'll make a reference to. Oh, thank you. I'm going to need that. Yeah. All right. Just keep a hold of that and keep going back. All right. Sorry. So homeowners insurance, how do we make that an impassioned, lively talk for 15 minutes before lunch? Usually I get into a big audience like this and I give a very impassioned speech of how planes don't fly without insurance, although the FAA and our air traffic controllers might have something to say about that. Real estate doesn't get developed. Houses don't get bought and sold. You cannot get a mortgage without insurance, maybe with Bitcoin as a backup, I don't know. Learned a few things earlier this morning. You cannot drive a car out of a showroom without your insurance. So your homeowner's insurance, your auto insurance, your collections insurance, your liability or umbrella insurance, with the gentleman from Merrill Lynch mentioned a couple of horror stories about jury awards for accidents involving people getting hurt in auto crashes. I could spend all day up here talking to you about double-digit, multi-million-dollar settlements and jury trials that go on almost on a daily basis in that marketplace. And I wanted to address and was asked to address the value of your insurance and how to unlock that. There's been a massive rise in cost for homeowners insurance and auto insurance here in the state of Florida, but really all around the country. And both the cost and the availability of that insurance, particularly right here on the West Coast of Florida, where there's been 3 or 4 hurricanes in the last 7 years. So that's made it even more difficult. And you can't really go through that without understanding and getting some explanation, or at least the backdrop as to why, right? So I'll try to touch on that. And then I want to talk about the relative value of your homeowner's insurance, which everybody always undervalues or underestimates. No one, including myself, wants to pay more for their insurance than they have to. Everyone sees it as a necessary evil, but there's real value in that asset and the protection of what's likely one of your most important and most valuable assets. I mean, whether you're worth 10 million or 20 million or hundreds of millions, your home or your homes is usually one of your most valued possessions and all the toys that go in it, whether that's your wine collection, your vintage Ferraris, or your art collection. There's something to protect there, and how you do it matters. There are only 5 or 6 high net worth homeowners insurance companies out there in the marketplace today. So it's a very small niche market. There's $50+ billion of insurance premiums, and more than 50% of it is distributed through what I call the mascots. You know, the discount double check commercials you see on TV, or you used to see on TV before State Farm lost a lot of money. The Gecko Lizard, or Flo from Progressive. Those are all household brand names, and they spend hundreds of millions of dollars in marketing, but really provide almost little to no service, and we'll talk about that. What I want to make sure I get through to everyone is the relative value of that. We were talking to tax accountants earlier, trust advisors earlier, lawyers. No one questions how much they pay those guys, right? And their job is to not screw it up. Their job is to make sure you're protected, to make sure your assets don't go down. But they don't take less money if you lose money. They don't take less money if you get audited by the IRS. In fact, I've been audited by the IRS. It costs a lot more money when that happens. And the burden of proof is on you. You have to go to, your accountant has to go to whatever state he has to go to, and the burden of proof is on you. Now, I won, so just for the record, I did not have any tax problems. But the relative value and the relative cost of the insurance is comparative to what you get from your other trusted advisors, and arguably is actually less. For cents on the dollar compared to percentages of your assets, and what you get for that if there's a calamity, a loss, a fire, a hurricane, a tornado, whatever that may be, and we can talk about some of those, you get there. What people don't look at is the relative value from even their property taxes. You know, Florida property taxes are close to 1 or over 1.5%, depending on what county you live in, and that's a lot of money on a $10 million house. It's even a lot more money on a $20 million house or a $50 million house, and there's no decreased value. So as values have gone up, and the appraisals have gone up in the last decade, so has insurance costs. People don't complain about their property. Well, they do all complain about their property tax, but it's all relative, right? People don't necessarily complain about their cost of their landscapers or their pool man, but they'll think nothing of spending $2,000 or $3,000 or $4,000 a month to cut their grass and trim their bushes, and that doesn't cover the cost of the mulching or the additional fertilization, which, you know, it's additional costs if you look at those bills. And you know, that adds up to what you normally is more than your homeowner's insurance. So, you know, there is value in that. But let's go back to why and where the homeowner's insurance and what's causing the value differential. So here's a map, right? This is FEMA's map of all the flood zones in the country and the fire zones out west. And if you look at it and overlay the 10 most wealthiest cities by property values, they're in the same places. Wealthy people want to live on the coast, whether that's the Northeast, the Southeast, the Gulf Coast, or the West Coast. That's where the highest values and concentration of those values are in the United States. That doesn't mean there aren't wealthy people in the Midwest, in Chicago, or anywhere in Illinois, or anywhere up in Maine or the Northeast. In fact, most of those wealthy people also own homes in one of these other places. You know, almost all of our clients own homes in the Northeast or the Midwest, and have a ski house in the West Coast or near wine country or down here in Florida. And that's a very common thing. What drives the values is the increase in the values of the homes and the concentration of that risk. So in the last 15 years, even right here, if you drive around, and I drove across from Palm Beach County yesterday, across Alligator Alley, it's unbelievable how many more homes are here than there were a decade ago, and how high the values of those homes have gotten. Everyone who's bought their home for $3, $4, $5 million a decade ago, those houses are all worth $8, $9, $10 million. Maybe if they only bought them 4 years ago. I met a gentleman earlier who bought a home here 4 years ago. I'll bet that house is 40% more than it was when he bought it in 2020. And we underestimate that. It's not necessarily the cost of the home, it's the cost to replace the home. Only about 30% of your premium is derived because you're in one of these concentrated areas. The cat risk, as they call it, the value of the catastrophe risk, the modeled expected number of storms in a 10-year period or a 20-year period or a 250-year period, doesn't matter. But it's roughly the aggregation of that risk in these concentrated areas that cause the value, the cost to go up. Because if a storm, and when a storm does come through here, and there's been 3 in the last 7 years right here, some north of here, one run right through here, and a couple hit Tampa pretty hard. Luckily, the East Coast has been spared, but North Carolina got hit pretty bad last year, and this year, California, as we've all seen in the press, has witnessed $40 or $50 billion in fire losses. That's all borne by the insurance and reinsurance industry. And the other 70% of your premium has nothing to do with the cat. I tell people all the time, it's the cat doesn't kill us. It does not kill the high net worth insurance companies. What it does kill is the fly-by-night, one-off, one-hit wonders that pop up in Florida and disappear after there's a hurricane or a tornado that comes through. And there was a tornado that whipped through the middle of the state last year as well. So 70% of the costs, somebody was saying, back off, there it is, comes from the things that are caused by hurricanes. That's water losses, fire losses, flood losses, the pipes break, the electrical causes a fire, any of these impacts. And there's been a whipsaw or a J curve really since the pandemic, since the COVID years, where what's happened, what's been the dynamic? Not only has the cost of supplies gone up exponentially, whether it's plywood or masonry, it's the cost of those service providers. No longer can you get a plumber to show up or an electrician to show up, an HVAC contractor to show up to even change a thermostat unless they're getting $200 an hour. That used to be $70, $80 an hour. Now it's $200 an hour. Add that to the cost of copper to replace your electrical wiring if you're remodeling your house, to redo the plumbing if your home is more than 20 years old, or to put a roof on. Roofs now cost anywhere from $75,000 for a small house to $400,000 or $500,000 on an 8,000 or 10,000 square foot house, particularly here in Florida. And what used to be the game of you can buy a 20 or 30 or 40-year roof, and everyone thought it was guaranteed for 30 or 40 years. Well, if you look at the fine print, it's really guaranteed for about 4. And what these manufacturers have developed is a way to beat that system too, so they have repeat business. Not only do you need a new roof, but they change the colors, or they change the tile pattern, or they change the roof you put on 5 years ago, unless it happens to be a standard roof, which most high net worth homes don't necessarily put on a standard roof, you've got to replace the roof, even if you only have a small section of your roof is damaged, because it won't match, because they don't make that tile anymore. So now a $50,000 replacement fix becomes a $250,000 full replacement. Materials have gone up dramatically since COVID, but so has the cost to get anyone to show up to do the work. And that is what's driving that. The other thing that I like to talk about in these sort of things is the value, unlocking the value of a high net worth carrier and differentiating it from a standard market carrier. Whether it's the Gecko or Flow or the Mayhem of Allstate, they still handle more than 50% of the market. More than 50% of the market goes through them. That's a mass market business. They're not that they're bad. It's just that the product is different. The service is different. What you get for it is different. When you buy insurance from a high net worth carrier, you're getting a team. You're getting people. You're getting real claims handling service. You're getting a real team behind you if a plaintiff lawyer that you see on a billboard is coming after you because you've been in an accident. You're getting a real group of folks that are in-house that will push back on the big Morgan & Morgans or the plaintiff firms that want your assets, that want your policy limits if you have an accident. And that's usually how it starts, We offer risk management tools that don't exist. You'll never hear from a standard market carrier. We don't deal with bots. We have no bots. If you call Vault or any of the high net worth carriers, and there are 5 or 6 of them, you get a person, and you get a person rather quickly, and you get real expert advice rather quickly, whether it's what do I do with my cars if the impending storm's barreling down on you, or how do I move my boat, or what do I do to batten down the hatches if I don't already have that. We'll come out and assess your home. We really assess almost every new home we insure, and then do it as a service every 3 or 4 years. And we'll look for the vulnerabilities of your home. Is your generator working? Does your fire alarm work properly? Is your water shutoff valves to prevent a massive plumbing leak tied into your alarm system so you get an alert if your plumbing doesn't shut off? Some of the worst losses I see when someone goes away for a month or 2 months or 3 months, and the third floor toilet starts running and doesn't stop, and fills up and overflows, and that leaks down to the second floor and into the first floor and into the kitchen, and all of a sudden you have $3 or $4 million of damage. That's probably the biggest nuisance loss that we deal with. You are dealing in a high net worth insurance carrier the way you would buy a plane ticket. A lot of us in family offices and high net worth businesses fly private. You do that for convenience. You pay more for that. You pay more to be able to drive up to the FBO, hand your bag to the valet, and walk onto the plane and go away. You don't have to go through TSA. You don't have to go through security. You don't have to wait online to fill the bus up, and you don't have to be delayed. You go. And whether you're buying a first-class ticket or sitting in row 36D, will you pay for that difference? Most people will, that are high net worth. Most people would rather sit in rows 1 through 6 than in 36D and board the plane first for whatever reason, even though they're not getting out of there any quicker. It happens. And there's a reason for that, If you're buying a car, do you want to buy a VW or you want to buy a Kia? They work. They get you to A or B. Warren Buffett brags about driving a pickup truck. He also owns NetJets, by the way. So some of that's a little tongue-in-cheek. I don't think he drives himself anywhere, but he definitely has a pickup truck. Pickup trucks today can run you $100,000. The mass market, I've met with most of them in the last couple of years because they've come to us and said, listen, our model's broken. We can't actuarially figure out how to price a car worth more than $150,000. Never mind service it. Never mind getting it fixed to the satisfaction of the client. That's scary. And they're handling a big chunk of the marketplace. They self-admitted to me that they lost $12.5 billion in the fires in California. The mass market markets that are out there still haven't gotten their checks for their insurance, still haven't decided if they can build or rebuild, still might be negotiating with a third-party adjuster to try to get their claim. Every one of Vault's claims have been paid in full with under 45 days. There were homes that we saved from being burned. They had some smoke damage, but we sent in crews to, fire break the property and make sure they weren't affected. In the last storm that came through the West Coast here, we called out 750 clients in the Tampa area and said, hey, this storm's coming right at you. If you don't have a place to move your car, your house is at sea level, we'll help you move it. And it's going to be there in 48 hours. That's an appreciated service that high net worth people and family offices appreciate. There's a value to that, and it costs a little bit more. Whether you're, if you want to fly in the front of the bus, if you want to fly first class or business class or internationally and privately, you pay more for that and gladly do it. But everyone complains about it when they're talking about their homeowner's insurance or their umbrella insurance or their auto insurance or their insurance for their boat or their yacht or their plane. There's been a lot of catch up in the insurance business and a lot of inflation costs that's come through the pipe in the last couple of years. But we're now at a point where there's some stability. Looking forward, I think the industry and the market has caught up. And the differentiation and the value that the high net worth carriers offer is really the service. It's really the people, whether that's the claims handling service and the ability to pick up that phone in seconds, not minutes. Someone earlier talked about calling the IRS and waiting for 4 hours. Try talking to a bot about your auto coverage. See how long that takes to get an answer. If it's a simple fender bender, they might be able to take a picture of it, send it in, and be done. But if you have a $200,000 Porsche and you get into an accident with a high net worth carrier, and you're not at fault, the high net worth carrier pays you up front, gets your car into the proper service, and then gives you a car like in kind to borrow until your car is fixed. That's become increasingly expensive, especially if you drive a Tesla, because it takes longer to get a Tesla fixed because there's just not available body parts than it does for a regular car. There are more and more cars worth well more than $100,000 today than there were, not too long ago. I mean, a Range Rover costs $190,000 new today. Never mind the Porsches and the Ferraris and the high-end Mercedes or the AMG cars. So you get what you buy what you get. We offer the inspection service as part of our deal, as do most of the high net worth carriers. They come to your home, give you a full assessment of your plumbing, your water sources, your generator protection, how well your wine cellar works, what's tied into your security system, what's not. You do with that what you want. But how old your roof is and whether you need new appliances, how old your HVAC system is and what's going to happen in the near future. Anybody who needs to replace their air conditioner or HVAC anytime soon, you better do it now, because what would cost $5,000 or $10,000 to replace the air handler, come January 1st, there's a new federal law out there that's changing the content gas of the Freon. So now not just the outside unit has to be changed, so does the inside unit to comply with it. So now to change any AC unit in your home, a 2-ton, 3-ton unit is going to be $20,000, $25,000. And many large homes have 3, 4, 5, 6, 7 of them, depending on how big your home is and if you have guest homes and anything's on the property. So the value at the time of loss, when you have a loss, the high net worth policy doesn't just cover the inflation cost to rebuild your house. It doesn't matter what you paid to build your house, it pays to fix it. It's not a stated value, it's a replacement value contract. That's infinitely more valuable than what's in what's actually charged in the contract. There's also something called additional living expenses, which is very underappreciated and almost never understood. If your house is in a hurricane or in a fire or tornadoes destroyed it, or if you just had a roof leak or a plumbing leak and the house is registered uninhabitable because there's mold and we got to do remediation and all kinds of changes, they will rent you a like-in-kind home in the neighborhood. Well, I don't know about you guys or anybody who lives around here, but if you're in the Palm Beach County and you try to rent a home on Palm Beach Island for the season, you're looking at $60,000, $70,000, $90,000 a month. I'm sure that's more than they paid for their homeowner's insurance. And that could go on for 4, 6, 9 months to rebuild your house. So there's a value in that. There's an intrinsic value in that doesn't exist in the standard market insurance contract. There's a service aspect that does not exist in the standard market contract. There's a customizable coverage feature that does not exist in the standard market insurance. You can customize your insurance. The true value to unlock in your homeowner's insurance is ask for customization. If your house is worth $10 million and it would cost $20 million to rebuild, but you only want to insure it for $10 million because your wife wants to knock it down anyway, we could do that. You can have a risk-sharing endorsement in there where we could share the cost. If you want only insure the cat risk and take all the maintenance out of it, we can do that. You can buy $1 million deductible or $500,000 deductible, or cap the loss on, cap the coverage for if your roof is 25 years old and you want to, and you need to replace it, and most carriers would say, they just say no. They don't get in a debate with you. They just tell your agent, no, we're not in that business, or we don't want that risk. So you wonder why you're getting declined. It's because you need a new roof. But you want to come to a high net worth carrier and say, I want to insure my house and not insure the roof, done. You want to put a depreciation schedule on that and discount my insurance, you can do that. That the value of the customization for a high net worth insurance policy, infinitely more options than there is in the standard market. Because the standard market, it's a box. You got to buy within that box and it's got to fit their box. And the box for the standard market breaks around $3 million in value for almost the entire industry. Once you get past $5 million, they're guessing. And it doesn't mean you can't get the insurance, because there are agents who will strong arm some of the carriers to get it done. And there are agents and there are carriers out there that will, because of posterity, keep you as a long-term client. But it doesn't mean you're going to get the same value for it if you have a loss. And you need to be cognizant of that. You need to be aware of that. You need to use that as an asset, and an asset you can protect. I think I'm trying to get to the end of this so that we can, I think that is the end of that. Okay. So I'm not going to go through the slides. I put them up there for your reading pleasure while I'm talking. I can ask her a couple of questions, or I can get the hook. I think we're getting close to time here, and we are getting close to time here. So thank you very much for your attention. Good luck investing in Bitcoin, and I've learned a lot today.
Wow. Scott Carmellani. All right. There we go. Lovely. All right. I encourage all of you to say hello to Scott before you leave today. A lot of fascinating information, and he's been through the industries and watched it all evolve incredibly. I know that, of course, in the live event business, the rule of thumb is you can't do a single thing. You can't do anything if you can't insure it when it comes to doing big events. So I appreciate the special thing that they cover. Thank you to Vault for being very generous with us and help producing this event. All right, now moving on and moving along, I would like to tell you about a thing. Sorry. What if I told you a phrase like that? You long the heroes and you short the zeros. Does anybody know what I'm speaking about? Come on. Anybody? Anybody? At least one person over there. Matt, I see you in the corner right there. Longing the heroes, shorting the zeros, of course, means longing the value creators and shorting the destroyers, right? It turns out to be a fascinating niche and a sort of a thing that's really right in front of our faces as we watch what really drives the market. And of course, we've come across a good friend of the community and has become a good friend of this production. And he has this fascinating calculus that he calls leadership alpha. And he's going to come up here, of course, and give us a proper breakdown of it. And why is he qualified to do that? Well, our good friend Kareem is not only the founder of Paragon Intel, which, of course, is a preeminent research firm used by many of the world's top hedge funds to research CEOs and boards and looking for the distinctions that will show up through leadership. But he's also founded, of course, a new fund called Eagle Talent Partners. And, of course, they do some fascinating work. Kareem has been inspired us since the get-go, since we entered this conversation, to help us help develop kind of a new feature or a new dimension, essentially, to what it is that we're doing with the Naples Symposium. And without any further ado, everybody, please welcome to our stage Kareem Mauji.
There it is.
All right.
Thank you, Jack.
That was pretty close, right?
That was very close.
Let me get out of your way.
All right.
Excuse me. Your mic on?
Is my mic on?
There it is.
Beautiful. Thank you.
Remember the blue button.
Blue button. All right. See if this works. All right, there we go. Everyone in this room has lived this story or something like it. You've analyzed the numbers, the strategy, the market share, and everything looked solid. Then a CEO changed. Within months, even weeks, something felt different. The tone, the energy, the outcomes. And before markets caught on, you could already sense it. Something fundamental had shifted. That's because markets price information, but they don't always value judgment. And leadership, well, leadership is judgment. It's how capital gets allocated, it's how people are motivated, and it's how strategies actually become results. At Eagle Talon, we focus on what we call leadership alpha. It's a measure of excess returns attributable to having the right leadership team in place. And for all my crypto friends in the audience, no, this can't be tokenized. Leadership alpha is based on understanding how CEOs create or destroy shareholder value. Because behind every market outcome, there's a leadership decision. And the market, time and again, underestimates how much that matters. Think about it. We can model every variable: sales price, units sold, input costs, consumer trends. But when the wrong CEO runs a company, the assumptions unravel. Conversely, when the right leader is in the right seat at the right time, the company turns into a compounder. So, how do we do it? Well, we evaluate CEOs the way others evaluate companies. We apply the same rigor, deep research, validated by multiple sources, and quantitative discipline, but through the lens of analyzing human behavior. Our team includes not just investment analysts, but investigative journalists and intelligence professionals, people who know how to separate narrative from fact. Because the truth is, most investors, they stop at the resume. We dig below the surface, the mindset, the relationships, the true capabilities that determine whether a CEO can execute. And we're not just studying companies. We're studying the humans who drive decisions and actions that make or break the companies. And that's what's fascinating. This approach is as old as human behavior itself. And the inefficiency will continue to persist. Everyone agrees leadership matters. But few have a system for measuring it. And that's where the alpha hides. Let's start with a simple observation. The market knows when a CEO changes. It's publicly available information. But what the market rarely knows is what the change truly means for the company. We've studied over 20 years of CEO changes, thousands of data points, and the pattern is clear. In the first 2 years, after a new external CEO comes into a company, the top quartile outperforms the market by more than 80 percentage points, 80. The bottom quartile underperforms the market by almost 50 percentage points. Okay? So if the S&P is up 20% over 2 years, those outperformers are up 100. They double. The bottom quartile, if the S&P is up 20, they're down 30. That's massive dispersion and a massive pool of alpha deficient. Clearly, external CEO changes create inflection points, and markets underestimate the impact. Why? Because traditional analysis is built for financial statements, SEC filings, company presentations. It's not built to quantify the effect of human leadership on value creation. The irony is, research shows that leadership explains 1/4 to 1/2 of company outcomes. Markets chase what they can measure: earnings, margins, multiples. But leadership, it's harder. It's judgment. It's pattern recognition. It's understanding whether this person's skill set and temperament actually fit what the business needs right now. So let's look at 2 real-life examples. These demonstrate how important the CEO is to value creation. So on the left graph, you'll see CSX, the railroad. What this graph represents is that big gap up on the left side. That's when the Wall Street Journal published an article that rumored that veteran railroad operator Hunter Harrison would step in as CEO. Just on the rumor, okay, no one could capture this because it happened pre-market. Just on the rumor from a credible source, the stock gapped up 25%. Of course, no one could have captured that gain, as I said, but over the next 47 days, the stock ended up 35%. That created more than $11 billion of shareholder value. On the right graph, when Brian Niccol left Taco Bell to lead a turnaround at Chipotle, the stock gapped up 16%. Within 90 days, the stock was up 67% and created $5 billion of value. In both these cases were the same companies, the same systems, the same challenges. All that changed was they had a new leader. What investors recognized, though, was that these two leaders understood exactly what their companies needed and how to deliver it. And this is what we call leadership alpha. The excess return created when the right leader is in the right seat at the right time. So why did the stocks gap up on the open? Specifically, both CEOs had previously created massive shareholder value. Harrison had built and refined his playbook while turning around 3 railroads. Niccol had driven growth and innovation at Taco Bell. In both cases, their success wasn't random. It was consistent with who they were as leaders. And I believe history doesn't repeat, it rhymes. And so do leadership patterns. So back to the CSX and Chipotle stock performance. How did they do over the next 3 years? Well, CSX tripled over less than 3 years. Chipotle was a 6-bagger. It was up 6 times. You made 6 times your money in about 3.5 years. And that's our approach at Eagle Talon. We believe every stock in our portfolio is at least a double over the next 3 years. If it's not in our portfolio. These are multi-year transformations, where the market finally catches up with the leadership signals. And that's the key insight. When the right leader is in the right seat at the right time, value compounds. And the leadership signal, it always shows up. Investors just rarely recognize it early enough. So what makes CEO change, So what makes CEO change powerful to investors is how consistently the universe renews itself. Every transition resets a company's trajectory, for better or worse. Overlay that on business cycles and market cycles, and each leadership change signals a new opportunity. So my question to you here is, what's the average tenure of a CEO? Is it less than 2 years? Is it 4 years, 7 years, or 10? So how many people think it's less than 2 years? Okay. How many people think it's 4 years? All right. 7? Okay. And 10? No one. Okay. So most of the votes came in the middle, and the answer is actually 7 years. So what that means is, every year, 15% of all CEOs are turning over. In the Russell 1000, that means every year, 150 companies change CEOs. And approximately 1/3 of these are external CEOs. They come from outside the business. Very few investors specialize in this discipline. And that's despite it being a persistent, underfollowed source of alpha. So you might be asking why. It's because it's expensive to do it right. It's complex to analyze. And most firms, they're built to analyze numbers, not people. But that, right there, is precisely why it works. Market inefficiencies, where alpha is created, is where others can't or won't go. So we're not looking to buy or sell every CEO change. We're looking for the ones that matter, the ones where leadership fit, company opportunity, and timing converge. Every year, we narrow the universe of 50 new external CEO transitions to a handful of high-conviction opportunities where the leadership signal is clearest. Our process is comprised of 3 layers. Most investors focus primarily on that first layer, the one labeled number 1. That's the company. Management quality is just a checklist at the end of their process. As you're seeing, we take a different approach. We begin with the leaders. In addition to our best-in-class fundamental research on companies, we have 2 additional layers focused on the people who are making the decisions. In the second layer, our investigative journalists conduct interviews with people who've worked with the CEOs, typically from college until current. So you get a 360-degree view, time-weighted, of how they've evolved as leaders and as managers. And as you know, there's a difference between leaders and managers. Ultimately, what we want to know is, does the CEO's expertise and track record match the company's needs at this stage of its life cycle? And whether the CEO accomplished what they say they did. In the third layer, our former intelligence and law enforcement officers conduct a deep background check to see if they walk the talk. Now, this isn't just career and education. We're searching for evidence of a criminal record. We're searching for a history of civil litigation, because that provides insight into their personality and their fit with company culture. We believe that the way people manage their personal lives is the way that they'll manage their businesses. So we also look at, what cars do they drive? What homes do they own? How much personal leverage do they employ? What's their family tree look like? Who are their parents, their siblings, their children? We look for evidence of substance abuse, marital strife, illnesses in the family. And illnesses in the family is a great example of how all of these data points fit together. Because if we find an illness, we're not sure what it means. But what we can do is insert that question with our investigative journalists, and by the end of the process, we have a pretty good sense of whether it's going to distract them or make them more empathetic leaders. We then combine all of this qualitative data and we quantify it. We reflect it in our financial models, and we assess our playbook for value creation and probability of success. Then we go long the value creators, and we short or avoid the value destroyers. So everything we've discussed so far, the interviews, the investigative work, the leadership mapping, it all comes to life here. Because at the end of the day, leadership analysis only creates value when it connects to the fundamentals. Traditional investing starts with fundamentals, margins, returns, capital efficiency. We start one level higher with the decision makers who are responsible for producing those fundamentals. We synthesize what we've learned about a CEO's skills, mindset, and decision patterns, and overlay these onto our financial models. For example, if we see a pattern of strong execution through cycles, well, we can model through volatility with higher confidence. In other words, leadership tells us which numbers to trust and where to push our model. It's how we turn a qualitative edge into a quantitative edge. When you synthesize leadership and fundamentals, you stop investing in what companies are, and you start investing in what they're capable of becoming. So this is really the core of how we evaluate leadership fit. We build conviction layer by layer, because every data point tells part of the story. So let's go through a case study. At the time Margot Georgiadis was appointed CEO, Mattel had lost nearly half of its value in just over 3 years. About $7 billion of market cap erased under prior leadership. The board, it was under pressure, as you would expect, to find a change agent, a new CEO who could transform the company, restore confidence, and rebuild trust. Let's walk through Mattel the way we analyzed it real time. Margot's marching orders were simple: become more like Hasbro. Hasbro had created blockbuster movies and video games based on its brands. It had created a flywheel. As a result, Hasbro's stock price had doubled. Meanwhile, over the same period of 3 years, Mattel's stock price was down 18%. Margot's resume, it checked all the boxes. Harvard, McKinsey partner and head of both consumer and restructuring. Google, president of the Americas. Strategy, analytics, digital, all ideal skill sets to drive a digital transformation. If you were on the board and you had this resume in front of you, would you have hired her? Most people would have. Makes sense. Then we looked at compensation. Her pay package, $37 million, 3 times the prior CEO's pay. But when you look deeper, over 90% was tied to long-term performance and equity awards. Do you think that's enough motivation for her to move quickly and execute? Probably. Next, the board. Up to this point, most of what I've shown you is publicly available. Filings, footnotes, the kind of information any analyst could piece together with enough effort. But to understand the deeper relationships, we had to go further. We mapped board overlaps using multiple sources, a process that's complex, time-consuming, and not something most investors take on. Then we layered in insights from our interviews. What we found was telling. Several directors already knew Margot from prior companies and shared board service. During her time at McKinsey, she'd actually worked closely with Mattel's current COO for more than a year on a digital transformation mandate. What we're doing here is connecting the dots. We're looking at how relationships and prior work histories might shape decision-making dynamics in the boardroom. It's another layer of context to help evaluate fit. When you look at Mattel's roadmap on the left versus Margot's resume on the right, side by side, it all makes sense. Mattel's roadmap called for renewed vision, digital transformation, restructuring, a cultural reset, and Margot brought exactly that skill set from McKinsey, Google, and Discover. So here I'd like you to take a couple of minutes and discuss with the person next to you, based on what we've seen so far, would you have hired her? Then we'll do a quick vote.
Ding, 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 ding. Ding, 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 ding.
All right, You guys come up with your answer? All right, how many people would have hired her? All right, how many people would not have hired her? All right, looks like a little bit more would have hired her. But that's exactly the point. And a lot of you didn't raise your hands. You'll fix that for the next interactive slide, right? The information so far could lead reasonable people to different conclusions. So to understand whether her skills actually match the company's culture, the stage of its life cycle, and the mission, let's move to our next layer of analysis, the background check. Ooh. All right, our investigative review surfaces filings, what filings can't show, which are indicators of behavioral patterns. What we found was that her compensation package equates to 1/3 of her pre-tax lifetime earnings. That's significant, right? But compensation was not as closely linked to value creation as it appears on the surface. Does that change your confidence in whether she'll execute? All right, everyone has to raise their hand here if this happens. So quick show of hands. How many people here have ever worked with an executive coach? All right, fair number. I do too, by the way. And was that something, you don't have to answer this one, was that something you chose or something the organization required? In Margot's case, she was required to work with both an executive coach and an image coach as a condition for continued advancement at her company. That detail stood out, not because coaching is uncommon, but because of why it was mandated. It hinted at underlying challenges around collaboration and communication with peers. Would any of that change your confidence in her as a transformational leader? During her tenure at Discover, litigation records revealed her involvement in a marketing program that regulators later determined to be deceptive in its presentation to consumers. It raised questions about oversight and judgment, about how decisions were made and by whom. When you're evaluating leadership, how do you factor in patterns like this? Do they speak to integrity, to governance, to culture? Now, we even came across a detail that's maybe not what you'd expect in a CEO background dossier, especially for a relatively high-profile CEO. Someone in her family owns a motorcycle. We couldn't confirm whether she's the rider, though she does have at least one minor traffic violation on record, a speeding ticket. Now, that may sound trivial, but details like this help us understand personality, risk tolerance, and behavior under pressure. All right, another interactive slide, so let's see more hands up. Now that you've seen what we've uncovered through the background check, a deeper, non-public layer, let's revisit your earlier decision. By a show of hands, based on everything you know now, would you have made the hire? How many people would have made the hire? Okay, how many people would not have made the hire? All right, that's a pretty big, so we probably went from to about 1/10 of the room will make a hire and probably half would not. The goal here isn't to determine whether you're right or wrong. It's to see how additional information can sharpen or change conviction. And this is why we go deeper. Because every new layer either reinforces the thesis or it challenges it. We've examined the public data and reviewed the background check findings. Now we're going to move to layer 3 of the analysis, the interviews. This is where we test everything we've learned so far against first-hand accounts. We hear directly from people who actually worked with her. So from these conversations, a few clear themes emerged. She was a first-time CEO. The background check had already raised questions around integrity and character, and several non-board sources offered contrasting views. Let's look at two representative quotes from former colleagues. She knew how her bread was buttered and who would butter it. And she played politics well with people above her. Second quote, she would essentially purposely make some of these people look bad in front of their boss. These quotations help explain why what looked strong on paper didn't translate in practice. Here's what we began to hear consistently from people who had worked closely with Margot. She was great at managing up, but she was horrible at managing across and down. Collaboration and communication was often strained. A former colleague described her this way. You need to surround her with smart people, as I was saying, visionary people, or these other ones who can do it, but also those who can actually operate with her, and would be okay with the mercurial sense or just her way of operating. I think that could be a bit of an Achilles heel that I don't think can fix. Again, this is the kind of insight you never find in filings or press releases. Clearly, she was not someone who could mobilize teams behind a new mission. A new vision. Another consistency that emerged from the interviews, Mattel needed a transformative leader, someone who could reimagine brands, inspire creativity, and rebuild culture. But Margot's background was rooted in operations, analytics, and efficiency. Exceptional skills, but not what Mattel needed. One former colleague described it this way. In fairness, they brought her back to Google for a reason. They were like, you're here for results, and culture, fit, or whatever, be damned. That's what she was here for. Her strengths were optimized for scaling and structure, not for creative reinvention. The final theme that surfaced from our interviews was environment. Google. It's a well-oiled machine. It's a virtual monopoly with almost unlimited resources. But that environment can also mask weaknesses that only appear when resources are constrained. A board member and longtime friend said, I think the things to watch for is this. If I were to look at blind spots, dealing with capital structure, dealing with finance is not something she's got deep experience in. She's never had to worry about those things. It's a pattern we see often. Success in one environment doesn't always translate cleanly into another, especially when it requires a completely different type of problem solving. All right, so I want to see hands again. Now that we've seen all three layers, the public data, the background check, and the interviews, by a show of hands, how many of you would buy the stock? Anyone? Wow. Can we hold it to the end? How many would short the stock? Okay, and how many would avoid it? All right, a lot of people avoiding the stock. But we have some short sellers here. I like it. Here's where all the pieces fit together. The board, this is our investment thesis, by the way. The board had a poor track record hiring the CEO, the right CEO. The prior two leaders had already destroyed $6.7 billion of shareholder value. Rather than changing how they made decisions, the board repeated the same process. Margot, well, she was a first CEO with the wrong expertise and the wrong match. Not creative, could only manage up. And if you think about what her skill set was, it's managing up, not down or across. Mattel is filled with C players, not the A players that you find at Harvard Business School and McKinsey and Google. So now she actually has to lead a team of C players. She can't do it. Digital transformation. Both the board and the CEO lack the experience. And what was really telling at the beginning was when we looked at the board composition, Mattel had how many board members who were focused on media or tech? It was 1. How many did Hasbro have? 6. 6 board members at Hasbro. No wonder they could create a flywheel. The company was in structural decline, and pressure was applied on a time horizon basis because they had a seasonal sales cycle, and she had a limited amount of time to change the business. So what was the outcome? 15 months later, the market caught up to our analysis. Mattel's stock fell 43%. She erased $6 billion of shareholder value in 15 months. The leadership signal, it had been there all along. We made a 31% return, created 40% alpha by shorting the stock. Annualized, our return was 43%, our alpha was 55%. The return, it was cycle resilient, and it was uncorrelated to markets. Hasbro was only down 5%. The Russell 1000 equal weight was up 13, and the consumer discretionary index was up 25. So that's the essence of what we look for. The right leader in the right seat at the right time. And when those 3 elements line up, value compounds. When they don't, it erodes. So whether you lead a public company or a private one, large or small, or even a family or a team, the principle is the same. And it starts with a mirror. Ask yourself, am I living my principles? Because you can't judge a leader by their resume or the narrative. You have to understand the person, their judgment, their energy, and their fit for what's truly needed right now. I'm Kareem Mauji, Chief Investment Officer of Eagle Talent Partners. We invest in companies led by the right leader, sitting in the right seat at the right time. Thank you, and I'll take questions.
Wow.
Do we have a microphone for questions?
Yeah, we do.
I'm sorry? She may know it now. No, so all of our work is done below the radar. So that's why we have this team of investigative journalists and former intelligence officers. So my view is this, okay? If you're the CEO of a public company, it doesn't matter what your competence is, whether it's finance, whether it's technology, whether it's marketing. The reality is, to become CEO, you have to be an extraordinary salesperson. And I don't actually want to talk to those people because they'll be able to convince me of whatever they want to. So we actually find all the data points in a constellation around these people, and we make our own decisions based on that.
Now, do you know who the original search firm was that did this search? Was it Korn Ferry or?
I did. I don't recall right now. I think it might have been Spencer Stewart, but I don't recall for.
Did they have a requirement for a gender hire?
I don't know that, but it's interesting with the search firms. If you look at their mandates, okay, there's always time pressure, right? They always want the board always wants the CEO yesterday, and so what ends up happening typically is they don't hire the right person for the job. They hire the right person who's available right now. The best person available right now, not the best person.
Can I ask you a question about how you do your research? Like, love the use case, but how do you account for the gender bias? Because I mean, it's statistically proven that even in like reviews or like generally speaking, when there is female versus male person at executive position, there is enormous bias towards female leadership. So how do you incorporate that in your research and in your in your analysis?
So you're asking about the choices that it's shifting more towards female leadership, or the fact that that she failed and others fail?
Yeah, it's bias toward the leadership style, towards like her past experiences, like when you run this interview, when you overall running your analysis on the person.
Okay, I think I understand your question. So what I'll say is, look, our mandate is not to make sure there's gender equality or anything like that. We're just assessing it, okay? And so one thing that has kind of shaped the business world today is that, and you see this, you'll see it with Marissa Mayer from Yahoo, for example, and there are a lot of other women like this. What has happened is that a CEO job vacates, and the search firms will go out to all these people. And what happens is, often, historically, the offer has gone to the males first, okay, because they have the most experience. They've built the most experience. They have the most skill sets. And some of them, these turnarounds are just so messy, the guys say no. And so they go down the list, and the women are like, I want the experience, right? In their view, now I've become, even if I fail, I've become CEO of a public company. It makes it easier for my next role. And so there's been a lot of research that's shown that women, I don't know how long ago this was, but it probably was in the last 5 years that the survey and the study was done, but that a disproportionate of number of roles at that point that women ended up with were these really tough restructuring situations. That's what we do. This isn't an algorithm. We do have algorithms, but this isn't an algorithm. This is real human intelligence. This is former intelligence officers gathering information. This is, ex-Wall Street Journal investigative journalists who've been in the business for 20 plus years asking the questions and pulling the threads. This is experienced investment staff actually taking the data points and connecting them to see what the real, putting the puzzle together.
I see a question over there, Kareem.
Yes.
I'll stand up so you don't have to repeat it. So I'm very curious. So first of all, thanks for a great presentation and a very novel way of looking at this. How long do you allow to do this analysis? Because from it's announced till you're going to be a stock impact,
You don't have that much time probably. And also, when you're doing these interviews, how many do you do, and what's the filtering mechanism so you don't just get a bunch of I didn't like her kind of noise, because it must be quite of a noisy thing.
Yeah. No, great questions. So you actually have more time than you think in order to figure out whether the CEO is a good fit. What we found is that most of the returns in a 2-year period come in the last 18 to 21 months. Okay, so you have 3 to 6 months generally before the stock moves a lot to figure out if they're the right person. In terms of the interviews, I don't mind sharing it with you because it's very difficult to replicate. All right, we start with between 500 and 1,000 people, and we figure out which of those people worked with the CEO at that time in the right areas, in the right office, on the right floors, right, in the right divisions that might have interacted with them, and then we will select a subset of those. And then we'll go out to them, and we have a good mix of sources that we speak to. Yeah.
Let's give Kareem a round of applause. Thank you very much, Kareem. Very nicely done. I just want to remind everybody that we are live streaming this event. It is on YouTube and it is on LinkedIn. And if you search for Naples Symposium on either one of those, you will be able to find it, and you can repost it and tell all your friends to watch the afternoon sessions. It is now time for lunch. So there's a lunch buffet out in the hallway. You can see people are already coming in with their food. Enjoy lunch. You'll bring it back in here, eat at the tables. The staff here will clean up the tables for us, and we'll get started in about 1 hour from now with the afternoon sessions. Enjoy your lunch.
Yeah, I might get something. We'll see. I thought I was going to. No. Yeah, I'll do it. I got it.
Cue the music.
Just shut up, John.
Was kind of curly. Went to her house and bust her out. I had to leave real early. These girls are really sleazy. All they just say is please me, or spend some time and rock around. I said it's not that easy. It's tricky to rock around, to rock around. That's right, on time is tricky. How is it, Dave? It's tricky, tricky, tricky. It's tricky to rock around, That's right, on time is tricky. Tricky, tricky, tricky. In New York, the people talking try to make us rhyme. They really hawk, but we just walk because we have no time. And in the city, it's a pity cause we just can't hide. Tinted windows don't mean nothing, they know who's inside. It's tricky to rock around, that's right, on time is tricky. When I wake up, people take up mostly all of my time. I'm not singing, phone keep ringing, cause I make up a rhyme. I'm not bragging, people nagging, cause they think I'm a star. Always tearing what I'm wearing, I think they're going too far. A girl named Carol follows Daryl every gig we play. Then dissed her and dismissed her, now she's shocking Jay. I ain't lying, girls be crying, cause I'm on TV. They even bother my poor father, cause he's down with me. It's tricky to rock around, that's right, on time is tricky. How is that? Tricky, 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 tricky. It's tricky to rock around, that's right, on time is tricky. We don't use drugs, but you assume on your own. They offer coke and lots of dope, but we just leave it alone. It's like that, y'all, but we don't quit. You keep on rock shot, cause this is it.
Everyone should be able to save and protect their wealth across. Institutions are joining us in our vision. Every economy is built on patient, long-term capital.
In real assets, such as commodities and gold. 3-Edge Conservative is designed as a substitute or a complement to a traditional bond portfolio. 3-Edge Total Return can serve as a complement to a more traditional 60-40 stock and bond portfolio. The strategy aims to smooth market volatility and reduce risk while also seeking to be additive to investment returns. If you would like to find out more about how our investment solutions can smooth the ride for your clients, we'd welcome an opportunity to connect.
Everyone should be able to save and protect their wealth across generations. We built this company so billions of people around the world can take control of their financial lives. We've reimagined savings and protection from the ground up with digital money and modern technology. We're the world's first Bitcoin life insurer. For the first time, people can save, protect, and pass on their wealth entirely in Bitcoin. 4 years ago, we started working directly with individuals. Today, as the Bitcoin economy has grown, some of the world's largest and most conservative institutions are joining us in our vision. Every economy is built on patient, long-term capital. Bitcoin is the foundation of the next phase of global finance. We're not just building a Bitcoin company. Meanwhile is the backbone of how everyone will save in the future.
Hello, I'm Fritz Foltz, the Chief Investment Strategist here at 3-Edge Asset Management. As a trusted financial advisor, now more than ever, protecting your clients' hard-earned wealth is critical to success. Our 3-Edge investment solutions can play an important role as part of an advisor's value proposition. By adding 3-Edge solutions as a complement to a client's overall investable assets, an advisor may be able to reduce the volatility and manage potential portfolio drawdowns while also seeking to be additive to returns. How do we do this? 3-Edge is a tactical, multi-asset investment management firm. Being tactical simply means that we have the flexibility to make changes to our portfolios when our market outlook changes, based upon our proprietary research model. And as a multi-asset ETF strategist, we have access to a wide array of asset classes, including stocks, bonds, and real assets, such as commodities and gold. 3-Edge Conservative is designed as a substitute or a complement to a traditional bond portfolio. 3-Edge Total Return can serve as a complement to a more traditional 60-40 stock and bond portfolio. The strategy aims to smooth market volatility and reduce risk while also seeking to be additive to investment returns. If you would like to find out more about how our investment solutions can smooth the ride for your clients, we'd welcome an opportunity to connect.
So at Eagle Talon, what we do is we focus on leadership, meaning we're focused on the CEOs and the rest of the team that runs the companies. So if you think about a company, it has all sorts of assets, but decisions have to be made as to how those assets are used. And it all comes down to how those people manage, how those people lead, and the decisions they make. And so we do deep work on the CEO, the management team, and the board to figure out how they are as leaders, how they manage the company in order to create or destroy shareholder value. We do this in a very differentiated way. We have a team of analysts who obviously look at the company to understand what the company needs at this stage in its life cycle. And then we have a team of, on the second layer, investigative journalists. They're typically ex-Wall Street Journal, and they do interviews with people who have worked with the CEO, typically from college until current. So it gives us a 360-degree view, time-weighted, so we can understand how these people have evolved as leaders and as managers. And there is a difference between the two. And the ultimate outcome of this is to really come to a conclusion as to whether they are the right match, they have the right expertise, what their track record is, and whether, again, they can turn around this company. The third layer is another check on management, and we have a team of former intelligence officers and former law enforcement officers, and they do a deep background check. And this is really deep. It's not just career and education. It's going into, is there evidence of a criminal record? It's looking at civil litigation because that indicates what type of personality this person actually has. We're looking at the cars they drive. We're looking at the homes they own, the personal leverage they employ, again, because we think that the way they manage their personal lives will bleed into the way that they manage their businesses. And so we combine all of this data to come up with our conclusion as to whether they'll create or destroy shareholder value. And then we're going long the value creators and we're going short the value destroyers. And what we do is very simple. We basically understand the leadership of the company and how they're making their decisions. And then we analyze the company and we're finding the right match. So it's complex and to execute, but it's very simple to understand how we do it.
In a world of refined living and complex risk, protection must rise above the ordinary, demanding an understanding of what matters most. Volt is led by industry experts redefining insurance, crafting tailored coverage for the things you value most. From exceptional homes and luxury vehicles to yachts and private aircraft, each policy is purposefully designed, grounded in insight, and delivered with care. Discover protection without compromise at Volt Insurance.
You've said that we're in the final stages of this currency's life cycle, and we're facing a debt-death spiral. But yet, when I look around, we see the stock market is at a near all-time high. What would you say the vast majority of people, even savvy investors, are completely missing right now?
I think we are in the middle of what would be considered a debt-death spiral. The dollar is a currency. It's not a money. Okay, well, what's the difference? A money is a store of value, and a currency is a medium of exchange. So a lot of people look at Bitcoin as being a competitor to the dollar. A lot of people who misunderstand Bitcoin, investors in the marketplace, think Bitcoin is trying to compete with the dollar. I think they're complementary. The dollar is global, it's worldwide, it's the reserve asset. Why in the world would you try to compete with a medium of exchange technology that has already captured pretty much 100% of the global economy? It doesn't really make that much sense. But what we know about the dollar is that it's not a store of value. It's a really bad store of value because it can be issued ad infinitum. And ever since 2020, we've seen that peak up dramatically, which is waking people up to the fact that a money is a store of value. And to be a store of value, you can't increase the supply at ridiculous rates. Now, we have a natural money in gold, which through its cost of production, limited its supply expansion. But with Bitcoin, we have not just a natural money, we have an engineered money. We have something that through computer code introduces the concept of absolute digital scarcity. For the first time in human history, we have a monetary asset that supply cannot be expanded. That's a really hard pill to swallow. And it's really hard to understand that the only way to get the increase of supply in Bitcoin, the only way to get the circulating Bitcoin to increase is to get the price to go up. So because of that, I believe that that was a strategic design, and therefore I call it engineered money. So I do believe that if the currency system wasn't abused and the amount of dollars wasn't expanded at the rapid rate that we see today, at least $2 trillion in our ongoing deficit, then theoretically, the dollar could maintain its value. And if credit was not extended ad infinitum and the supply of dollars declined, perhaps the dollar could even gain value, theoretically. So it has the ability to actually function that way. But because we have put ourselves in this position, because we have allowed ourselves to conform to the idea that something is too big to fail, we now find ourselves in this situation. See, with Bitcoin, when we went through all of the rehypothecation scheme of version 1 of Bitcoin lending with Genesis and FTX and BlockFi and Celsius, and we had this big rehypothecation period, when it collapsed, we couldn't print the Bitcoin. So we failed. But that failure is a critical part of the business cycle. And in the traditional markets, we don't get that part of the business cycle. We print over it because it's too big to fail. And when you don't allow companies to fail, what you're doing is you're creating zombie companies. And I think we've gone so far now that these zombie companies have infected the economy, and we have a zombie economy. And that's why we're able to print trillions of dollars, spend it into the economy, and still see debt to GDP go up, still see our financial position become less and less healthy. So we have a really big problem right now with the dollar. And if we don't figure out a way to strengthen our financial position, then yeah, we are at the end of our life cycle. We will get to a point where people will not even want to use the dollar as a medium of exchange, because if they don't spend it immediately, they're going to be able to buy less and less stuff over time. And I consider this a matter of national economic security. If you look at El Salvador, they have some of the best performing traditional bonds in the world. Number one, because Bukele is cleaning up the country. But number two, because they put Bitcoin on their balance sheet. And what that does is it strengthens their financial position. So if something were to go wrong, they could tap into that 24/7, 365 liquid marketplace that Bitcoin is to fix that problem. So what the United States needs to do if they want to strengthen the dollar is to take some of the money that they're printing and buy Bitcoin. Because when you put Bitcoin on the balance sheet, if you take that dollar, you invest it into the economy, you're not getting back principal plus interest. If you invest it into bringing out natural resources, it's going to take significant investment and time to actually see any revenues from that. I'm pretty sure nobody wants to sell Alaska to Russia. So we're limited on how we can monetize the asset side of our balance sheet, and we're limited on what assets we can invest in to amplify the performance of the asset side of our balance sheet. And then here comes this magic internet money, Bitcoin. But it's absolutely digitally scarce, and it's engineered money, and it was strategically designed to store value over space and time.
But a lot of people end up in a dilemma. Jack Mahler's called it the hodler's dilemma. So I bought Bitcoin. I did what I was supposed to do. I held like I was supposed to. I have a lot of wealth supposedly on paper, but my life hasn't gotten any improvement. Michael Saylor says you never sell your Bitcoin. So how does a Bitcoiner solve that problem?
Life doesn't change until you can leverage that wealth, till you can unlock that purchasing power. And that's exactly what we do at People's Reserve. We're designing Bitcoin-powered finance products that enable the responsible saver of Bitcoin to unlock the purchasing power of their Bitcoin without giving up ownership. And the whole idea behind People's Reserve really started with my own failure, my own mistake. And that was in 2019, I bought my first home, a small single-family home, for 100 Bitcoin. And yes, I knew it was a bear market, but my wife was pregnant, and relative to my overall Bitcoin savings, if I didn't do it, she would have killed me. So I had to buy that house, and today I look at the price of Bitcoin and I could have 12 million additional dollars on my balance sheet. Instead, I have a house that I'd be lucky to get $500,000 for. So it makes sense when people understand where we are in the adoption curve, right? We talk about that S curve at adoption. We are at the bottom of the S curve. Yeah. And then we have a liquidity crisis, right? And then we have COVID and price falls from 10 to 5 and I'm getting margin calls and I'm posting a little bit of extra margin. I don't know how much lower it can go. 50% in such a short time is a lot, right? Bitcoin's volatile. It'll bounce back up. Well, no, overnight it went below $3,800, liquidated, 400 Bitcoin gone. So again, another experience I had where it's just a horrible experience to see Bitcoin go from 10,000 to below 38, lose a portion of your Bitcoin that you had leveraged and borrowed against. And then a couple months later, it's right back where it was, right back at the $10,000 point. But it gave me the idea of, for our products at People's Reserve, specifically our Bitcoin powered mortgage product, that there is the chance to eliminate liquidation risk. In that same COVID-like scenario, if you came to People's Reserve to get a Bitcoin powered mortgage, what we do is we cross collateralize the real estate with the Bitcoin. And by doing that, we can eliminate liquidation risk. So as the price of Bitcoin goes down, every 10% it goes down, your interest rate goes up 50 basis points or half of 1%. So during the COVID example, you go from 10,000 down to 5,000. That's 5 deviations or 50%. That's 2.5%. So for a couple of months, you would have paid an interest rate that was 2.5% higher than your starting rate. But as Bitcoin recovered and rebounded, for every 10% price gain, you get those points back. So by the time, 2 months later, you're right back at your original terms. Plus, you had no liquidation risk. You bought your new home and you can actually sleep in your new home because you don't have to worry about getting liquidated. This is something that we're really excited to offer to the marketplace and to innovate with. We're going to offer the best rates in the industry. I believe Bitcoin powered finance will redefine the risk-free rate and redefine the risk-free borrower. It is no longer going to be the entity who has the power of the printer who is known as the risk-free borrower. Just because you can print more of that collateral and pay it doesn't mean it's a pristine collateral. So because of that, we are using multiple strategies, including a fund LP strategy, to where we are not partnered with people who practice fractional reserves. So what that means for us is that we do not have to marry our business model to the traditional yield curve. And what you see in traditional Bitcoin lending is that lender will be partnered with a banking partner. They will have a line of credit at a certain rate. And therefore, in order for the business to be profitable, they will have to arbitrage the difference between their borrow rate and their customer's borrow rate.
Right.
So if you're, prime right now is 7.5. If you're at prime plus 50 basis points because you have a good relationship and you're at 8%. And the advent of Bitcoin as pristine collateral, I would posit, is negative risk. So when you post Bitcoin as collateral, because it's engineered money that was strategically designed to accumulate value over time, when you post it as collateral, you become deleveraged, right? So when you buy your car and you drive it off the lot, it loses value. Right. And the more you drive it, the more wear and tear it loses value. This is why it needs to be subsidized, much like a home, because there's a lot of wear and tear.
So I have a $50,000 loan on the car, but the car is only worth $40,000 now.
Yeah, and it becomes more and more risky of a loan over time. The opposite is true with Bitcoin, and that's only with Bitcoin. Over Bitcoin, because of its engineered design, it auto deleverages the borrower. It is the advent of negative risk. You cannot plug negative risk into TradFi risk models. It's like going into a Power Excel sheet and putting in the wrong information. All the error codes come up. Like you mess something up. Something in some cell is wrong. I can't calculate this. That's what happens when you try to plug negative risk into TradFi credit models. Bitcoin is the advent of negative risk. And therefore, we're going to be able to beat the interest rate in any marketplace because of the lack of risk. Risk is the factor that has been mitigated through subsidies through the government. But in the free market, how do you mitigate risk? By the quality of the collateral. I think there's going to be two competing systems as we transition into the future of finance. And one system will be the stated and anchored system where the rate is controlled by central banks, and the other system will be more of a free market system. I like to call it the internet economy, as you said, because it's the only economy in the world that is debt-free. It's the only economy in the world that can't be outcompeted by any one economy because it's an aggregate economy of everybody. And it's the only economy in the world that can't be controlled by any one person or power. And because of that, this is where decentralized finance has really flourished. And this is why a lot of capital, you see BlackRock rushing into stablecoins, you see stablecoin legislation going through. A lot of that is getting access to the opportunity in DeFi where we actually have a free market rate. When you look at funding rates within the internet economy, where people are using leverage just to make bets on Bitcoin, the annualized rate on that could be anywhere between, depending on how hot or cold the market is, between 10 and upwards of 30, even 40%. You can't get that kind of rate of return in anything that you would see in TradFi without significant risk. They have that famous saying, you don't change Bitcoin, Bitcoin changes you. Governments don't change Bitcoin, Bitcoin changes governments. And business doesn't change Bitcoin, Bitcoin changes business. And that's what I'm most excited about moving into the future, because those changes are based on an extraction mechanism versus a value delivery mechanism. And I think the biggest change you see in Bitcoiners who have been responsible savers of it and benefactors of increased purchasing power is that once you remove the financial stress that the current system exudes on almost everybody, except the very 1% who have a large disproportionate amount of the wealth, who cares? I got my own problems. I got to worry about me first before I can serve you, right? If you're on the airplane, put your own mask on first before you put your kid's mask on, because if you don't put your mask on, you might not be able to breathe and put their mask on and you both die. And fiat forces you to look at yourself first before you look to others. But when you embrace Bitcoin and you have financial freedom, you're able to look at others first and you're able to serve others. And that's really the most powerful thing about Bitcoin. And I think we're going to see it not only in personal and business and government, but it could change the whole dynamic of human relationship. That's how important money is at a foundational level.
Anybody can permissionlessly participate in this network. I can underline this system and grow this network. And by mining, you plug into this system and you're just permissionlessly part of this open, decentralized protocol. And to me, I was like, this is amazing. This is so cool. It's why I've been so fascinated by it. And the mission of what Bitcoin is for humanity, I think, is extremely important. It's this beautiful freedom tool. No one's going to force you to do it. No one's going to stop you from doing it. But you are rewarded if you're an honest actor. If you use your energy to secure this network, you're going to be rewarded proportionally for providing that service. So as the network becomes more valuable, there's this price signal to the market. Hey, we need more miners. Because this network's growing in value, we need more security. But to me, that symbiosis was brilliantly designed by Satoshi, and I think Satoshi Nakamoto will win a Nobel Peace Prize and a Nobel Economics Prize. I think he deserves to win one as this anonymous individual who created this brilliant innovation for humanity.
Financial systems still run on technology built in the 1970s. That's 50 years ago. Systems like ACH and SWIFT, NASDAQ and the New York Stock Exchange, global commerce is running on last century's technology. Over the next decade, all these financial rails will move to the blockchain. But enterprises cannot connect their existing systems to this new technology. Introducing Web3 Enabler, the missing link for enterprise adoption. We are the Salesforce ISV partner bringing the blockchain to Salesforce. We're on the cusp of $1 billion opportunity as the market materializes. Salesforce powers over 150,000 corporate clients, including 91% of the Fortune 500. And 90% of them use one or more AppExchange products to run their business.
I spent 15 years in the Salesforce ecosystem, including 9 at Salesforce. Why I invested in Web3 Enabler. 1, they're the only approved Web3 payments app to pass the AppExchange security review. 2, their Salesforce interfaces are simple, clean, and intuitive. 3, they have a strong team with a clear vision of integrating Web 2 and Web 3. And 4, the market for SaaS Web 3 integration is massive.
Join us in bringing blockchain to the world's largest enterprise ecosystem. With 150,000 customers and an expected annual spend of $8,000, we are targeting a $1.2 billion ARR opportunity. But we're starting with the US and European financial services company. In time, the entire universe of Web3 innovations can be brought to Salesforce for enterprise adoption.
Our focus is on making systems as easy to use as possible. We make blockchain totally usable by big corporation customer service people and accounts payable people who don't understand crypto wallets and shouldn't have to.
Our digital asset wallet lets wealth managers advise their clients knowing about their crypto. It's designed for the largest advisory firms like Merrill Lynch and JP Morgan, and boutique players alike.
It seems like everyone I know has cryptocurrencies in their portfolio today. It's getting way too important to overlook in the full financial picture. That's why I'm very confident in what they're building at Web3 Enabler.
B2B international payments are projected to reach $150 trillion by the end of this decade. As these transactions move to the blockchain, there's a $1 trillion opportunity. With Web3 Enabler, businesses can collect and receive stablecoin payments and manage their wallet entirely in Salesforce or off-ramp instantly to their bank. Our technology is backed by industry leaders like Circle, Stripe Crypto, Bridge, Alchemy, and Crypto's API.
Corporate treasury is so much faster and cheaper with the blockchain, but the user experience of existing wallets is awful. Blockchain payments makes this so easy.
In July 2025, the United States passed the Genius Act, the first federal law regulating stablecoins. The law mandates 100% reserve backing, monthly public disclosures, and consumer protections, giving enterprises the confidence to adopt stablecoins at scale. With regulatory clarity here, Web3 Enabler delivers compliant, enterprise-ready blockchain solutions right inside Salesforce. And the market is clearly ready. When Circle IPO'd this summer, it peaked at nearly a $70 billion valuation its first month. Having built bespoke implementations for XRP Ledger, Circle's USDC grant program, and Project Catalyst for Cardano, Web3 Enabler is trusted by the blockchain leaders to build their Salesforce solutions. And our commercial offerings are already live in the marketplace. So join us in bringing blockchain to the largest enterprises.
Real estate people and Bitcoin people have a lot in common. You know, scarcity, it's a physical asset. You can't take it from me. You can't break it up. You can't grab it. You can't steal it. We have 42 buildings, 15,000 renters. If there's some litigation against me, you're not busting up the partnerships. You're not taking my property away from me. And so as much as there's a lot of middlemen in the real estate, but to me, the two universes between real estate and crypto, when they start communicating to one another, they have this natural symbiotic relationship. And the asset, the pieces, the benefits of real estate, of the cash flow and the leverage that crypto might not have, I think are very compelling to people in the crypto space.
So how do you see that overlap between real estate and I'm curious in what you're doing in the space? Actually, before going into real estate, first, your story into crypto, your stance on crypto early on and how that shifted, especially after the approval of the ETFs and the landscape now that we're moving away from Gensler and the Biden administration.
Yeah, well, look, I'm a coward investor. I don't invest in stocks. I've always been a coward. I get rid of cash. I don't like cash either, by the way. So I get rid of cash. Our companies produce quite a bit of cash, and I want to get rid of the cash. I want to be at zero all the time. And so what can I put my money into? I know if I put my money into a real asset, not office, but apartment buildings like we purchase, they're going to provide me with cash flow. If you're a coward, you like cash flow. And I'm a coward. I admit I'm a coward. Any cowards in the room? I like to put something in, get something out. And so we just accomplished $500 million worth of transactions in Florida that was going to be up here, by the way. We paid cash. We pay cash for these beautiful buildings that we buy from institutions. Those buildings produce a 5 or 6% cash flow, institutional quality, great locations. And we have no debt on it. We'll wait for the debt market to go to 4%, and then we'll put debt on it. But I'll wait until, or 3% or 2%. I believe that we see 3% interest rates again in the next 24 months. I think Trump's going to put his foot on the Fed's throat and say, yeah, I'm not going to fire you. You're not going to quit. You're just going to go to 2. And now, how much real estate can I buy? Well, the cash flow could buy Bitcoin. Now, the way everybody's been trying to do it and nobody's done anything is they're trying to put property on the blockchain. And I've had 5 different groups. I've been on Spaces and saying, hey, you show me how to do that. I'll donate $100 million worth of real estate. You show me how to put it on the blockchain. You show me how to break it up into tiny little pieces and get the SEC to sign off on it, and I'll do the project tomorrow. And everybody's like, I can't quite get there. So the other way to do it is a simple way, which is buy the real estate with cash and have the distributions or the cash flow from the real estate buy the Bitcoin for this massive audience of people out there that do not want to go out and buy Bitcoin because they don't know where to store it, they don't know how to buy it, they actually don't even know what it is. But if the real estate bought their Bitcoin, rather than getting a distribution in fiat, they would get a distribution in maybe a fund that holds Bitcoin.
So you kind of flipped it around. Can you go back?
And so that like Ryan Secco, Ryan's, what are you, 40 years old? Okay, you look good for 40. So he's a pilot, he's a real estate guy. He hadn't bought any Bitcoin yet. But if I told him I'm gonna invest in a deal, okay, and the distributions aren't gonna come in cash, they're gonna come in, every month we're just gonna simply buy your BTC for you and hold it. So now I get 2 explosions. I get 3. I get the cash flow. It buys my Bitcoin. It feels like it's free. I get the tax write-off and the depreciation from the real estate. And then I have the appreciation possibility of long-term appreciation of both the real estate and the explosion of the BTC.
So have you launched that? Did you have a date on when you launched it?
We're in progress.
Okay. But you mentioned something interesting earlier, because I did see you on a space just a few days ago. And you mentioned a bit of a concern on moving real estate onto the blockchain. You asked, like, show me how to do it. When you had those discussions, what were
Nobody can show me how to do it. Anybody in this room can show me how to do it. I'm ready to go today.
It's a genuine question, by the way, if anyone wants to take up the challenge and actually...
Everybody's like, oh, they did a house in Aspen. Why didn't they do a second house? Oh, they did a hotel in so-and-so. Why didn't they do a second hotel? If you can't scale it, you can't do it. If you didn't do it twice, the first time had some problems. Like, I don't need research. I don't need a white paper on it. Why hasn't there been 50 or 100 or 200 of these projects? Because they're not doable. They're not approvable by the SEC.
So it's a regulatory concern mainly?
100. And, you know, I don't want to go to jail. I'm not interested.
And that applies outside the US as well? You've seen the same. Have you looked into Europe or other countries?
No, I haven't. But
the US.
You're right here. I don't even need to look any further than this, right? Like, this is great.
And do you think that could change under a Trump administration, or you'll just wait to see?
I don't think that. I mean, I don't think he can change that. I think he's got his hands full with other projects. So,
just back to the RWAs, because obviously it's a space we're invested in. So your concerns are something I'm selfishly interested to better understand. So, like, all the different use cases of kind of moving real world assets onto the blockchain. You know, accessibility, you know, the efficiency of it. You know, leveraging smart contracts, fractionalizing real estate. It all makes sense. But you're saying that the most important hurdle is getting regulatory approval. How long do you think it would take for that to happen?
I don't want to wait for it. So, I mean, nobody has shown me, oh, we're going to get rid of the middleman. You're not getting rid of the title. You're not getting rid of escrow. You're not getting rid of insurance. You're not going to get rid of the mortgage. Like, I don't know what you're getting rid of. What are you getting rid of? It's like, and I have to wait to take this isn't a single family home. This is not one house with one address. This is 300 or 400 or 500 units. I have different leases going through it constantly, okay? I'm gonna break it up into 10,000 pieces, and it's gonna sit on the blockchain. What are you gonna do? You're gonna transfer, what happened? Like, there's no mathematical formula for how you trade that back and forth, and then why would you want to? Like, I just don't understand. You know, do I get rid of my title? Yeah, I guess I get rid of my title insurance. I get rid of or there's some middlemen that are going to go away. I mean, maybe, but that's not why I'm buying real estate. I'm buying real estate because I think it's going to be more valuable in the future. It's going to provide me with cash flow. And then the big benefit, he's going to come back with bonus depreciation. I'd bet dinner that bonus depreciation goes back to 100%. So a $100 million building should bring $40 or $50 million worth of tax write-offs year one. How do I put that on the blockchain? Who do I give it to? And by the way, once I give it to you, when you trade it on the blockchain, where did that depreciation go?
Another thing, though, you've done, kind of step in the direction, getting your beak a bit wetter, is putting your both. I think you put 2 homes on a blockchain-based.
Yeah.
How did that go?
Yeah, I have a house in Malibu, and I have one in Golden Beach, Florida, and we put them both on the what is it, Proppy?
Oh, you put it on Proppy? Yeah. We're invested in them. So.
Yeah, and but so where's the fucking offer?
When did you lose?
Where's the offer, bro? Like, who's going to trade Bitcoin for a piece of real estate? Nobody.
That's a good point.
Nobody's ever going to do that. You're not going to do it. Let's say Bitcoin goes to $1 million. You're not going to trade your $1 million of Bitcoin. You're going to go borrow against your $1 million. You're going to borrow $250,000 against your Bitcoin. You're going to take the $250 and buy your house. You're not going to trade your Bitcoin. Why would you? For toilets and termites, and tenants, you're not going to do it. You're going to keep them both. What's better than just the Bitcoin? You know, the Bitcoin and the real estate.
Have you gotten any offers yet?
No, we didn't get any offers. But I mean, I got them priced into the, up into the stratosphere. So, basically they're priced where I just crack somebody.
Well, that might play a role waiting.
But it's great promotion. Like anything to do with the Bitcoin space is going to be great promotion. It's just tremendous amounts of promotion. Now it's sexy, it's exciting, it's in the news.
Your stance, we talked a bit backstage. You've invested in Bitcoin. It's been a long time. The journey started a lot longer than many people would guess. Maybe tell us more about your journey into crypto and where do you stand now in the industry?
So I got a phone call. There was a group doing an event in Las Vegas, and they wanted to pay me in Bitcoin. And I think it went to Jared first. Jared's like, no, here's our fee, and this is what it is. And then it went to somebody else in the company. No, we don't do that. And then I heard about it, and I'm like, hey, I'll take it. I'll take goats. I'll take whatever. I'm not working that day anyway. I'll go up there and do the deal. Give it to me, right? So they gave me, I forget what, 100 pieces. And I didn't know what it was. I had no clue what it was. I still have them today. So it was about $500. I think it was trading for $500, and my fee back then was $50,000, and travel, and they took care of the travel, and I kept the Bitcoin, and it was the best speaking gig I ever did. It was the best. I was the best, by the way. I was freaking brilliant that day, and so I still have that today. And again, and then I added some more along the way. Added some at 30,000, and. Some other things that we've done along the way, but I'm never selling any of that stuff. Like, I'm not looking for a place to get off. It's another thing I'm trying to collect that hopefully I can pass on to somebody else.
You believe in the store of value argument, you're bullish on it.
Well, I really believe that there is no other store of value, So, I don't have to convince myself of the store value. We were talking about this morning on the way over here. I'm just convinced that cash is not a store of value. That cash is not king. That was a lie. Saving money is a ridiculous proposition. No one should do it. It's a loser's bet. There's no such way. It is an oxymoron. You cannot save money. It's impossible. There's no such thing as it. So what do I go into? I don't want gold. I have no interest in gold, never had any interest in gold. I'm 66 years old. No one has ever offered me gold or silver for a transaction, ever. So I don't understand the whole gold thing. I'm gonna keep it. I gotta dig it up out of the ground. I gotta put it back in the ground. I gotta pay somebody to hold it, somebody to insure it. If I wanna sell it, I have to get it transported, authenticated, like that's gonna take a week. So I never understood the gold thing, the silver thing. Wall Street, never understood it. Okay, if I buy a stock, I never buy enough. And if I buy enough, it goes down. So I'm trading paper for another piece of paper. I'm trading a piece of fiat, U.S. currency that has God on the back of it, so it's bullshit. Because this isn't God we trust, and I don't think God had anything to do with the U.S. dollar. And then I take the U.S. dollar and I convert it to another piece of paper that Apple distributed. Or whoever, whatever company. Most of these companies only last 7 years. When I was growing up, they'd last 70 years. Now they're 7 years. These AI companies, you're gonna have 99 of them bust out for the one that makes it. And so how do I convert cash that they're gonna continue to print? What handful of things can I convert a piece of fiat to that has a chance of being more valuable in the future?
It's probably one of the best arguments to present, to clip and present to anyone in TradFi that's still not convinced.
You believe in Bitcoin, not just as an asset, as a pillar of the future global economy. But there's a problem. Accessing your Bitcoin today means selling it or taking on high interest debt. What if you didn't have to choose? Introducing Meanwhile, the first life insurance company built for the Bitcoin economy. We've reimagined whole life insurance optimized for a deflationary world. Instead of tying your policy to dollars that lose value over time, we anchor it to Bitcoin, a scarce, appreciating asset. Grow your wealth tax-advantaged, secure your legacy, and unlock liquidity without ever selling your Bitcoin. Bitcoin Whole Life. Protect your future. Maximize your present. Brought to you by Meanwhile.
Here's a reminder from Steve Cucchiaro, Chief Executive and Chief Investment Officer at 3Edge Asset Management, that what melts up also must melt down.
Anytime in the past when we've had market melt-ups, again, they're hard to predict when they fall. It's like an avalanche. You don't know which snowflake is going to cause the avalanche. But when they fall, it tends to be sharper than what most people might believe because you got all the leverage built into the market, all the margin buying, and then people try to run out the door the same way. So we're concerned, and we really want to watch for that.
He's favoring international stocks and gold as he weathers the melt-up and prepares for the meltdown. And it's all discussed in the big interview on the October 23rd edition of Money Life. Check it out.
I have the honor tonight of giving the remarks for our honoree, Scott Carmilani. We have been very, very fortunate to have great honorees historically here at Answer the Call, and Scott's a special person. I have known Scott Carmilani for over 20 years. We grew up in the business together, he being the great underwriter at AIG, then to AWAC, and now Fairfax, and I being the broker trying to convince him to do things that he never wanted to do. And over that time period, we built a friendship, we built a trust, and today we share a relationship that I cherish very much. Scott grew up in New Jersey. He was a high school wrestler star. He also wrestled in college. And I can tell you every issue he's tackled since then, he's been wrestling. He's a great father. His daughter Brianna is with him today. He believes in his people, he believes in his friends, and he believes in all of us in this room today. When I went to him and asked him to be the honoree, he didn't hesitate. He said, "How can I help?" Scott remembers 9/11. He was working downtown that fateful day. He knows what the first responders did for everybody in this room, for our families and for our friends. And he's taken a long view about New York City and what first responders have done to make this city great. He totally gets it. The greatest thing about Scott is he's had great success in business, he's had great success personally, but he's never changed. He's the most down-to-earth person I've ever met. He's straightforward, he's direct, you always know where you stand. So when he said yes, I know he wasn't going to retrade me. I know he was going to dedicate himself to it, and I knew we were going to have a very successful dinner. It is very, very difficult, as I mentioned earlier, to find people to take the time, make the effort, and support an event like this. We all have busy lives. And then yesterday happens, and it all becomes clear to all of us in this room why we're here. We live in a city that we're allowed to move around freely. We live in a city where all different types of groups of people are allowed to succeed. We live in a city where race, color, religion do not matter. When I travel to different parts of the world and I come back here, I'm not worried about the United States succeeding because New York City leads the way. Scott gets that. So he's happy to carry the mantle this evening. He's happy to financially support our cause, and he's happy to emotionally support it. I'm honored to invite him up to the stage to accept the award as this year's honoree for the New York Police and Fire Widows and Children's Benefit Fund. Scott, will you please come up?
Thank you. Thank you very much. Thank you, Phil, for those kind words. For those of you who don't know Phil, or even for those who do, giving him a microphone in a room in an audience like this, you never really know what you're going to get or what you're in for, so I appreciate those kind words. Being an honoree in an event like this is more like realizing that you're the highest bidder in a silent auction. Yay, we win. Really? Wait a minute, what am I in for? What did I get here? I wasn't sure if I'd get a stack of PBA cards or a police escort to the airport. None of that, but hey, that's not what I signed up for. What we're really here for is to honor and support our police, fire men and women. It's not often where you follow a rabbi or a priest, but I can tell you in life I've never followed either of them or both at the same time. I want to thank all of our first responders. Thank them all and for all they do for us. You are the backbone of this great city. You fuel yet control the energy here so that this city thrives. All while keeping the sanity amongst the chaos. And as stated earlier, we've had no shortage of chaos in recent events. All along the way, and of course, you're there to protect us, one and all. I especially want to thank all of you who are here tonight, the attendees. I know that the police and fire departments appreciate you coming out. Just look at that show of strength and force that was presented to us as we made the walk over from the Deutsche Bank lobby. As we entered the building tonight, what a show of force. Very, very impressive. As Phil said, this event and this organization provides such a meaningful benefit to so many families and children. It's more than 600 plus, I've learned. That is truly an amazing thing. And the fact that there are only 2 employees on staff, I've never been involved or supported any charity where virtually 100% of all the funds raised go right to the beneficiaries and fill the cause. Yeah, that is worth applauding. That board does all that work for free, and the 2 women who run it do an amazing job. And therefore, that's why I'm honored, but more humbled to be a part of this event and this cause. And I couldn't feel better about personally contributing to its success. Thanks to all of you for coming out tonight, for donating your time tonight, and for donating some of your money. Phil will try to get the rest of that out of you later, I'm sure. Thank you very much. Enjoy.
Joining me now to talk more about the second half of the year and the early days of this third quarter is Bob Iacchino. He's a chief market strategist for Path Trading Partners. Bob, great to see you bright and early this morning down there in Naples, Florida. How does this market look to you at these levels?
Well, I think it's taking a what we call a well-deserved pause. I was a little surprised to see us get to new all-time highs this quickly. I think the issue with it is that we still don't really know what the trade deals are going to look like. We obviously have this July 9th deadline, which I guess now is pushed to August 1st in reality. And that seems like President Trump is trying to give himself a little bit more leeway to make the deals that he knows the market wants to see. And because of that, the market's a little bit on edge this morning, but I really don't call it any sort of panic by any stretch of the imagination.
I would say probably most notably then the next event could be this earnings season, Bob, and we are expecting companies to report results just within the next few days or so and in the weeks to come. What do you anticipate from corporate America?
I think we're going to see quite a few warnings in terms of earnings going forward. I think what we're seeing right now is an economy that is clearly slowing, not necessarily pointing to a recession at this stage, but it is clearly slowing. We're seeing that across several metrics. And then one of the metrics that bothers me more than anything is the manufacturing PMI figures, whether you look at the national level or you look at the sort of individual ones. Philly Fed was better this past week, but it was still in the negative 12 and change is what I saw, even though it was an improvement from the prior figure. And those have a really good history, these manufacturing PMIs. Although we're not a manufacturing economy, they really correlate to overall stock market performance. So if you don't start to see recoveries in those indices, it's going to be difficult to say that the new all-time highs are going to last that long.
What is the best way then, Bob, with the sum of these parts, to position yourself in this market?
Well, shockingly, I actually like consumer discretionary, which kind of goes against what I just said. But when we're looking at the ETF, for example, the XLY is a good example. It's breaking out to the upside. And this might have something to do with wages still improving at the margins. Not as strong as it was a couple of months ago, but still improving overall. I think that has something to do with the level of deportations we've seen. When you looked at the jobs number, we saw a decrease in the foreign-born labor force by over 500,000, and that's allowing employers, or I should say forcing employers, to give raises to the existing employees. The last thing you want to do is lose employees and watch that quits rate improve because of the availability of jobs at whatever level you're talking about. So I like consumer discretionary. One of the ones we like the most is Roku, especially with the new release of the Bear season and them renewing it for a 5th season. That's going to help Roku over the medium term. They have a good pricing structure versus their competitor. And again, they're showing the ability at least to produce independent or individualized content like The Bear that you haven't seen a lot of success other than maybe Squid Games with Netflix.
So we saw what was a historic V-shaped recovery in the second quarter. Trade obviously is still a topic on the forefront of many traders' minds, including down here on Wall Street. Bob, do you think we could see more volatility ahead? How are you preparing for that?
Well, I look at the tariff situation a little bit differently than other people. I don't see it as inflationary. I see it as a tax, and taxes are deflationary. And what I mean by that is I think tariffs are likely to slow the economy more than consistently raise prices. If you get a one-off in price increase, what you get is a slowdown in consumption. You don't get an inflationary cycle or an inflationary trend. So I see this as more of an economic slowdown and a factor taking place globally, not just here in the U.S. So I do think we'll see more volatility in the stock market and in the trade deals. You know, you look at the situation, for example, with Tesla and with Elon Musk and President Trump. Two of the most volatile personalities on the planet are feuding, and that's causing volatility in Tesla stock. When you talk about President Trump versus some of the world leaders he's trying to negotiate, you have a similar dynamic. So I think you could see stresses based around trade. And if they don't get that settled or get, even if it's just a blanket level of tariffs across the board, and then individualized deals with individual nations, however high they are, let the market know what that is, and the market will figure it out.
Treasury Secretary Scott Bessent saying earlier that several trade announcements are ahead. Bob, when we look at the second half, so the next 6 months or so between now and year end, do you think the S&P 500 is higher by the end of the year?
I actually do think it's higher. So Scott Bessent is one of my favorite people in the administration. He's probably one of my favorite Treasury secretaries ever to this point. And I think with his pedigree and his depth of knowledge, he's the kind of person who could work around this volatility and straighten out some issues that we have. He's already said or implied that he's not going to extend the duration of the Treasury issuance. And that's a good thing for stocks. What we have seen is when we get higher long-term yields, which we will get if he starts issuing more 10-year and 30-year, that's bad for the stock market. So overall, I think for this year, the S&P is going to be higher at the end of the year than it is now.
All right, giving us some optimism this Monday morning. Bob Iacchino, always appreciate you joining. Bob's the Chief Market Strategist for Path Trading Partners down there in Naples, Florida.
Over the last 12 months, Strategy has been extremely successful at building the capital base and expanding the balance sheet, using primarily equity in the IPOs from the preferred markets. And over that 12 months, you saw MSTR underperform Bitcoin in a fairly significant manner. Do you guys view the strategic priorities moving forward as focusing more on increasing amplification and less on expanding the balance sheet? And how has this past year informed your go-forward strategy and how you might prioritize the prefs over the common equity moving forward? Thank you.
Yeah, that's an open-ended question. So I'll start and then Fong or Andrew may have something to add. Yeah, clearly, with equity, I would say if you're going to own Bitcoin, you need a 4-year or longer time horizon. If you're going to own amplified Bitcoin, a company that aims to be more volatile than Bitcoin, you can't have a lower time horizon. So you
And so what separates us from the rest of the crowd of, trillions of assets in life insurance at Bermuda and globally? The fact that we do everything the same except our currency is Bitcoin. Literally, we are a holding company, operating company structure where our operating company does not need a bank account. Everything's in Bitcoin. That means that you pay your premiums in Bitcoin, your death benefits paid out in Bitcoin, and you can get policy loans, which are in Bitcoin as well, but at a new stepped-up basis. But in order to explain how all that works, I kind of have to just create a couple of analogies to the traditional life insurance world. So with traditional life insurance, you go to a life insurance carrier and you ask them for coverage. You say, I'd like a $10 million policy on my life, and they'll say, great. They'll crunch some numbers based on your age, health, and other factors, and they'll dictate to you an amount of premium that you have to pay in dollars, either each month or each year. And in whole life, those dollars go into a mutual fund. And that mutual fund has a guaranteed growth rate of 4%, conservative. And every year, it's up 4%. And over time, it might be up 20, 30% in decades. And because it's whole life, you can actually borrow out of it. And because everything's tax-free, you don't have to pay capital gains, or income tax, or any type of tax when you borrow out of that whole life policy. And you never have to repay the loan. So if you could borrow up to 90% usually of the surrender value, and when you get a loan, let's say you borrow $1 million out of this $10 million policy, your new death benefit is now $9 million. It nets down from the policy loan, and meaning you never have to pay back that $1 million loan. Keep it for as long as you want. You pay 0 taxes on that loan, and that's basically how the life insurance policy loan element works. And finally, when there's a claim, when there's a death, that $9 million left over gets passed down, paid out to your beneficiaries, completely tax-free. All of that in Bitcoin is similar, but there's one stark difference. The fact that Bitcoin is a scarce asset. It is a finite supplied asset, whereas dollars are an unlimited supply asset. And so to do everything in Bitcoin, you can't come to a life insurance carrier on the Bitcoin standard like Meanwhile and ask us for coverage. You can't say, I'd like a $10 million policy or I'd like a 100 Bitcoin policy, because that would mean that we have to tell you how much premium that you have to pay in Bitcoin. But we don't know how much Bitcoin anyone has. It's a scarce asset. So we can't tell you have to pay 10 or 20 or 100 Bitcoin premium. We don't know how much you have. So instead, you come to Meanwhile with an amount of Bitcoin that you know you have that you want to use as premium. And you say, what do I get with this? Well, we will then crunch numbers based on your age, health, sex, smoking status, and give you a death benefit ratio that you will get relative to the amount of premium that you want to pay. There's never a dollarization, meaning we're never going to sell your Bitcoin. There's no realization event. We're not going to index to the dollar. And so because we're on the Bitcoin standard, there are no taxable events when you work with us. And that's one of the benefits of Bitcoin life insurance, the fact that life insurance is tax-free. When you do life insurance in Bitcoin, then your Bitcoin becomes tax-free. And so as an example, let's say a 35-year-old healthy non-smoking male came to us and asked for a policy. He comes to us saying, I have 10 Bitcoin, what do I get with it? Well, we'll crunch numbers and you get 17.9, call it 18 Bitcoin in death benefit. It's an 8 extra Bitcoin that you get, or an 80% return on your Bitcoin over the course of your life. How does 10 become 18, though? How does 10 premium become 18? Because in order to qualify as life insurance, we have to grow the portfolio. Every life insurance company is growing their balance sheet. They're investing their assets. They're buying municipal debt at 6% coupons. They're able to generate yield and pass the yield on to the policyholder to grow their portfolio. And obviously, they'll keep some of the yield for themselves. That margin is how life insurance companies make money. And so where does the yield come from? That is one of the most important questions here. How does 10 Bitcoin become 18? Well, we have a very conservative nature. We're regulated by a strict regulator that wants us to take little to no risk. And so we've come up with a solution to get Bitcoin-denominated yield with barely any risk at all. And the way we do that is we are able to work with low-cost basis Bitcoiners in the form of a fully collateralized one-year repo loan, allow them to swap low-cost basis Bitcoin with high-cost basis Bitcoin. And I'll explain what all that means, and I'll break it down for you. So let's say there's a Bitcoin miner. Bitcoin miners are earning income in Bitcoin. They're mining Bitcoin every day. And what happens is they get vintage Bitcoin. Every day they mine Bitcoin. The cost basis is established on the day that that Bitcoin lands in their wallet. But miners, like most other companies, they have CapEx and OpEx needs. They need to sell or get dollars somehow. And to go from Bitcoin to dollars, you either borrow against your machines or you sell Bitcoin. Now, which Bitcoin are they going to sell? Well, they have to pay capital gains tax like the rest of us. So does it make sense to sell Bitcoin you mined 5 years ago at $1,000 a coin, or Bitcoin you mined 5 days ago at $100,000 a coin? Obviously, you would sell Bitcoin you mined recently, closer to today's market price. So what do you do with all the old Bitcoin? As a miner, there's really not much you can do, because if you create any type of taxable event, you're going to incur this large corporate tax rate that is really going to eat away at all of your income and your revenue. And so when you have low-cost basis Bitcoin as a miner, you kind of wish you did something with it back then, years ago. And so now it's just sitting there, and essentially they're Bitcoin treasury companies holding Bitcoin on their balance sheet with very little ability to do anything with it for fear of causing a taxable event. Well, until Meanwhile came around, being a life insurance carrier in the crypto space, we have very long-dated liabilities, meaning that we have young people, 20-year-olds with policies who are probably not going to pass away for 70 years. And so our liabilities are long-dated, and therefore we're duration-seeking. We're willing to take long-term loans with the right types of counterparties that meet our conservative and risk-averse nature. And the loan that we created that solves a problem for miners and solves a yield problem for us is in the form of a one-year repo or a repurchase agreement, where a miner can lend us low-cost basis Bitcoin, call it 100 Bitcoin. We'll lend them back 100 Bitcoin. That assumes today's cost basis. They can immediately sell that for CapEx needs. And at the end of the year, they can repay the loan or roll to the next year. Mechanically, they're going to lend us 100 Bitcoin. We charge them 3.5% yield up front, so we're going to actually send them 96.5 back. That 96.5 takes today's cost basis, which they can sell, use for CapEx needs. Now, what happens if our counterparty disappears, goes bankrupt, loses the Bitcoin? From our perspective, it doesn't really matter, because we have all 100 Bitcoin of theirs, and they only have 96.5 of ours, hence it's a fully collateralized loan. And like I said, at the end of the year, they can either repay the 96.5 Bitcoin, get their original low-cost basis back, or they can keep rolling to the next year, pay us another 3.5%, another 3.5 Bitcoin. So what do we get out of that? Well, we get 3.5% yield in Bitcoin-denominated terms, not dollars, in a fully collateralized loan, meaning that we have no counterparty or credit risk. Because if our counterparty disappears, we still have all 100 Bitcoin of theirs. They only have 96.5 of ours. We give 2% of that yield to all of our policyholders. That's how 10 becomes 18. That's how premiums turn into death benefit over time. We amortize out the yield to age 100 on any of our policyholders. So for that 35-year-old, that's 65 years of 2% compound annual growth rate, 2%. 10, 10.2, 10.4, so on and so forth, all the way to 18, if you do the math. And yeah, the 1.5% spread, that's how we as a life insurance company make money. So the policy loans are where it gets actually very interesting. And probably this is what most people speak to our company and sign up for. If you think about when you borrow money out of a life insurance policy, how does it work and what's the point? Well, you don't have to pay cap gains. You get cash. You don't have to repay the loan. It's pretty great. Now, if you do it all in Bitcoin, the way it works is you're going to get new Bitcoin at a stepped-up cost basis. So let's say, for example, in the future, let's say 5 years down the road, Bitcoin goes to $1 million a coin. And you have a policy with us, and you want some cash. Well, you really have two options. Option one to get cash is sell Bitcoin at $1 million. But you're going to pay a very large capital gains tax relative to your cost basis. Option two is generate a policy loan. The way that works is you come to Meanwhile, you log into your account, and you'll see that you can borrow up to 90% of your surrender value. In essence, that's a 90% LTV loan. You'll see it's now 5 years down the future. This 35-year-old was paying 10 Bitcoin a year, so that's 5 Bitcoin in premium. He could probably borrow up to 3 Bitcoin or so, 3.5 Bitcoin. And let's say he wants to borrow 3 Bitcoin out of his policy. Because remember, you're borrowing Bitcoin, you're not borrowing dollars. Everything we do is in Bitcoin. So he's going to borrow 3 Bitcoin. How does that work? He gives us a wallet address. We're going to screen the wallet address with Chainalysis, make sure we're not sending Bitcoin to North Korea or Iran. And we're going to send him 3 Bitcoin. Now he has 3 Bitcoin. Great. But he wants cash. What's he going to do with 3 Bitcoin? Well, he has to sell it. So he takes it to his favorite exchange, Coinbase, and says, hey, I got 3 Bitcoin to sell. And Coinbase says, great. But where did this Bitcoin come from? And what's the cost basis for tax purposes? Well, he'll have a loan document that says this comes from my regulated life insurance policy at Meanwhile. And it says right here the cost basis on these Bitcoin was established on the day I originated the loan. In this case, $1 million a coin. So now while you might have paid your premiums with Bitcoin you bought many years ago at Coinbase at $100 or $1,000 or $50,000, and paying premium is simply just transferring Bitcoin from wherever it is in custody into our vault at Coinbase or Anchorage or custodians that we work with, you're not using that Bitcoin, you're not getting that Bitcoin in the form of a loan. You get new different Bitcoin from the life insurance company at a new stepped up cost basis, in this case $1 million a coin. So Coinbase says, oh, great, $1 million a coin. You do a limit order sale of $1 million, so your cost basis equals your sale price. There's no delta, no tax liability, no Form 1099. You withdraw the 3 Bitcoin at $1 million each, $3 million cash in your bank account. You never need to repay the loan in life insurance. It carries a 3% interest rate on the loan. You can let that accrue over the course of your life. There's no risk of lapse. That's how we designed this policy. And your new death benefit nets down against the size of the loan. So you had an 18 death benefit, you borrowed 3, now your death benefit is 15. You're paying 3% interest on the 3 Bitcoin. So ultimately your death benefit will be 14 point something. And most importantly, arguably most importantly, you're never at risk of a margin call. Because what happens if Bitcoin then crashes to $200,000, has an 80% drawdown after it hits $1 million? Well, from our perspective, nothing. Because everything we do is in Bitcoin, not dollars. So 1 Bitcoin equals 1 Bitcoin. From your perspective, you're never going to have to worry about the dollar price. You still have this $3 million. You have the 3 Bitcoin that you sold. Your death benefit just netted against it. You never have to repay the loan, but you have the option to repay the loan, which actually could be lucrative and interesting because now Bitcoin's at $200,000 a coin. You might have 3 Bitcoin times 200,000, $600,000 left over from that 3 million cash, and you decide to go buy 3 Bitcoin and repay the loan. Why would you do that? Well, you're going to stop paying 3% interest rate, and you're going to free up more loan capacity for yourself in the future to be able to borrow more out of your policy. If you think on the next bull run, Bitcoin's going to go to $4 million. And so that's an option. You can call it an arbitrage if you want. But we don't anticipate most people will do that. We think most people borrow and let it accrue. You're going to pay us 3%. Remember, the rest of your portfolio is growing at 2%. So it's a net delta of 1%. And that's how the policy loans work on the Bitcoin standard. And finally, it is life insurance. So there's a death benefit component. When you do pass, your Bitcoin will be going to your family or your beneficiaries, whoever they are. And it's really important, actually. Some people overlook this. Some people don't realize that, they don't think they need life insurance. But the truth is that think about where you have your Bitcoin right now. And if you, God forbid, get hit by a bus crossing the street, do your loved ones know how to access your Bitcoin? Do they know where it is, the ledger, what your passwords, private keys are, how to access it, the Google authenticators, the YubiKeys, all the different authentication methods that you've created to access this digital bearer instrument that has no recourse? A lot of people have not figured that out. And as such, their Bitcoin could die with them. And that's a tragedy given the price of Bitcoin and where we all think Bitcoin's going to go into the future. And so in life insurance, you never have to worry about your Bitcoin dying with you. You don't have to worry that your family won't be taken care of. It's in life insurance. All your family needs to know, your beneficiaries need to know, is not how to use a wallet. They might not be crypto savvy at all. They just need to know you had a life insurance policy at this company, file a claim. We'll work with the beneficiaries and give them either Bitcoin or dollars if they want dollars. And we anticipate that some people will want dollars because there might be some beneficiaries who are, a spouse, the wife and her husband had this policy, and her husband was all this crypto savvy guy who got this policy and had a million different wallets, et cetera, and he's gone. And she has no idea how to use Bitcoin. And so she files a claim and she says, I don't want Bitcoin, I want dollars. Well, the Bitcoin on death receives a new cost basis, and you can either receive the Bitcoin or we'll help you liquidate it at Coinbase's trading desk or anywhere and help you wire the money into your bank account because Bitcoin receives a new cost basis, it's all tax-free. And so whatever you want, we're going to work with you to help you get the assets that are owed to you in the policy. And it becomes a very seamless concept when you think about how it all works. You get yield, 2% a year in Bitcoin-denominated yield, which, by the way, think about if the price of Bitcoin goes up by a lot, 2% a year in Bitcoin-denominated terms gets amplified by orders of magnitude. You get these tax-free policy loans, the ability to sell Bitcoin without paying taxes, and lastly, you get the fact that it's, your family is taken care of, your beneficiaries are taken care of. So it's a pretty powerful concept when you think about it all together. And I don't know if we have time, but I'm happy to take a couple of questions. If not, you can find me. I'll be floating around. Yep. Sorry, it's a 10-pay. So it's a limited pay policy. You pay your premiums over 10 years in equal annual installments. For that 35-year-old who's paying 10 Bitcoin in premium, that's 1 Bitcoin a year in premium for 10 years, regardless of the price of Bitcoin, because 1 Bitcoin equals 1 Bitcoin. And while the price might go up over that decade that you're paying premiums, your death benefit's also going up. So if you got to stop thinking in dollars, you got to really think in Bitcoin for the value of what this product is. And you either pay your premiums over 10 years, or you can pay it all up front, and we'll escrow it at Coinbase for you and pay it into your vault, into your account for you, because it's a non-MEC. It's an insurance term that just means there's no taxable event. And it has to maintain that way. You can't pre-fund everything and then borrow max on day one. The IRS figured that loophole out in the 70s and plugged it, and that's what is a MEC, or a non-modified endowment contract. So that's how it works. Anyone else? 1 Bitcoin equals 1 Bitcoin. Your premiums costs go down, but so does your death benefit. Bitcoin goes up. Your premium costs in dollars go up, but so does your death benefit. No, your death benefit is guaranteed and fixed from day one in Bitcoin-denominated terms. Yep.
Based on what I'm hearing, you're going to be effectively sponging low-cost basis Bitcoin over time. How does that impact the business model?
To us, Bitcoin is fungible. 1 Bitcoin equals 1 Bitcoin. So whether we have low-cost basis Bitcoin or high-cost basis Bitcoin on our balance sheet doesn't matter, because we don't care what the dollar price of Bitcoin is or was or will be at any point in the future. While others do, we don't, and that's our edge, being a regulated insurance company, to be able to take any cost basis Bitcoin, give you back Bitcoin that you might want because it is a different vintage. And from our perspective and our regulators' perspective, and everything is pari passu, it's equal. 1 Bitcoin equals 1 Bitcoin. I keep saying that a lot, but this is like this think in Bitcoin Michael Saylor concept that you really have to adopt. Last one. So if low-cost basis Bitcoin disappears and there's no more low-cost basis Bitcoin at miners or wherever to get the yield from? Well, I think what we've seen happen and what will continue to happen is today's price will become low-cost basis in the future. If the price of Bitcoin goes to $1 million one day, then $100,000 Bitcoin is low-cost basis Bitcoin then. And so low-cost basis Bitcoin will always technically be around. The corporate tax rate is about 21.5%. So if you do the math, you can calculate what price Bitcoin has to be relative to today's price for it to be considered non-economic to sell it, where you'd rather swap it. And so if we all think that Bitcoin is going to go up over time, then it becomes a moving target, and there continues to be a trove of low-cost basis Bitcoin. We think there's at least 50,000 low-cost basis Bitcoin currently held by miners alone around the world, and that number is going to go up if the price of Bitcoin keeps going up. All right, last one.
So would you leverage Virgin Coin the same way you would leverage low-cost basis Bitcoin?
To us, whether it's a newly mined Bitcoin or an old Bitcoin doesn't matter.
So low-cost or Virgin doesn't matter?
From our perspective, it does not matter, yeah. All right, that's all the time I have. Thank you, everyone. Come up, me after.
Thank you, Jason. Well done. Thank you.
Yeah. Yeah. Yep. Yeah. Thank you. I'll be right back. Yeah, I'll be right back.
Oh, come on. Sorry, guys. There it is. Oh, hold on. One of my favorite moments from yesteryear. You'd like to see the day. And that's interesting. All right. Okay, here we are. We're live. Are you feeling warmer yet? All right. We started a little campfire out in the corridor there. We're hoping the heat will transfer in and the AC has been diminished. All right, macro views, future trends, really a fascinating topic. We could just spend the entire weekend just dancing around on this one. But instead, our good friend Bobby, of course, is going to get up here and lead this dance. Bobby Iacchino, of course, he's the co-host of the Future's Edge podcast and author of The Unfiltered Investor. Let me click that slide so we can see your beautiful smile. Look at that.
Look at that.
Look at that. Oh, my gosh. Everybody give him a nice little, little golf clap.
I buttoned it up a little more than usual.
Oh, that is pretty fancy. That is pretty fancy. All right. Oh, don't sit down just yet, Bobby. Let's see. It says 32 years of experience in commodities and futures. That's an awful long track record right there.
I'm older than I look.
Quite successful.
I'm way older than I look.
That's right. Actually, I'll let you pick up one of those microphones.
Yeah, sure.
And pop them on. All right, well, without further ado, of course, Bobby's going to introduce our panel and bring up the team here. In fact, while I say it, Mike, Stephen, Craig, please come on up and join us. We've got a fascinating conversation to let fly, and I will pass off my microphone to you, Craig. There's one for you. Sounds good. Well, wherever's comfortable, Steve. Big couch. You good? Here, hold on. Oh, almost right. He was about to sit on it. Hello. Nice to see you.
Well, first of all, I want to thank the guys for holding this kind of an event. And I'm honored that we get to talk to you guys. My name is Bobby Iacchino. I know Bobby. I'm an adult man, and I call myself Bobby. That's a little strange to start with. But I'm also an adult Italian man. So that means this is Mikey, Craigie, and Stevie to me. So I'm just going to go ahead and pass it on. We've got Mike, Craig, and Steve on the stage. They're all going to tell you a little bit more about themselves. But before that, this is a macro conversation. This is Bitcoin inclusive, but not Bitcoin focused. We want to help you guys understand as best we can what's going on in the entire environment, economically, investment-wise. So Mike, tell people what you do, who you are.
Senior Commodity Strategist with Bloomberg Intelligence, and delighted to be here. And John, thanks for having us, or me in particular.
And I'm Craig Shapiro. I'm the macro strategist at a firm called the Bear Traps Report. I'm also the macro strategist at Ninja Trader Live.
Steve Cucchiaro. I'm CEO and Chief Investment Officer of 3Edge Asset Management here in Naples. And also we have offices in Boston and in LA, and we serve family offices across the country.
So he's definitely Stevie to me. You guys heard that last time? All right, we're moving on. So let me start with you, Steve, if I could. The first question I want to ask all three of you is, what do you think the most pressing economic issue is right now? The worst economic scenario and the best you could see.
So I'll start with the two extremes. Right now we have a stock market that's been ripping for years. You can say the rally started back in the ashes of the great financial crisis of 2008, and it's really soared. And it's still rising, and recently we've been making all-time records. We're in a market melt-up. It's very exciting. A lot of people made a lot of money. And the question is, will this continue or not? Every time there's a dip, the people who buy the dip come in, and we get new gains. And because the stock market's been doing so well, that's actually driving economic growth and spending, especially among the more wealthy who own the stocks. So if something were to happen to the stock market, that could have effects way beyond just stock investors. That could really affect the economy, and not just the U.S. economy, but the global economy. So that's on the upside. On the downside, we have a market that where there's a lot of debate. Some people think, well, maybe this market is overvalued. And a lot of people are on both sides of that. But I'll give you a couple of facts. Over a long period of time, the stock market will grow at the same rate. The price per share of, say, the S&P 500 will grow at the same rate as the earnings per share, or the sales per share over time. But every once in a while, as Warren Buffett says, the market in the short term is a voting machine based on popularity if people are exuberant or panicky about the market. But in the long term, it's a weighing machine. Things get back to value. So going back to when this rally started back in the 2009 timeframe, in March of 2009, earnings of the S&P 500 have grown 4 times. That's a tremendous amount of growth, and that's driven a lot of the excitement in the stock market. Unfortunately, the price per share has grown 10 times. And we know that that is an equation that can't persist. So that's a big red flag that you don't read a lot about, you don't hear a lot about. The price-to-sales ratio right now just hit 3.5. We've never seen a price-to-sales ratio so high in the history of the U.S. Now, does that have anything to do with what the stock market's going to do tomorrow or next week or next month? Very little. It has tremendous correlation with how the stock market is going to do over the next 8 to 10 years. So people should be a little bit more cautious and decide. The last thing I'll say is that earnings have been tremendous. Profit margins. Right now, profit margins of U.S. companies have been so strong that we have the second highest profit margin ratio in the history of the U.S. stock market. And that's been a reason why a lot of people have been saying stocks are great. Well, can anyone guess when the number one time was where we had the highest profit margins in the U.S.? Can anyone guess? Summer of 1929. And at that point, a famous, highly regarded investor and economist, Irving Fisher, said, "We have entered a new era of permanent prosperity." It was 1 week before the crash. So I guess all I'm saying is times are really great, but they're more dangerous than people would say.
So you're saying nobody should say that right now? Craig, same question. And to Steve's point, do you think, well, by the way, when we say the market, I think it's common knowledge that we mean the stock market, but we'll be specific if we don't. Same question, Craig, and do you think things are overvalued as a follow-up to that?
Yeah, what I would say is we have a bifurcated economy and we have a bifurcated stock market. So in the economy, we have a haves versus have-nots issue. Anything that's been related to this AI CapEx build-out has been incredibly robust. It's been going on for years. It looks like it's going to continue. I mean, the spending numbers are up into the trillions. We're seeing the administration support AI CapEx spending and the build-out every single day with the headlines, with the CEOs in the White House, with the revolving door, that the administration is promoting this AI CapEx story and the competition with China and how necessary it is for us to win this competition. On the flip side, we're seeing small companies, low-end consumers really struggling with affordability, really struggling with borrowing costs, and the outlooks away from AI CapEx really aren't that good. Housing has struggled, autos have struggled. The tariff story really hasn't brought back much of a manufacturing renaissance yet to America. Maybe it'll happen, but so far really everything's been CapEx focused, AI CapEx focused. So that's a bit of a concern in the economy. I think we saw that on display with these elections earlier this week. It was a little bit of a, it's a backlash against the administration's policies and some of the wins that we saw for Democrats in New York and New Jersey, in Virginia and California. More and more citizens are getting increasingly frustrated with the affordability crisis in the country. In the stock market, we're seeing the same exact thing. We're seeing these companies, these AI companies are valuations are incredibly good, incredibly high, but the spending is there and the CapEx is there and the stories are there. But away from that, low-end consumer-related companies are really struggling. Housing-related companies are really struggling. Auto companies are struggling. Transport, restaurants, consumer goods companies. So again, a bifurcated market. But because of passive investing and continued flows into 401ks, the overall indices are doing incredibly well. And so I think investors have to keep that in mind. And the question is, can the AI CapEx part of the cycle bring up the rest of the economy? Or is the sluggishness in the rest of the economy going to eventually kind of draw down this AI CapEx story? And I think right now it's on display with the labor market, right? We're seeing AI is increasingly displacing white-collar workers and the outlook for labor. And so that has me a bit more concerned that the economy is slowing away from AI CapEx, and more structurally will continue to slow as more and more jobs and more workers are displaced. So that has me a bit concerned.
So Mike, I want to ask you the same question, but I want to go back to Craig for a second, because a couple days ago, you wrote on an X post, caught my attention. You wrote, AI is not hitting jobs first. Do you guys hear that? AI is hitting capital access first. Big tech used to fund AI from free cash. Plenty of liquidity to go around. Credit stayed friendly. Everyone could borrow. That phase is done. Do you mean to say that as they enter the borrowing phase and as the economy demands higher rates, it's going to be a problem? Or am I reading that wrong?
No, that's right. I think the narrative is shifting. The original build out here was internally generated free cash flow from the likes of Meta, Amazon, Google to support this AI CapEx build out. And now what we're seeing with OpenAI looking to tap the debt markets, and Oracle has tapped the debt markets, and Meta has tapped the debt markets, and Google, investment grade credit is increasingly going to go into funding this AI CapEx build out story, which is going to starve the rest of the economy from capital. It's just going to raise the cost of capital for all other borrowers that are not in this sphere. And so whether it's residential construction, whether it's mortgages, non-residential, commercial real estate, any other CapEx that's away from AI is going to see higher borrowing costs. And so I am concerned that that narrative that is shifting from being internally generated cash to debt finance. Look, the money's there. There's plenty of debt finance to go around, but it's going to be at higher and higher rates. And then not even to mention what the government is borrowing, every year with the increased deficits. And so there's going to be a bit of a crowding out effect. I think we're going to see higher cost of capital kind of across the board.
So Mike, same original question to you. What are the biggest macroeconomic factors you're looking at, positive and negative? And then to add on to that, we haven't seen issuance increase yet. For anyone who doesn't know, we're talking about issuance. We're talking about the amount of debt that the government puts out there for sale, right? And a lot of people, including myself, predicted that the government was going to have to issue more debt to fund some of the lunatic spending that's going on. They haven't done that yet. They've sort of kept it stable. So macroeconomic factors, and then any insight you have on that.
Well, I like to piggyback on what Steve said. We'll start with 1929, so I don't want to mince words here. Roger Babson College, in 1929 said, "I'll tell you what I told you last year and the year before. This is going to end, it's going to end badly. I used the reverse of that in 2024 and at the end of 2023 because I was getting so frustrated with being bullish gold and being wrong. I said, I'll tell you what I told you last year and the year before, it's going up. Now it's gone up too much. Here's the problem, is I'll state out facts of my views as I published on the Bloomberg terminal first. I think we're in the beginning stages of the third 50% drawdown in the U.S. stock market since the beginning of the millennial. It should start with cryptocurrencies. I think cryptocurrencies have started a 1929 site cascading scenario. And just part of some of the anecdotal things I've seen here, I'll give you the facts, but I'll also tell you some of the anecdotes. One of them was last year. I started getting really sensing peak bullishness in cryptos. And the number one thing to remember is you're supposed to be selling when they're yelling. When everybody here was clapping for that Bitcoin panel, I mean, I was bullish Bitcoin at 10 grand. Yeah, I was going to 100 grand. I jumped off the horse a little bit, but that's going to be looked back upon as a problem. Even the thing about just the past one, that's just assuming that this number on a screen that tracks nothing is going to go up. And it's complete fallacy. It's not definable diminishing supply. To quote me, 6 years ago when I was bullish, it's unlimited supply. There's now 25 million cryptocurrencies. Maybe there was 1 million or so a few years ago. And yeah, there was one in 2009. Yes, but Bitcoin's different. I'd say we're beginning at the end. So first of all, and the panel recently talked about strategy. I know Michael Saylor. I've interviewed Michael Saylor in Miami. But I wouldn't say we're friends. I think he disagrees with me. But strategy's down 17% this year. Put that in context. The S&P 500's up 17% this year. Yeah, sure, it had some backup. It rallied in the past. Its 200-day moving average is tipped over. So the tip of the iceberg, first of all, the iceberg in all risk assets are cryptos. Bitcoin's on top of it, and MicroStrategy's at the peak. It's rolled over. Okay, fine. Check mark number one. Bitcoin is below its 200-day moving average. It started rolling over. It's just hovering on $100,000. The Bloomberg Galaxy Crypto Index is down about 5% this year. It trades 4 times the volatility of the S&P 500. It's highly correlated, and it's heading lower. These are signs you're supposed to look at the beginning of the end. The bell is ringing. And I hope you can look at me next year and say, McGlone, you're wrong. Gosh, I hope it's... There was a quote last year. I was telling a gentleman the same thing I said. Yes, John, you got to laugh at this because I'm just going to sell facts. I hope you boo me. Because when you clap for bullishness, please, thank you. I needed that, and I love it. But you got to do that. That's my job, is to agitate with facts. So I mentioned last year, I really started when I saw what I saw was peak signs of bullishness in cryptos. Everybody was jumping on board. Things that some of us predicted. We could not wait for ETFs to launch. We launched the Bloomberg Galaxy Crypto Index under my guidance for it to be tracked by ETFs. It hasn't been yet. So now that's in the space. And when I mentioned that to him and I was bullish gold, the quote was, I feel sorry for you. Gold is outperforming everything this year. I get a lot wrong, but when the store of value that's ancient beats everything, you gotta be worried. And if you're not worried, then start. Because I don't say these things often. Also, it's never happened on an annual basis that gold's up 50% or so and crude oil's down 20%. That disparity is about 70%. The biggest year ever was 2008. Before that, it didn't matter because we've never had a disparity. So I'm saying that we are at peak bullishness and everything. And I'll back it up to where I think things are going. So a couple years ago, I saw the alpha in cryptos. I got lucky. Bitcoin was around 5,000. The U.S. and New York Attorney General came down hard, and it didn't go down. Like, all right, crypto dollars, Bitcoin got to go up. Got lucky and caught it up to mostly to last year. And then what happened, so it kind of tilted me over to gold as alpha. When you get alpha in gold, that's a problem. Alpha this year is in gold. Anybody overweight gold in this room? Anybody? Anyone? Got to have a few of you. And you're way overweight now, because if you were last year, you're beating everything. Now, gold's super expensive. It looks to me just like Bitcoin did it on 100,000, which is where it is right now. So I look at there's only one big trade left. Deflation from inflation. That's not a view, it's a fact of history. Price of Time by Edward Chancellor is one book. Really bearish. It's happening in China. So to me, this is the next big trade. And right now, we're on the cusp of breaking down. If Bitcoin breaks 100 grand, it's holding there right now. It's supposed to hold support. When it breaks below 100,000, which is my view, as traders, we would both be buying it and test it, make it go down, and then stop yourself big in a short. It's all tilting downward now. And it's the end of the year. And we have a shutdown. What's going to end the shutdown? There's one key thing. Stock market going down. We all, I hate to say it, but remember TARP? The first time they rejected it? Stock market went down and said, oh yeah, we'll pass this. So I look at it right now, I'll make a prediction, and gosh, I hope you can tell me I'm wrong next year. I think the next, Bitcoin's at 100 grand. I think it's much likely to go to 50, then 150. And the number one thing now for all cryptos to go up, for Bitcoin goes up, is the stock market absolutely has to go up. I'm a commodity strategist. For copper to go up, the stock market has to go up. For crude oil to not to go down more, it's already down 20%. That's the most significant industrial commodity on the planet. Copper's secondary. For that to even stabilize, the stock market has to go up. We're in such a phase now, and we've reached diminishing returns. So I'll end with how the Fed started easing again, kind of because they have to. But Chairman Powell finally came out and pointed out facts of what presidents used, Federal Reserve presidents used to say is we have to take away the punch bowl when the party's getting out of hand. And the number one force for inflation on the planet, most notably in our country, is the U.S. stock market. It's the most expensive in history versus the rest of the world, versus GDP, versus gold is finally rolling over. So that's a bright way to look at. Maybe it's time to just say, hey, thanks. This has been a great problem, making a lot of money. So,
you guys ever seen the Blues Brothers movie? Anybody? I feel like we need the chicken wire around Mike for this particular talk.
So Bob, why am I not afraid to say it? Because we both came from the trading pits.
Also, you're in Naples. Nothing's going to happen here.
Well, yeah, exactly. But in the trading pits, you didn't care about, you just want to get the next big trade. That's all that mattered. Either way, didn't care about direction. And that's how I became somewhat neutral. This is, I think, the next direction.
Well, I have other questions here, but I'm going to go to Craig then, and then I'll go back to Steve. Craig, do you have any response to that at all, or do you see it as more of his particular view on just sort of the general markets rather than a negative view on the asset itself? And I am obviously talking about Bitcoin here.
It's a tough follow, but no. Look, I mean, I agree with Mike in a lot of ways. I mean, we have overvalued markets. We've had rampant liquidity. And we have this divergent, bifurcated economy where more and more people are feeling left out and are being left out. And with respect to AI continuing to be pushed so aggressively, labor prospects, job prospects for more and more people are getting worse, not better. And so I think the Fed is going to have to react to this. I think the Fed is going to be engaging in an interest rate cutting cycle. And it's probably not going to be enough. It's not going to be enough to arrest the slowdown in the labor market. That has me concerned. I think with respect to Bitcoin is the last functioning fire alarm from a liquidity perspective. And so when there's worries about liquidity, Bitcoin feels it first. The rest of crypto feels it even more. So I kind of agree with Mike from that perspective, at least in a near-term basis. I think there's more interesting structural reasons to own Bitcoin with respect to the government's money printing, and that's never going to stop. And if we have this kind of deflationary, recessionary episode, you can imagine very quickly the government's going to react to that. And print more money soon. But I think we have to go through that pain period first. And so I'm kind of in the camp of Mike here with respect to asset prices have to have a correction here in the next, let's say 3 to 6 months that brings out the money printer again. And you could expect that that's what we're going to get.
Steve, I want to give you the opportunity to speak to this if you can, but also I want to, well, go ahead. Let's speak to this for a second if you want to. Otherwise, I want to change the tone a little bit and ask you a different question.
Okay. One thing I've noticed is that, in general, people who are very positive about Bitcoin sometimes have a little bias against gold, and people who are very positive about gold sometimes have a little bias against Bitcoin. But that shouldn't be the case. There's room for both, and I've always been a big believer that everybody should have some part of their portfolio in an asset that's not based on a fiat currency, that's not someone's liability, that cannot just be printed at the whim of a central bank, and that qualifies for both. You've heard a lot about Bitcoin. Some people don't realize with gold, if you take all the gold in the world, and most of it is already above ground, you take all the gold bars and all the gold coins, and you put them all together in one place, they would fit basically one Olympic-sized pool. So the supply of gold is a lot more limited than people realize. And right now, we have a situation where I've been paying a lot of attention to Bitcoin because I've been a big believer that gold and hard assets should be a part of everyone's portfolio. And would Bitcoin take the place of gold and be that part? And the jury is out, and someday it might. But so far, Bitcoin has been much more correlated to the NASDAQ 100 Technology Index times 3 than gold. So it hasn't quite got to that same status yet. So for me, a better hedge for now against a lot of bad things happening might be the gold.
Let me ask the room here, and don't be shy, because obviously we're not. How many people here are either 100% Bitcoin or would like to be? Look at John in the background there, Paul. Let me ask anyone who actually wants to yell, because I could come down there if you want. What biases you against other assets? It's a legitimate question. Is it, you want me to come over there? I don't know if you were trying to get my attention, if you're trying to tell me to shut up. What biases you against other assets? Is it the return on investment? Is it the money printing? Is it the profligate spending of the government? Is it you don't believe non-GAAP earnings? What is it? Anybody just shout out, anybody. All of the above from the surfer guy over there. Anybody else? So it's funny, I don't know about the supply itself, but that's something Matty Eitz said to me when I was on his podcast, is he said to me that there have been a number of times in history, and I believe him to be right, Mike, that gold has been fake. In other words, they drill the center out of a gold bar. I know that's not really what you're asking when you verify the gold supply, but Steve looks like he wants to answer that. Does there have to be an intermediary? Because that's obviously one of Bitcoin's advantages.
There really is gold in the vaults. I was actually in Switzerland once, and I wanted, and we owned a lot of gold on behalf of clients. I wanted to go see the actual gold bars that we owned. And they said, okay, and they took me to a nondescript warehouse-like district outside of Zurich. And they took me in a car, and all of a sudden out of the blue, this door opens. We drive in, I get out, 2 other people take me, we go down a long corridor, there's a door, they hit a bunch of keys, the door opens, we go in an elevator, and it seems like we're going to the center of the earth, get into a room, and they said, okay, we'll show you the gold, and they brought out a push cart showing samples of gold bars and gold leaf and gold coins, and I said, I want to see the real gold. And then they started talking together in Swiss German, and then they took me to another room, and it was not the size of this room, but the shape of this room. It was smaller, and I sat there, and I didn't see anything. Then all of a sudden, this guy comes out with a big key, puts it in the wall, turns the crank, and the entire wall moves. And I saw gold bar after gold bar, just stacks and stacks and stacks of gold bars. We were instrumental in the beginning of a lot of the gold ETFs that came out. We were early investors in that. And I know through some of our audits that the gold behind the ETFs really does exist in London. So there is real gold.
But you obviously didn't know if those bars were real, right? You just assumed because they told. I'm not trying to play devil's advocate.
I could feel the.
Okay, fair.
Feel the vibration.
That's fair.
I got a comment on that one. So depends on how you hold gold. I've been kind of a bias towards gold forever, mostly at the ETFs. So what if it comes to pass that the U.S. does not hold as much gold as it says it does? What does that mean for your position in gold? It goes up. Like, okay, that's a good problem. Okay, I'll take that. But the key thing I want to point about gold is I saw all the gold at the Fed, too. In New York, it's the biggest gold stash on the planet. I got to see Ellen Bliner there. That was a couple years ago. Yeah, it's real. It's there. But, yeah, they could have faked some of it. The thing to remember is I really appreciate what Steve said. There's times to be, and my entire time watching Bitcoin to gold's been about a decade, times to be, like I say about gold, is the world's going digital, and being a gold person and not having some Bitcoin in that space is basically missing out. But there's times to be overweight the rock and overweight the digital asset. And I still stick with the overweight the rock. So Bitcoin to gold right now is 25 ounces of gold per 1 Bitcoin. I remember watching it at 1. That's when I started believing it. My son in 2011 told me about it. Typically takes a young person like you guys over here who need to see a bear market, and then you'll realize what happens with your hair sometimes. But the point is, now I still stick with the problem is that Bitcoin to gold ratio. We have models, we have teams that do these models, and it looks like fair value is around 15. All right, that's a big deal. That means Bitcoin drops 50% versus gold or so. That's just where it was a couple years ago. Not a big deal. So, I mean, Bob wants to move on. That's to me thing to remember about. It's just a point about the Bitcoin gold is Now you're completely dependent for the stock market to go up in all cryptocurrencies. You just look at correlations, look at everything, and the difference with gold is it ran up so far. I'll just point out the key thing about what tipped me to say the word I'm not really supposed to when I published on the terminal is to take profits. It's a good problem to say that, which I kind of said too early in Bitcoin. Is the ratio? If you look at gold versus any moving average, from 60 months down to 60 days. It got the most stretched in about 30 years. And every measure of history means that's when you're supposed to switch on your money risk management hat and say, take some off the screen. When you see that they're all yelling, you got to be careful. And that's what's happening in gold, just like Bitcoin a little bit last year. And Bitcoin's just hovering on that level, ready to break down.
No, I don't actually want to move on. I like this conversation, but I want to go to Craig. But first I want to say that one of the things that I think upsets the Bitcoin community is when we say, basically, I'm paraphrasing, you're too young to understand what's going on. I think that's aggravating to people who probably do know more than we give them credit for, and I'm including me in this. I look young, but I'm old as shit. But I want to go to Craig. In terms of Bitcoin's role in the broader economy, I think it's going to increase. I'm not sure to what end. How do you see that evolving?
Look, the reasons that you want to own gold and Bitcoin are not changing, right? Governments around the world continue to deficit spend, and that it's not just in America, it's in Europe, it's in China, it's in Japan, and so money printing will never end. And so, the more that we have artificial intelligence and a push for that kind of spending, and that's going to displace labor, that labor is going to get put onto the government balance sheet, and the government's going to create money as handouts to pay for people to live. And so deficit spending is going to be here forever. And so the reasons to own hard assets is because fiat debasement will continue really into perpetuity. And so the question is, well, do you want to own gold, or do you want to own Bitcoin, or do you want to own both? I think central banks own gold, right? I mean, this is something that has been going on for quite some time. Stored trade, excess trade balances, excess trade reserves are being stored in gold. They're being stored away from U.S. Treasuries. That's been a trend that's been going on for the last decade. That's going to continue. The U.S. Treasury asset is no longer the neutral reserve asset of the world. Increasingly, more and more countries want to store their wealth away from U.S. Treasuries. It's just a fact. I think with respect to the people want to own Bitcoin. And so, if you believe in a world where governments are still going to have a say, and there's a place for gold, and as people get more power, there's a place for Bitcoin too. So I think, but fundamentally, the reasons why you want to own both these assets are only increasing. And so as a percentage of your portfolios, 60-40 is dead. The 40 that was allocated to bonds really should be zero. With respect to U.S. Treasuries, there are certificates of confiscation. And so you want to own assets that will preserve their value over time as the U.S. government is forced to put more and more people on its own balance sheet.
I completely agree on the Treasury thing, by the way. Steve, by the way, I just realized that looks like I'm in heaven on seeing if you guys can get in. Steve's in for sure. These two guys, I don't know. I want to switch real quick for 1 second because this is supposed to be macroeconomic, but I'm going to go back to gold and Bitcoin. And there's something I specifically want to touch that I spoke to a young Bitcoin content creator who's at Florida Gulf Coast University, FC. How do I get those right? FGCU. Thank you. Japan is about to play an important role and stuff, aren't they? Yeah. So, but before you speak to that, you're going to bring up the yen carry trade. And I'm going to do what nobody in any audience, I've done probably 50 of these in the last 5 years, nobody in the audience ever yells out, what the hell is the yen carry trade? So can you say what that is first and then talk about why it might be a problem?
So Japan's been in an extreme situation for a long time. They had their big bubble in 1989 when the Nikkei peaked almost at 40,000. They crashed down 70%. And it's only recently where they got back to where they were. It took 35 years just to get back to where they were. So they've had their big downturn. And in that process, they were the first ones to print money. They were the masters of 0% interest rates. And the Japanese currency kept weakening. So think about you're a hedge fund, and you're looking for a way to borrow cheap money and put it in assets you think are going to appreciate. That's the yen carry trade. They borrowed money in Japanese yen, paying literally 0% interest rates, and actually almost being paid to borrow because the yen is depreciating. They take that money, And what do they buy? They started to buy U.S. bonds. They said, well, we can do better than that. Let's buy U.S. stocks. We can do better than that. Let's buy NASDAQ stocks. And so a lot of the power and the fuel that has fueled our stock market rally is from this yen carry trade. Now, I can explain what I think.
Yeah, no, please go ahead. I mean, both of you can speak to it. You say what might happen when the BOJ, who's under a lot of pressure to raise rates, what could happen to
So
that?
after all these years and years of the yen depreciating and the Japanese and 0% interest rates, all of a sudden, inflation for the first time in decades is coming back in Japan. There's a lot of pressure for the Japanese central bank to start to raise rates. The yen is so undervalued that on a purchasing power parity basis, right now it's 160 yen to the dollar. People say it should be 120 to the yen. Some people even say 90. So there could be a big yen appreciation. And what's going to happen to all those yen carry trades? They're going to get margin calls. And all of a sudden, that cheap money turns very expensive. And what does that mean? That means on the other side of their trade, they might have to start selling all those assets that they bought with all that cheap money. And a lot of that are U.S. stocks and in particular tech stocks. So it's a kind of black swan that no one's looking at that could come completely out of the blue, and people are wondering what's going on, and that could be a factor that people should be have on their monitor.
Well, Bob's going to let me piggyback on that. Let's fast forward 35 years or so to now. What you just described, I started trading JGBs, Japanese government bonds, in 1995. What you just described is exactly what's happening in China times 10. And China, this supreme leader was, with his unlimited friendship, basically, according to NATO, is a decisive enabler of a war in his best customer's backyard. There's a pretty significant war going on. But in China, their debt to GDP is running around 300%. What are we in this country, 130 or so? Their money supply is running $45 to $50 trillion. That's double the U.S. Massive deflationary forces in a normal cycle that happened in Japan that you and I lived through very closely. And I remember very well the denial, and then it's too late. And why did the stock market finally bottom? Because the government started buying ETFs. What's China doing now? So the fact of macroeconomics is we have severe deflationary forces on a global basis just kicking in. Most notably in China. I mean, I wish I can buy one of the electric cars because it's twice as good as one as I drive and much more efficient. But we can't do that yet because it's so deflationary. So here's one analogy that Scott Bessent used, and I love using, from the movie Fantasia. Anybody remember that movie? Mickey Mouse? Yes, perfect. Made the spell, Sorcerer's Apprentice, which was, I think, from a German author, but he could not stop the spell. That's what's happening in deflationary forces right now. Scott Bessent used it because I think we both read the same book by Yuval Noah Harari. That's what's happening, massive deflationary forces. That's the second largest economy. Now let's look at Japan. Well, they're trying to get it out of there right now. Let's look at third. Germany, they're facing major deflationary forces. Maybe they'll be able to defend spend their way out of it. And then we got the U.S. holding the whole world up because of the stock market. So the key thing to remember also, that we got to have some disagreement on this panel. The key thing I've learned starting trading treasuries since the 80s is every time someone told me yields are going to go up because the deficit's ballooning, yields went down. And that's exactly what's happened in Japan, and it's what's happening in China right now. That 10-year yields are 1.8%. My prediction, by this time next year, if you can say McClone's wrong, maybe, Mr. Mike, our 10-year note yield about 4%. It's just hovering a little bit. By the way, yields went up when the Fed cut rates. That's the market telling you, Fed, you're wrong. You shouldn't be cutting rates. By this time next year, I think we'll be heading closer to that yield in China. And you hope I'm wrong, and there's one key thing that'll trigger that, just maybe a 10% correction in the stock market from where we are now, led by cryptos. But the macro is, this just is where things are. And yes, look where we are. We're getting towards the later stages of the year. At this time last year, we had the momentum going. President Trump was elected. Everybody was bullish, right? Now we're hitting stops. It's just starting to happen in cryptos. The Bloomberg Galaxy Crypto Index was up 30% a couple months ago. I just remember come Christmas time, remember when you're running leveraged money in the trading pits? You want to be able to buy the G.I. Joe with the Kung Fu grip for your kids and buy some pearls for your wife. You see profits fade and you're hitting those stops. I mean, it's just the way markets work. It's the end we see this shutdown that no one seems to care about. It's our economist, Anna Wong, said this is severe economic contractory stuff. So I'm not trying to scare anybody, just point out facts. And then I just point out, well, have you ever seen a year with gold up this much and crude oil down this much?
So we had Fantasia, Trading Places, Blues Brothers.
There we go.
This is like the old guy movie review panel up here. Craig, real quick, or real long. I don't really care. When you hear stuff like some of this doom and gloom stuff, and then you see the Congressional Budget Office, take that for what it's worth, recently said that debt to as a percentage of GDP is actually starting to head down, but they included the tariff revenue for the first time ever. Obviously, we never had such large tariffs. Is that a temporary thing to get past, your opinion, of course, temporary thing to get past the midterms, or just complete shell game? How do you look at that whole situation?
Yeah, I mean, and we'll see if these tariffs are ruled unconstitutional.
Yeah,
There's
to me,
obviously
that's
a
the biggest
ruling,
thing going on
and I
right
think
now.
that is a real risk for the bond market. But look, I think bonds have outperformed more recently, aided by some of that tariff revenue, which has been, I mean, the tariffs are a tax on the consumer, and they hit the low-end consumer even more. And so, but look, I think if we have this type of correction that Mike and maybe myself are anticipating, the government really can't tolerate it for very long, right? I mean, we have such a highly financialized economy and financial system that you can imagine as the stock market starts to fall, there will be efforts to print more money. There will be efforts to deficit spend. There will be efforts to transfer wealth again and provide checks out to people again. So that's my concern with respect to the long end of the bond market. I think as you're starting to see other countries move away from ownership of long duration treasuries, there's risk there. And so the government's pain tolerance is, I think, what we're talking about here. And I think that the pain tolerance is low. I think the minute we get a little bit of a correction, they'll scramble, they'll open the government back up, they'll scramble, they'll deficit spend again. And that's the reason I think people in this room are, remain constructive on crypto, Bitcoin specifically, on gold and on hard assets, because we can't really afford that type of deflationary bust type environment that happened in, post 1929.
So that brings up an interesting point. I mentioned it a second ago. I spoke to a young lady from FGCU, is that right? FGCU. I can never say that. I lived here 5 years now. And she talked about how her crypto club almost felt like they were in competition with the stock club. So Steve, how do you get people to sort of look at this and say, this could be a good asset and that could also be a good asset? How do you get past that? Or do you? I don't think Mike does.
Well, I'll follow up on that later.
One way to invest is to pick the asset you think is going to do the best and put all your money in it.
There you go.
And you might be right and be a hero, or you might be wrong and get wiped out. Another way to invest is to say, there's no just one single asset that can make money over time. Many, many assets can make money over time, but they zig and zag at different times. They respond to different parts and different stimulus that's affecting the economy and the markets. And you can build a highly diversified portfolio that covers many different asset classes, that covers many different geographies, different types of assets, and do very well and have much less risk and downside. So what we do at 3Edge is that we create these global multi-asset portfolios. They include different types of stocks, but all over the world, and all liquid using ETFs. We invest in different fixed income instruments, although we're at our absolute minimums in fixed income right now for a lot of the reasons you just heard. We invest in hard assets, which include gold and different commodities. We can be diversified across different currencies. And we have a mathematical model that helps us analyze the cause and effect relationships, which tell us when do we want to be at our minimum range or maximum range. And the end result is you can make very fine returns over time, and when the drawdowns hit, you get hurt much, much less, so you get to stay invested. So a lot of people use us as the safe part of the barbell strategy when there are other more risky or illiquid strategies are being deployed.
Guys, unfortunately, I have to cut it. I'm getting that sort of signal, but you can all come to my house later. We're going to be talking about this more. No, thank you all for having us here. Real quick, if all three of you can just tell people where you can find, where they can find you if they want to follow you or speak to you more, or I'm sure this guy's going to want to talk to Mike. Where can people find you, Steve?
So I'll be hanging out here for the cocktail hour and be happy to talk to anyone. It was mentioned early in this conference that one of the reasons to have this conference is for people to meet one another. And we've been based in Boston for many, many years and been very successful based there. We recently, pretty recently opened an office in Naples, and I'm looking for ways to try to meet more people in the Naples community. So I'll be very happy to talk to anybody. The name of our company is the number 3 EDGE. Our website is 3edgeam.com.
Craig?
And my colleague is here, Al Candy, as well.
Yeah, best place to find me is on X, where I mix it up pretty regularly. CES921 is the handle.
He does.
X, Mike McGlone, at Mike McGlone 11, LinkedIn, Senior Commodity Strategist, Bloomberg Terminal. And just a final thought, when my outlook for cryptos was they were going to peak after we had wide dissemination ETFs. That held for about 6 years. We have that. My outlook now is the whole thing will be over once we have about a 90% drawdown on things like Dogecoin, which is worth nothing as long
Well,
as
Matty Ice has bids way below the market.
There we go.
I'll tell you that right now.
But all is well, Bobby, because you invited us to your home and you're in heaven. So
How
we're
about
all
that?
being saved.
All right.
I'm at the gates of heaven if you're looking for me. Cheers, guys.
All right. All right, all right. Oh, thanks, Mia, for bouncing me. I totally forgot the clicker. That's how it is. Okay. Oh, without further ado, my friends, we're going to bounce right into our next section. That's right. In fact, Mia, helpfully get me to the title in a moment. There it is. Blockchain emergence technology and the investment landscape. And, of course, who better to help explain it and roll it out than 4 of the masterminds, the best masterminds, in fact, to be found when it comes to technology and the intersection of, well, the family office and, of course, good utility for all services worldwide. Something like that. Sure. Everybody, this is Alex.
Hi, everyone. So we're going to talk today about areas where technology is creating some real opportunities with a specific focus on family offices. I'm going to have us all introduce ourselves, so I'll start it off. I'm Alex Hochberger. I'm the CEO of Web3 Enabler. We work with partners like Salesforce, Circle, Ripple, and Stripe Crypto to help enterprises adopt these new blockchain technologies. We support Bitcoin. We're very big on stable coins and payments. And we're very big on the new real-world assets. And if those of you have, investment arms for early stage, we're doing a seed round right now. And the thing that mostly fascinates me right now is stablecoin treasury operations and moving money globally. So I'm going to let everyone else on my panel introduce themselves, what they do, and what's kind of interesting them in the technology landscape right now.
Hi, everyone. Garrett Johnston with Marsh. I am kind of an insurance guy in the room. Been in the business 26 years. Really got into Bitcoin in 2019, 2020. Followed what Michael Saylor did very closely. I sit at Marsh now, which I joined about a year ago. Marsh McLennan, the parent company, is a very broad net that it casts globally. So 90,000 associates, 130 countries that we're in. We have the insurance brokerage and the reinsurance arm, which we're known for. That's where I technically sit. But more importantly, we have Mercer Investments, which is $17 trillion under advisory. They're bigger than BlackRock, and they're the #1 advisor to most sovereigns and pensions. So that gives me a very interesting line of sight across the industry. And then the other one we have is Oliver Wyman, which is very akin to McKinsey. So we kind of have global consulting, global investment advisory, and insurance. I help lead Bitcoin strategy across the firm. So at a 100,000-foot level, I talk to the Bitcoin miners, the stablecoin operators, the Bitcoin treasury companies, you name it. I kind of have line of sight into that, as well as all the Wall Street bulge bracket banks.
Hello, my name's Mike Reevey. I'm the CEO of Bullet Network. My background is in software. I was writing software way back in the 1980s. I got started accounting mostly. I got a job on Wall Street. I was a trader, bond trader, convertible bonds, and then went to the buy side. And 2009, discovered Bitcoin, not programmable money, but Ethereum later, or Solidity. Started programming. Bullet Network, what it does, to me, business starts with credit and ends with payment, not the other way around. If it's the other way around, it's a cash-only economy. So Bullet lets you mint your own credit. You can originate your credit. So if I deliver product to you, I can mint an NFT.
Why is that useful? That's to finance it in a pool that we have at Bullen Network.
Todd Ziegler, I'm the CEO of TCS Blockchain. Can I borrow yours? I'm going to have to double it here. I'm the CEO of TCS Blockchain. I'm an attorney by education. I've been working in the transportation industry for longer than I would like to admit. I've owned freight brokerages. The single largest problem in North American supply chains is cost of capital. We don't have a driver shortage. A lot of these other kind of Main Street narratives that you hear about. Over 90% of all goods in this country move on trucks, and 97% of the trucking companies and logistics firms in the United States are 1 to 5 trucks. So this cost of capital issue is impacting them. It's impacting all of us. The genesis of TCS was that it's really the thesis of Bitcoin, right? That we can utilize blockchain rails to provide faster and cheaper credit to transportation companies. Anytime somebody delivers a truckload of freight in the United States, they're typically waiting 30 to 180 days to get paid. I have been customer facing with Fortune 1000 customers whose pay terms are net 180. So literally you do all the work, you pay all the front end costs, you do your job, you deliver the freight, you get a receivable that can't be monetized for 6 months. That's almost industry standard. So TCS was born to reduce this capital cost problem. We're the first company in the world to settle a freight invoice on chain. Fast forward to where we are today, we have over 100 trucks and brokerages that are on the platform. We just closed a deal with a huge Chicago carrier that does $200 million a year in AR flows. The thing that I'm really excited about is digital asset payments, right? I feel like we're in a new chapter for blockchain, Web3, and digital assets. I think the focus is going to be less on speculation and these various tokens and more on real-world use cases that impact RWA, that impact payments problems. And again, this problem in particular, I would argue, is the largest B2B problem in the United States. So, and my company we've been invited to the White House twice since March, so I know that this is becoming a very serious consideration on Capitol Hill as well, and I think that's a good thing. I think that the industry has matured, and we're kind of turning the page and moving with a greater focus on these tremendous use cases that are impacting legacy industries. So happy to be here today and talk about it.
So clearly we've come a long way from Fartcoin and some of the other more speculative things as we discuss treasury operations, insurance, accounting, and transportation. So since we have here people that are really focused on capital allocation, I'd like from everyone's perspective, where are family offices getting a unique advantage in this market, and where do you think they can run ahead of the slower moving organizations?
Yeah, I'll start. So when I look at it from like the institutional capital level, and I'll use the insurance industry as just an example, privately, most insurance executives and institutional capital on the insurance side, they are wrestling with inflation. They use a term called social inflation, which is like runaway jury verdicts when there's a car accident claim that should be settled for $1 million, gets settled for $100 million in Texas, something like that. That is a pernicious problem. So privately, I think a lot of that insurance capital, which is $7 to $10 trillion of insurance capital, kind of gets it privately. They're handcuffed from the regulators. So I'll just give you a couple examples, and I did a little ChatGPT exercise on the way down here to illustrate it. So when you think of insurance companies and banks, they are really dictated by their capital rating. So like an AM Best rating is the bread and butter of an insurance company. For example, if you were to take an AIG, a Chubb, any of the major players, you get heavily penalized for putting Bitcoin on your balance sheet because of the regulatory risk-based capital ratios that come in. So just as an example, if you're an AIG or a Chubb and you put 5% of your reserves and surplus in Bitcoin, you would have a 60% penalty on your RBC capital ratio. So you basically would get downgraded by AM Best, even though most of us who understand it, you do the math on long duration assets in an insurance portfolio, and that's a winner. 5% allocation beats what they're doing right now. So I say that in the context of They kind of get it. They have handcuffs. Family offices don't, right? The banks see it. They see it on the stable coin front. The big money capital, like it's starting to come. The regulatory friction points, to me, is where the family office opportunity is. You guys have a year to 5 or so to kind of front run and do this trade. But once the regulatory stuff is unlocked, that big capital is waiting to come in. Like so many private conversations I have on that front. So if you're a family office, to me, that's my biggest recommendation is just, if you don't understand it, connect with people who do the learning, and fantastic window to entry point for family office.
Where right now the biggest pool at Bulla Network is the TCS pool. That would be trade finance. It would fit into your private credit bucket if you already have one. It's sort of in the fixed income area. What would be different about this pool is that it has 30 to 45-day liquidity, which I've spoken to other people in private credit. They're still trying to get out of their private credit investments. So that's the biggest difference for us, and that's where it would fit.
That was a great primer from all three of you. The one thing that I would add, I would say family offices are missing opportunities in blockchain related to legacy industry arbitrage. Okay, and let me give you a brief example of that. So my company TCS, we buy freight invoices. A lot of them are A to AAA rated. Okay, a lot of them are from Fortune 1000 shippers. Because these transportation companies can't wait 30 to 180 days to get paid, they have to sell them now to intermediaries, right? They're called factoring companies in the transportation industry. They're banks, they're financial intermediaries. Typically, it is not out of, it's actually more common than not that you'll see these companies pay 3 to 5%, okay, to get paid in, let's just say 2 to 10 days, so they don't have to wait 30 to 180 days. What they don't realize when they sign those 3 to 5% contracts is that is an annual cost, or I'm sorry, that's a monthly cost. Okay, so they are paying 36 to 60% annualized interest rates. They're paying the equivalent of hard money loan rates to monetize what is on Wall Street, typically A to AAA rated commercial paper assets, right? If I own a Walmart asset, that has a higher rating than US Treasuries. Okay, that's a massive arbitrage opportunity, okay, for institutional capital, private capital, family offices. Right now, those invoices get collateralized in a pool over at Bulla, okay, and Bulla is paying 8 to 10% yields on the capital that goes into those pools that are fully collateralized by these commercial paper assets. Okay, so there are, beyond token go up, right, and speculation on these various things, there are some very cool arbitrage opportunities happening right now at the convergence of traditional finance and Web3 finance. And I know Anthony Basili, who probably many of you know from Coinbase, I think he just wrote an article focused on institutional and family office capital called Get Off Zero, right, which basically means dip your toes somewhere. Right, like start your and I know many people in this room already have, right? I would guess if there was a show of hands, most folks in this room at least own Bitcoin. But it's, there are all these opportunities. I don't even, we talk about where are we in the baseball game, what inning are we in? I don't think the game's even started yet. Okay, there are all these tremendous opportunities happening at the convergence of legacy industries and blockchain and Web3, and I think that's where family offices can play a much larger role in terms of allocation than they are right now.
And that kind of leads us to kind of the next topic. There's a technology aspect to these sort of companies, and there's also a financial aspect to those. So kind of how do we think about these alternative investments and where they fit on your portfolio, on a scale of, I'm holding commodities on one end to early stage venture capital on another. Where do you kind of think these fall out on, the platform? Are they tech? Is this finance? Is this paper? What do you think?
It kind of depends on the business model and the regulatory environment you find yourself in. It's very variable. The dynamic around how you would look at those investments is going to be a function of what language. A lot of times I go to clients, I'm like, well, you got to think the language of the client. So Saylor actually does a really good job on this when he talks about some of his, I could talk about Stretch, and I could say it's a perpetual preferred, stock, and I could use all these lingos, and people kind of be like, it's pretty strange. But you could also say, hey, you're getting 2, 3, 4% from your bank in a money market account. How about I give you 10? And most people are like, yeah, I'll take that, right? He does that because it's embedded and backed by Bitcoin. So I think in many ways, we sometimes in the space overcomplicate and over-financialize the language around it. And you just personally, I'm a Bitcoin, not crypto guy. And one of my theses to most clients is, outside of some of the regulatory friction points, Bitcoin basically makes every business model better. You just have to know how to harness it and the pros and cons and how to structure it. And I think, Michael, who you'll hear later, does a fantastic job of leading the way of what's possible when you lean into kind of what that world could look like.
Again, I think it fits with your special situations kind of credit. What's really, I think, human capital is completely underfunded because of the traditional rails that we all suffer under. Bulla gives you an opportunity for anybody to fork and make a pool, for anybody to originate their own credit if I deliver product to you, or if I do a purchase order, or we have these funny things called friend lends if I want to lend money to a friend of mine. All of these things are possible. What that means is these pools that will start to be created on Bulla will have a lot of alpha, because the people running those pools, Todd is one of them, know their creditors, know who's borrowing. And you'll be able to see also on-chain his performance, what the state is of every invoice or every friend lend or every other commercial loan. So I am hugely bullish about this decentralized banking that Bulla is creating. I'm really positive on TCS. And just the bearish panel before, I'm a size buyer of Bitcoin. I just wanted to say that. No financial advice, but we are at a revolution for decentralized banking.
Yeah, what I'll add to that is, of course, portfolio construction is always a case-by-case basis. But I would suggest that, if part of the portfolio has to be allocated to, let's just say, risk-off assets, right? Things like U.S. Treasuries, things like, municipal bonds, et cetera. These instruments that are, safe but very low in terms of yield and ROI. There's this whole world of transportation supply chain finance that's going on right now, right? With, returns that are, typically 2x what U.S. Treasuries are paying. And this is a really important thing, too. This is a statistic that a lot of people don't know, but, because there's so much fragmentation in the United States, because 97% of the transportation companies are 1 to 5 trucks or smaller or small businesses, anytime you're forcing these large costs of capital on smaller players and small businesses, guess who ends up subsidizing that tax in the ecosystem? All of us. Every time we go to the grocery store, right? Every time we buy something off a shelf. Anytime you're forcing somebody to take on 36 to 60% annualized costs, when, they should be getting the, probably some of the lowest cost of capital out there, right? Somebody's going to have to absorb what I call that silent supply chain tax that most people don't even know exists. So again, it's always a case-by-case basis, but I think anybody that's, has a portion of a portfolio allocated to risk-off assets, the freight invoice settlement world is particularly interesting. I'll also share TCS has been live since August of last year. We have a 0% default rate to date. The industry-wide default rate in the United States on full truckload paper is less than 1.5%. Okay, so this is a very, very good stuff in terms of the universe of commercial assets, and the default rate is very low. This isn't like the construction loan world where you typically see 25 to 35% default rates. It's pretty interesting.
So pivoting from asset allocation to kind of the technology side of the investment, where do we see things going? So caveat, I work with existing enterprise technology tools and bring it over into the crypto rails, but we have kind of, industry-specific products, or we have kind of these general purpose, like the Salesforce, the QuickBooks, the Oracles of the world, and then we have kind of these new Web3 platforms that are coming out. So do we see a world where we're integrating the blockchain into the existing systems? Do we see new systems that are Web3 native coming out? Where do you guys see the technology going as they interact with you and your tools and your businesses?
I'll start. My answer is probably going to be more on the simplistic side, but I'll give you one use case. We handle most of the large global firms. So you take, even within our own firm, but if you take like a Coca-Cola, a Mitsubishi, a Toyota, they have these huge supply chains with money and product going around the world. The intercompany transfers that they have to do, there's just a ton of frictional costs. And so when you get into the crypto rails, and in particular things like stable coins, that completely, smooths out and eliminates most of the frictional costs. And when you're moving $25 billion of capital around the globe within your own company, 25, 10, 15 basis point improvement on that is like real money to the bottom line. So that's just one from an insurance standpoint. We have a lot of conversations of like, how do we improve your FX risk, frankly? Because like you could take something like a tether, right? And there is, you can transfer $5 billion for like less than $10 or something. It's ridiculous, and it's instant settlement. There's no T+2 or 3 or whatever it is. So it's just better, and I think it gets back to that point of like what makes their product better is like it's kind of double the rate you'd get not using the blockchain technology. So I think again that theme just comes back to me of insurance can be pretty darn boring, to be honest, right? But the innovation you put into it and how it can help manage risk is where I find kind of the exciting part. But it just, frictional cost goes down. Some of the financial engineering and like Meanwhile is I think a perfect example. Like life insurance on a Bitcoin standard just works better than fiat life insurance.
I'm going to use that recording in my next ad, by the way. Like I think that kind of explains what we do.
Software is hard. There's a lot of inertia for legacy systems. So it's hard to really change a lot. I think the future will be composable. It always has been in Web3. I am a member of a couple of different DAOs, and we pick and choose whatever software we're going to use, what's useful, and the only criteria is can we bridge it to whatever other system we already have. And I think you're going to be able to, one size fits all. We're getting away from that world. Traditional banking is one size fits all. And we're going to go from one size fits all to, I think, a happy medium. It's not going to be completely decentralized and, composable, but it's going to find some happy medium.
Yeah, and I'll just go back to the business-to-business settlement and payment space because that's the space that I operate in. But I'll say right now, I think 5 years from now, you're going to see the majority of business-to-business settlement exclusively operating on blockchain rails. It's faster, it's cheaper, and it's a better user experience. I joke with people all the time who are like, you're getting trucking companies to adopt settlement and crypto on blockchain rails? And I said, when you explain to these companies that their true cost of capital are 36 to 60% annualized, if you told them it would be faster and cheaper and a better user experience to go bury their invoices in their backyard overnight and come back the following morning and dig them up, and they would reduce their cost of capital by 50, 60, 80, 90%, they would absolutely do it. When a trucking company settles with TCS, we directly deposit tokens into their wallet on an exchange. In 3 clicks, they're back into US dollars. That's how easy we've made that for them. So we're not quite to the world where crypto is the back end, but I think we're on our way there.
So, globally, the U.S. has been kind of a laggard in some of these areas. Certain areas of the world have been a little more ahead. We're really focused on the African market right here. But which global regions do you think are leading, and for what reason, and where are you excited to see, global adoption, and why? Like, why is that region leading?
A couple thoughts there. I think something I find really fascinating is it's so easy for us to get blinders on with the U.S. perspective of a lot of like Bitcoin's kind of on a need-to-know basis, and we're a first world, very affluent country, right? And so we do not feel the pain point that a lot of these kind of the global South feels. So sometimes when I'm talking to either like my parents or my parents' friends about Bitcoin and stuff like that, I put it in the example of like, if you're living in Argentina, you're going to swap to dollars because dollars are a harder asset. They hold their value. All Bitcoin is just a harder version of US dollars, right? So there's that dynamic to it. And then I just think the global South, for the most part, has been a far quicker adopter of crypto because it just functions better. It's cheaper. You don't have to have kind of the financial privilege. If you've read that book, Check Your Financial Privilege, that is a fantastic book about kind of laying out how the first world versus third world dynamics play out. And then I would say just from a US perspective, I think we were falling behind until the new administration. And we just did this giant pivot of we're going to kind of plant a flag and put some market structure around it. And at least in the world I live in, which is super risk averse and compliant, like we need, like insurance companies, if there's not regulatory structure, they will just wait. Like, period. They're just not going to jump in until there's regulatory structure because they're taking on liabilities that are 5, 6, 7, 10 years down the road. They can't do that in a squishy regulatory environment. So I think we were losing ground. I think we're jumping ahead. TBD on where that pendulum shifts from every 4 years, but who knows?
I would say the United States. I wouldn't have said that prior to this administration. I look at Google Analytics for our app. Before the change, it was all Africa, China, and some other odd places. Now more and more the U.S. To me, if it's not broken, there's no incentive, and there's not a lot that's broken here. There was a lot that is broken or doesn't exist in the rest of the world. The problem with the rest of the world is the magnitude of things. If you want to do a lending book in India, for example, it's microloans. If you want to do trucking, Todd just mentioned a huge number. The United States is where I think the bigger opportunity is to embrace this technology. It's matured enough to make sense to do it, to take the risk. So I'm very bullish, United States.
Yeah, I'll just add to that. So TCS is out there reducing cost of capital for small businesses and transportation companies. We got debanked during Operation Choke Point 2.0. Literally got a call from our senior bank and said, get all your money out of the account. You have 3 days. Okay? So, and here we are operating in the shadows, trying to provide faster, cheaper, better settlement to the U.S. supply chain, and we're hoping not to get a Wells notice from the SEC. It has been a 180-degree change in the United States in the last year. You can see that in the new leadership of the SEC. You can see that in the new leadership of the CFTC. You can see it on the Hill. You can see it from the White House. So I would agree with Mike. I think the United States, in a very short period of time, has again become the preeminent jurisdiction for blockchain and digital asset innovation. And I would just add to that it's about damn time.
And the last comment on that, what I would add on is for these markets to really function well, you need deep liquidity pools. And that's where the U.S. dominates, right? So if you compare us to Europe, et cetera, like they're not on board from they're much more antagonistic on the crypto side. So the liquidity in the U.S. is a huge benefit.
So I'm going to make it hard. You're not allowed to use North America, and you've got to pick a continent on a risk board. Where do you see the adoption going outside of North America? Who's leading? Is it Europe? Is it South America?
South America.
Yeah, I'd say Latin America. Again, it kind of depends on the sub-industry. So I think Bitcoin...
Nope, you only get to pick one continent. You going with South America?
South America.
South America.
Yeah, I have to go with South America. I have two people in South America.
I was very bullish on Europe until Mika got rolled out. So.
Okay. Okay, so, you guys are at this point, TCS is essentially like a tokenized credit, right? So, this is still niche, still under this real-world asset category or things like that. At what point do you see this as just a mainstream fixed asset and the fact that it's a token is incidental? When do you see that? And I'm going to guess we get a different answer for the insurance industry than everyone else.
Well, I will plagiarize an answer I heard a few years back that I thought was really illustrative. I think for the most part, this crypto stuff just kind of bleeds into the ether and it runs in the background. So for example, like nobody cares to understand how email works. Nobody cares. It just works. And it works way better than what? Fax machines, right? Snail mail. We simply I didn't know the technology. I honestly didn't care, right? Email works better than fax machines. I think that is where we land ultimately. That's going to be a journey, though, over a decade or two. But that is just like, nobody really, I don't know how the internet works, to be totally honest. I just know if I put in a website, it pulls up and I can pay my bills and I can book a vacation for my family. Like, it works great. But I don't know the underlying protocol. So crypto is the protocol layer, right? And then all these businesses are being built on top of it. So you hear this terminology of L1, L2. L1's the base layer, whether that's Bitcoin, et cetera. And then you have a Bitcoin treasury strategy, or you have what Michael Saylor's doing. He's building all these credit products on top of it, and then he's arbitraging kind of the frictional points in the capital markets using Bitcoin as collateral. But yeah, it'll bleed in. We won't even think about it. It'll just work better. You'll get double the return on your commercial paper. Insurance payments at one point will be settled like this versus, fight with your adjuster for 6 months and hope they pay it before the debasement goes down on what they're paying you.
As a trained engineer, I don't care how it works, it just does. I'm crying a little here. It hurts.
That hurts.
It's because I'm not an engineer, but I represent, I represent the majority.
When you said I don't know how email works, I'm like, oh, my life is pointless. No.
You probably care about as much as how insurance works, too.
That's fair. Right. I just get a bill and complain, so we're equal there.
I think an indicator of adoption will be when I talk to more vaults, and those vaults are incorporating my little or a couple of little lending pools, because the pool itself is not optimized for cash. I always redeem and deposit myself to keep the cash low. That's what a vault should be doing. And a vault should be doing other things with your money, trying to allocate it as optimally as possible. I've had more and more calls with vault companies, and I think once I get one to bite, then I'll know we're on the road.
So I love the email analogy. Please, nobody ask me to explain how email works, because I won't be able to do that. I want to give you one more analogy, though. In the transportation world, when you sign a contract with a factoring company, okay, you are collateralizing all of the AR that you sell them, all the receivables you sell them. You are giving them rights to all of your future revenue, all of your future AR. You're typically signing a personal guarantee. You're typically cross-collateralizing all of your other business assets, and you are locked into this draconian, typically they're like 25-plus page agreements, okay? You're locked into these terrible agreements for a very high cost of capital and pretty bad customer service. And I share that with you as somebody who owned a freight brokerage that was contracted with a factor for a while, okay? When we onboard a new customer at TCS, we have non-exclusive agreements. So we are collateralizing the AR that company sells to us. And our position is you can throw out the tech stack, you can throw out the blockchain. If you cannot allocate and underwrite and collect perfectly, none of this stuff matters, right? You have to be able to do all those things well. So our thesis is if that's a commercial paper asset that we should buy, then that's our collateral. So the point is all of these customers get the benefit of non-exclusive agreements. So I tell them when they onboard, look, settle one invoice. If you don't like faster, cheaper, and better, you can go back to doing exactly what you were doing before, and not one of them has left. That's the difference. That's the benefit of simply a better tech stack and better rails for settlement.
And I'll just offer for everyone who is interested in understanding how email works, I'm happy to walk you through the RFC protocol. So, I'd like to know, we have a lot of infrastructure discussions like Bitcoin or ETH. We have a lot of, in this case, the paper. Do you see the value and the value for investors primarily in the infrastructure side, in the payment side, or in what you can do with the tokenized assets themselves?
I'll just call out two use cases. One, which I touched on before, I just think stable coins and remittances, intercompany, business to business, and then globally, that's a huge one where there's just frictional cost that this ecosystem will do better. The other one, and it kind of it touches on some of the AI discussion on the last panel. So when I sit talking to a lot of these large Bitcoin miners that are doing these massive pivots into the AI data centers, I think it's really important to listen to kind of the language, and then the opportunity is in the structural shift of what's going on. So these Bitcoin miners are basically using language like they're becoming vertically integrated digital infrastructure companies, right? So they are no longer thinking themselves as a crypto company. They are power distribution entities vertically integrated. And so when you talk to them and you kind of look behind the curtain on their business models, the issue is not NVIDIA chips. It's raw, consistent power. And then so for me, the directional trade is more of a power issue. So I think we have about a 40% shortfall in actual power generation to what's been already pledged to invest in the AI space. So like, how are we gonna, you can't build a 1,000 megawatt data center. It takes like 3 years. It takes a couple $1 billion, 3 years, and just a ridiculous amount of red tape. So how are you gonna get there? There's a shortfall. So there's a trade and an arbitrage within that. And then, I'll stop there. Those are two easy ones that kind of come across my plate a lot.
I guess no crypto panel could resist talking about Bored Apes. I remember when Bored Apes came out, we had already started using NFTs for invoices. And suddenly, Ethereum, you couldn't even mint unless you had $50 in gas to mint a dumb NFT. Your question about where the value is, Bored Apes aside, I think in things like what we're doing, if you can find credit, private credit that is tokenized, that's underwritten by people that know what they're doing, that's a buy. That's an interesting opportunity, and that's, I think, where it is. So in the tokens, maybe not, okay, maybe Bored Apes, but some of the other tokens, not so.
Yeah, and I would just add that you have that spectrum between alpha and beta from an allocation perspective, and an 8% annualized yield on AA rated commercial paper, 2x treasuries, like that's a really good investment, but not an alpha investment, right? Alpha, is going to have to be found in other ways, right? Like for example, direct investment in a company like TCS through something like a Reg D 506C preferred equity round. But all of these things are available. So that's the good news.
Can I push back a little on the alpha? There is alpha in that 8% because it's not available to anybody just for free. You have to get Todd's system, how he looks at credit, to get that return. Other people doing the same thing might not get an 8% or a SOFR plus whatever, 300.
I realize I'm the least financially educated up here, but I'm pretty sure 8% is more than 4 and a lot less than 60. Is that the big takeaway here?
You are correct.
That's a fair assessment.
Okay, so that's one finance class, so I'm glad I'm following along. It was a while ago, I'm old. So I guess kind of final thoughts on investments here as you guys are discussing. Let's have everyone give a final thought for end of 25 and across 26. What we see going on. We don't need to compete with the last panel. Just kind of, what's a thought about what you're doing that's not everything's crashing? Like, what's a thought here?
Yeah, I'm pretty bullish, particularly on Bitcoin, because I look at it differently. Again, back to that AI trade. One of the issues in AI is they need like 99.9% uptime. Bitcoin is the only one that has the intermittency dynamic with the proof of work network, which is totally different than the other 25 million or so coins out there. It's a shock absorber. It's a circuit breaker on the power grid for these AI companies. So AI actually needs Bitcoin integrated into the power structure. So like Mara just released earnings, Q3 earnings. That's a great earnings call to listen through if you just want to hear how they intersect those two worlds. And then I would be remiss if I didn't plug some kind of insurance thing here. This is going to take time. And a lot of this is done offshore at the moment. So like in the US and Lloyd's of London, like they're just not on board yet from a regulatory standpoint. But in places like Bermuda and some of the Caribbean offshore, Caymans, et cetera, there is a really kind of burgeoning Bitcoin denominated insurance. And it can be like the meanwhiles, but it also can be Bitcoin balance sheet writing fiat policies, and then you get the same arbitrage Bitcoin yield opportunities that some of the Bitcoin lenders have. So as long as you have an insurance product that has duration over 4 years, and Bitcoin has a phenomenal rolling 4-year track record, you can usually arbitrage that pretty well, but you got to do it in the offshore markets. You got to do it through things like captives and some of these alternative structures that are kind of esoteric, but that's kind of the fun part of insurance I get to be involved in.
I think towards the end of the year and beginning of next, we're going to see more and more restrictive credit from at least the traditional side of things. I think the outlet is in stable coins, different kinds of stable coins, in private credit tokens, things that I'm doing. I said earlier, human capital is underfunded. I think you give it a minimum of capital, we're going to see a lot of productivity gains. Makes me very positive. I sort of like the first panel was the death of, I don't know, death of banking, more or less. And I think we're experiencing that to then have a new renaissance in capital formation and productivity.
Yeah, and I'll throw my trucking hat on here for a second. We're seeing a massive repatriation of American manufacturing. So, I'm not going to necessarily speak to equities markets or bond markets or crypto markets. I am very bullish on transportation trade finance. I am very bullish on the transportation industry. I think that capacity is going to surge, and I think we're going to see, and we're not just seeing that in terms of guidance from the White House with respect to tariffs and trade. We're also seeing it in terms of, like, many people might have caught the recent news that the Department of Transportation just nullified CDL, commercial driver's licenses, for anybody who's in the country who is not a U.S. citizen. Okay, we had tons of non-U.S. citizen truck drivers 30 days ago that we don't have now. So I do think we're going to see a real push into supply chains from Washington over the course of the next 3 years, and I'm very bullish on this industry writ large.
All right, so that kind of completes our discussion. I just want everyone to leave. Where is your preferred method for being contacted if people in the audience want to follow up? For me, it's LinkedIn. You can find me as Alex Hochberger. I am on other social platforms, but that's the one that best directly connects.
Two places, LinkedIn, Garrett O. Johnston's the handle, or Twitter @Garrett OJ.
Which one? Michael Reevy on LinkedIn, or @Reevy_Michael Twitter.
My 15-year-old daughter has 25,000 followers on TikTok. I have 10. So you can find me on LinkedIn, Todd Ziegler, TCS Blockchain. Thanks.
So thank you, guys.
All right. Wow, fantastic. All right, say it with me. Now, isn't that interesting? Huh? In fact, turn around to your left and right and say to your neighbor, isn't that interesting? That's how we do things. Thanks, Cody, for keeping us together. Thanks, Mia, for bumping up on the slides right there. We're going to go ahead and roll right into the next of our sessions. And, of course, it's going to be a fascinating deal right here about RWAs, real-world assets, of course, and portfolios. And I'm going to give you this thought to open it up. There's this thing that we work in our production agencies that produces this event and a few others. We go by a thing that we call the Stanzik Doctrine. And that has to do with this idea of being able to convey what it is that we do for the community and how we'd like you to be involved in that. All right, you're familiar with this? A little bit. The Stanzik Doctrine, that's right. In fact, it's kind of like a guiding light, and I realize that it's kind of the most important thing I really want to share. The gentlemen that are coming up on stage in a few moments, of course, will give you all great details in their backgrounds, but the Stanzik Doctrine is a thing that actually really unites them. And, of course, they're all very well qualified to talk about this topic and whatnot. But C.J. Constantinos is going to be up here, Grant Cardone, Jay Bose, and John Devine, and they all do that same thing. They follow the doctrine about being concerned what it is, expressing what it is that they do for the community, and how they'd like us, or you, all of us, to be involved together. So I'll just have you consider that thought as I bring out Alex and CJ, and Grant, and Jay, and John. Oh, look at that. They're all taking a meeting. Oh, I love this. Apparently, they're doing a dramatic entrance. They're having a little ex parte meeting out in the hallway, I think. I think they thought the bar was open early. Oh, there they go. All right, should we run through that again? How about this? You can all say, that was interesting. All right. I gave you guys the most rousing wind-up and swing and a miss. John Devine, Jay Bo, CJ Constantino, Grant Cardone, and the mighty Alex Stansig. Did you hear that? Did you miss the whole thing about the Stansig doctor? Oh my gosh. We'll have to get the replay for you. Here you go. We're sharing mics.
Thanks so much. Good afternoon, everybody. Thanks for joining us today. Some of these gentlemen you already know. I'm going to really quickly allow them to introduce themselves. We'll dig into the topic of the panel and talk about some high-level overview things and then drill down. So first up, we've got Mr. Grant Cardone.
Cardone, own a company called Cardone Capital, and we have about $5 billion worth of real estate. We also started a real estate Bitcoin hybrid fund this year. We have 5 of those now, about $1 billion worth of real estate, multifamily, cash flow positive day one. Comes with about a 35% depreciation to our investors, and then we add about 35% Bitcoin to the asset. We're taking that company public here either end of this year or next year. I think it's going to be a great solution for any digital company that maybe has a treasury focus but no assets and no cash flow. So we have tremendous cash flow day one. Customers already paying for the real estate. We've orange pilled a lot of people, probably 1,500 investors this year. Never explaining the Bitcoin. Like, my Bitcoin audience is completely vacant of any data. They're just getting the real estate that they understand with some Bitcoin that has some upside potentially. But after that couple panels ago, I'm like, fuck it. I mean, the whole 40 minutes, I'm like, I'm losing all my money right now. So,
CJ.
CJ Constantino's People's Reserve.
Jay Bose, I'm CEO of Private Key Capital and also the Bitcoin Benz Crypto Clubs. So we started as a grassroots organization to educate people on Bitcoin, but soon we have, become an investment team as well, and we just recently bought a credit union in El Salvador where you are allowed to custody Bitcoin in a banking regulated financial institution. And over the last 7 months, we have developed the architecture and the platform. And last week, we did the world's first Bitcoin transaction from Washington, D.C., cross-border, on-chain, directly into a regulated financial institution as a deposit into our credit union called Private Key Capital. So that's our claim to fame. It's written on the blockchain. It can never be erased. It's the first financial transaction into a regulated institution.
That's almost a round of applause. Yeah, for sure. Incredible work. And as I was saying to you before, we need gentlemen like you and men and women to lead this thing forward, and that's a beautiful way to do it. Hi, everybody. John Devine here. I'm from Blockfills. Blockfills, we're an institutional market maker and liquidity provider. We started off serving hedge funds, Bitcoin mining companies, Bitcoin whales, but now we're seeing, I think the largest, the growth of our client base is from family offices, actually. So family offices are coming to us kind of for, some insight on the market and how to get into Bitcoin, and I'll talk about that on the panel. Also, these digital asset treasury companies are becoming big players as well. My background is in precious metals markets and volatility markets in Chicago. I made a market there, and I'm taking all the stuff from precious metals and applying it to Bitcoin. Oh, and I wrote the book on Bitcoin options, which I think I see, thank you, and I think I see some books around there. If you want to talk to me about Bitcoin options after the panel, come find me.
All right, so before we start digging into the content of the topic here, I'm very curious about the people that we have here right now. How many of you, and please don't be shy, how many of you would say that you have a fair understanding or you think you have a fair understanding of what Bitcoin is? Okay, about a third of the room. And how many of you barely understand it all, would like to learn more? Couple. And then the other third is just like, whatever. Okay. Fair enough. The topic of our panel is to basically how do you integrate digital assets, considering the more traditional assets you might have seen. So like real estate, art, gold, things like this, things that many of you are probably very familiar with. What's happening right now is that this whole digital asset ecosystem, Bitcoin especially, as well as stable coins, things like USDT, they're starting to present what is looking like very disruptive technologies and rails that the world really has never seen before, and the world is having to adapt. So that combined with like AI, what's coming with robotics, creates a situation where if your intention is to manage wealth going forward into future generations, you may need to start thinking about how this stuff is going to impact you and your traditional financial investments. So all that said, if we can start with sort of a high-level overview from each of you guys, or your view, do you see Bitcoin as sort of a temporary thing? Is this a fad? Is this something that's like gained a bunch of momentum? Or do you have conviction that Bitcoin is going to succeed long term?
I was in the restroom and a guy asked me, he's like, hey, are you orange pilled? Did your brother orange pill you? Do you have conviction now? And I'm like, I look at Bitcoin's price every hour, so I clearly don't have conviction. Now, but I don't think it's going away any more than the U.S. dollar is going away. The U.S. dollar is not going away. I don't know why everybody thinks so. The dollar is going to go away. 81% of all the trades on planet Earth are in dollars. It's not disappearing. All the other money is garbage compared to ours. We're the greatest country on planet Earth. We have the best opportunities on planet Earth. If you're a young person and you live in America, you have more opportunities here right now than you had 30 years ago. So this is a great game. Now, whether you trade in dollars, like if I was a kid, I'm going to go hustle dollars, take the dollars, and buy Bitcoin. And I just, I've been doing this as a real estate person for years. Like hustle a dollar, get a dollar, and I'm trying to improve the value of the dollar. And I don't understand the stock market. It's not going away. The stocks will go away, but the market itself, the marketplace won't go away any more than Bitcoin's going to go away, or the blockchain. And maybe Bitcoin fails. I don't know. That's why we put the two together. If I lose the Bitcoin, I at least got my real estate. And if Bitcoin's a real thing, maybe it is. It seems to be. It's better than gold. I'm 67 years old. I've never owned a piece of gold in my life. I've never had anybody offer me a piece of gold. I've never thought about, okay, I got to give somebody gold to trade something. But so I think it's going to be here for many, many years.
Thank you. CJ, I see you over there shaking your head.
Out of love. Yeah, I mean, when I started buying Bitcoin at $150, it definitely could have disappeared. There was a lot of risk there, a lot of network risk. But what we've seen is the maturation of the marketplace. And what we're watching happen is actually fascinating to see it happen so quickly. Because we look at the world and how they transitioned through money. And we went from yapstones and seashells to precious metals, and then to currency units, and then to banking systems over the course of thousands of years. But what we've seen in a very short period of time is a new engineered money break onto the scene. And already we are seeing the monetization of the asset class. And what do I mean by monetization? Well, we're turning a speculative asset into a real world money. That is a really important concept, and it's happening at an accelerated pace. And then what happens next is the financialization of the asset class. And I think if you look at real estate and what happened to the dollar in 71, they removed gold from backing the dollar, and the genius that is about to speak after this panel, he likes to call it land banking. And what happened is that real estate, it became a store of value. It became monetized. And after it became monetized, when it became a good collateral, it became financialized. And we saw all types of products built around it: home equity lines of credit, second mortgages, all different types of financing options. This is what happens when something gets integrated into the system. So, when we first started, none of that existed. It was the wild, wild west. But right now, I think the way I see it, I call it the 5-5-5 plan. 5 years of monetization, 5 years of financialization, and 5 years of full-on integration. So for these next 5 years, we're going to see companies race to acquire the most precious form of capital in the world, which is Bitcoin. And that leads to the monetization of the asset class. But what comes after that is going to be, and it's kind of starting right now, that's what we do at People's Reserve, and I think that's what Saylor is doing with digital credit. So we see digital credit fully backed by Bitcoin, and we see Bitcoin-powered finance, which is Bitcoin's fusion into traditional financial products. So, preferred perpetual versus a Bitcoin-powered mortgage. And that financialization, the build-up of these products and services around this specific asset class is cementing this asset class within the system. What comes after that, I think, is 5 years of full-on integration. There will not be one balance sheet. There will not be one model of business that doesn't incorporate, some way or another, Bitcoin into it. And you have that 5, 5, 5. And in 15 years, Bitcoin will have done to finance and money what the internet did to shopping. And it will be a completely different world. Financial services will not be recognizable. That is the rate and pace of adoption that we're seeing with Bitcoin, and it's accelerating.
I'm recovered.
Feel better. Great.
Thanks, Alex. First off, really appreciate being here. And John Drew, my friend here, has brought together the old guard and sort of the new guard, right? The guys in Bitcoin shoes. And it's an interesting confluence because in many ways, what you guys do, most of you do, is you manage portfolios. What we do is we manage protocols. And what does that mean? It means that we now have a construct. We have a construct called Bitcoin, which has its own rails. So we are essentially able to go into a world where we don't have to trust a counterparty. We go into a world where it's permissionless. You see, when you breathe, you inhale air. You don't ask for permission. When you sign off with a signature on a Bitcoin wallet, you're not asking anybody for permission. When we were sitting in Washington, D.C. on October 28th at 3:28 p.m., why do I know that? Because that's the moment we transferred Bitcoin from Washington, D.C. on-chain, cross-border, across countries, into a native Bitcoin wallet in El Salvador Credit Union. It deposited within minutes. There was no SWIFT. There was no bank. There was no overnight deposit. There was no reconciliation by a clerk the next morning. There was no T+3, none of it. I didn't wait for a person to give me a little rubber stamp and tell me this is legal now, or this is right now, or a piece of paper. Those constructs are over. This was a shot across the bow. This was no demo. It was a demolition of the existing system. And it won't crumble tomorrow, but it's coming. And you guys are the early listeners, at least, if not the adopters, of what is inevitable. There's a sound of inevitability. Bitcoin is a store of value. Saylor has already proven that, right? He's going to be here. What we are doing is we are unleashing that thermodynamic energy that is stored in Bitcoin. Without selling it, we can do credit for it. CJ is going to build us stable coins based on Bitcoin reserves. We're going to create yields that based on all kinds of different instruments. So when you go from a $2 trillion to $3 trillion market, which is the store of value, this is the mathematical fortress. It's built on math. I have thousands of mining rigs all around the country and the world, from Dubai to Guadalajara to Texas. And when we mine Bitcoin, it's energy. You know, most people think money is little digits on your screen. It's not. Money is your labor. Money is your effort. Money is your energy. It's your trust in the system. That's what money is. And Bitcoin has a very low surveillance surface, as they call it. You know, it's cryptographically encapsulated in a SHA 256 function. You don't need to understand how your iPhone works. You just use it, right? Same thing. Understand that there's a tremendous amount of mathematics which has never been hacked into, never been cracked into, never been broken. And once you put that energy, your energy, into this thing called Bitcoin, it lives forever. As long as you don't lose your keys, it's yours. No bank can take it if you self-custody. And in our bank, we have actually patented this. We have a multi-key system, multi-sig, it's multi-signature wallet, but you actually have your own wallet. There is no central Nostra Vostra account where all the Bitcoin go in. Each wallet is tied to your savings account. And this money, you can see it every day. You have the keys to it. It's yours. We always say in Bitcoin, your keys, your money. There is no one custodying it. There's no bank telling you, oh, gee, you spent too much money putting gas in your SUV, so I'm going to hold back and not let you use your PayPal account. That doesn't happen. You see, it's freedom money. And once you start to understand the difference between the Federal Reserve and 12 guys in suits sitting and deciding what to do versus the market and the people deciding what to do, the equation changes fundamentally. So Bitcoin is here to stay. There are new products that are going to be developed. And yes, I do not expect the banks and the financial institutions to come up with the innovative new products. It is us guys who are going to develop it, we'll prototype it, we'll get it into the market, and then that'll be replicated across thousands of different financial institutions. So yes, I've had 20 years in Silicon Valley, and I know software, and I trust software more than I trust in humans. So here we are.
Yes, yes, yes. I had a hard time controlling some of my emotions there because you're spot on it. And so the question for us up here is, how do we generate that aha moment? And for me, it was, I have a background in energy systems. And so I started digging into Bitcoin, and I'm like, okay, pristine collateral, pristine collateral. Why is this pristine collateral? Everyone keeps saying this word. If you're going to write anything down from what I say here, I would say write down the double spend problem and write down the Byzantine generals problem. These are two extremely difficult computer science problems that were being worked on for, 30 years.
Don't forget the Austrian economists.
Well, of course, we need the Austrian economists to support us in our thesis. But these two computer science programs were tried to be solved for 30 years or something like that before Bitcoin solved those problems. Satoshi solved these two extremely complex computer science problems that allowed us to have Bitcoin, and that is why it's pristine collateral, because they solved those issues. And go do some research on your own time. I'm not going to get into the details of those problems here, but once you read about those things, I think you'll have a little bit of a light bulb if you're still looking for it. And then, kind of going on what you said about money and energy, money is human technology, and it stores and transfers human time, energy, and effort. If you want to debate me on that, I'm happy to. I'll be outside. But I've been thinking about that question for, 15, 20 years. What is money? Why are we going out into the world every day and expending ourselves? In return, we get these things called US dollars. Well, we're giving away our humanness for these dollars, right? But then you start to ask the question, what's a dollar? And then you begin to realize that dollars have fractured the laws of thermodynamics. Energy can neither be created nor destroyed, only transferred. And these people are creating dollars out of thin air, and they're asking you to give away your human time, energy, and effort for pieces of paper. Think about that for a second. So we've busted the laws of thermodynamics, and we're basically in an indentured servitude society, giving away our time on this planet for pieces of paper that are being created out of thin air by some guys in an ivory tower. That's crazy, and that's why Bitcoin's inevitable. Because once people figure out that these pieces of paper that they're giving away their humanness for are worthless, we need money that's based on the laws of thermodynamics, and that's what Bitcoin is.
Can I add one thing just to make it even more real? When we mine Bitcoin, it costs us, the power cost, it's cost me $48,000 to make one Bitcoin. I pay those bills every month. That's the cost of energy, which is being converted into this digital product called Bitcoin, right? When you print paper, there is no such cost. This is conversion of energy into a digital currency, which is real. It's the sound money. When you print something with nothing, it only buys you illusions, which is what paper money is. Whereas this is based on actual energy conversion, which is why, by the way, we won't get into it right now, but the convergence of energy, mining, and banking is a triumvirate that's going to start to happen. Future companies, actually the Bitcoin mining companies will become the treasuries. This is where Bitcoin is minted. That Bitcoin becomes the digital capital for the bank. And that digital capital converts into digital credit. And that digital credit produces cash flow. That cash flow goes back into mining and energy creation. And that is a regenerative process. It's a nuclear reactor called Banking 2.0. And that's what private key capital is going to be building as a prototype. A vertically integrated stack where energy, mining, banking tied together into a comprehensive model, which doesn't exist today. We have to prove it out, of course.
Let me hop in here because I feel like I agree with what Grant said. The dollar isn't going anywhere, and governments are not going to give up their ability to print the dollar, and other governments are not going to give up the ability to issue debt. Like, I don't see that happening ever. But I do believe we are working towards that future, and it's going to be a better system that empowers the user by delivering value, because the traditional system extracts value. But let me see if maybe I can act like a bridge between right here. I just happen to be sitting here, but I'll bridge these ideas, right? Think of Bitcoin as a savings technology, and think of the dollar as a spending technology, right? So when you earn dollars and you need to spend them, you keep them in dollar form. It's a currency. So know the difference between currency and money. Money is a store of value. Currency is a medium of exchange, right? Bitcoin cannot be used for eggs and milk. That's why we have great companies like Blockspaces working on technology that allows for rapid changes and increases in the velocity of money, right? Gold was a great store of value. We needed paper currency units to increase velocity, to promote economic growth. So there are blocks to the technology that make it a bad currency. If you're making a big purchase, okay, no problem. But if you're making small micro purchases, that's not really what a store of value is for. That's what a currency is for. So I see in the intermediate term, a world where we have to balance both of these mechanisms, both of these tools.
Yeah, for sure. So what we've seen so far right here is you've seen the full spectrum of people who are interested in Bitcoin, right? You've got on the far end very impassioned believers in what Bitcoin might promise as a form of money. Also, people who are a little more traditional, looking at it from a little more traditional perspective. So I'm going to actually direct this to Grant, because you're, from what I understand, fairly new, relatively speaking, to Bitcoin. What's got you switched onto it? You don't think the dollar's going anywhere?
I mean, this conversation kept me from Bitcoin. Okay, this idea that, like, guys, I exist in a fiat universe. This is money is not useless. I have not traded my humanness for fiat. I have offered tremendous services to the marketplace for 40, 50 years. They paid me in cash. Okay. That's what they had. There's nothing wrong with this fiat thing that we have. Like, it's better than trading donkeys and eggs. And it's better than gold. I don't want to drag gold around with me everywhere, okay? And I don't want silver jewelry to like this is a trading mechanism, okay? Is it perfect? No. Bitcoin's not perfect. Okay? There's nothing perfect about anything. Like, how much can I accumulate, though? How much can I accumulate, and how much can I help other people accumulate in that process? And you know, can I find something? Look, I'm a real estate guy, but I hate the plumbing, and I hate the roof, and I hate the gutter, and I hate the evictions and the termites and the tenants and all that stuff. That's how you got to talk to me. You want to convert me? You got to talk to me about, bro, I got something here. You could add it to your real estate purchase. Real estate's real. It's been around 2,000 years. It will be around 2,000 years from now. Even if you 3D print, you figure out how to 3D print for nothing, the price of the land's going to explode underneath it. So even if you come up with a solution to handle the housing, people have to live someplace, and I cannot live in my Bitcoin. Okay, you know, I've never touched a piece. I can't sleep on it. I can't have sex and make babies. I can't, like, it does everything, guys. Like, it doesn't, like, and when you talk to me about it doing everything, it prevents the fiat universe, the legacy people that would be interested in it from moving into it because it's so radical. So that when we introduce people like, hey, I have a real estate project. It's a $230 million real estate project in Boca. Takes up an entire block. I can show him a picture of it. It has 366 tenants. It's got $10 million worth of EBITDA today. We walked in, there it is right there. People live in it, okay? Bunch of Madami people. We're running Madami ads on this piece of property right now. True story. We have a Madami special going right now, okay? No application fees. That's a true story. It's in Boca Raton, Maine. Started running the Madami ads. We've already gotten phone calls. Hey, if you're escaping New York, no application fees, okay? No communism talk allowed on the property, all right? No taxes, no gun permits. Come do whatever the hell you want to do. Cougars, welcome down to New York. We run all these ads and promote stuff, right? Well, guess what? That is the largest real estate Bitcoin deal ever done on entire planet Earth. Okay, we're 2 weeks from finishing this. I bought it out of bankruptcy. Property's worth $335 million. We paid $235. And I stacked the difference in Bitcoin on top of it.
So you bought $100 million worth of Bitcoin.
Yeah, about 833 Bitcoin.
And how is this being received by the people?
Well, this is the 10th one we've done this year, so this has been extremely well received. Okay, we'll end up with about 800 investors in this. 70% have zero Bitcoin, own no Bitcoin. Okay, 50% of them never invested with me. They knew I'd been buying real estate for 20 years, but the real estate wasn't sexy. I mean, it's sexy real estate. That's as sexy as you get. It's as good as you get. It's trophy real estate. But it's like the returns are just boring. They're very boring and stable, but they're predictable. And people understand. 99% of planet Earth understands real estate. They either live in it or they pay for it or they invest in it. And so we put these two together. I met with Mike, my brother and I. Gary's in the room right now. Me and Mike and Gary met about a year ago. And Mike says, you need a public company. I don't have a public company. So I started building these to see how the marketplace would respond to them. And our investor was older, went up about 20 years in age. Not younger, older. Richer, okay, and half of them had never invested with me because the real estate was boring. And the check size got bigger. And by the way, I don't spend any time on any of this fucking crazy shit y'all are talking about. Like, it's so intelligent. You guys are so intelligent. Like, it leaves me out of the game, right? You need to talk to me the way I understand money. And I don't even understand the U.S. dollar, so I'm not ashamed that I don't understand Bitcoin.
If you did, you wouldn't want to hold it.
Let me jump in on this because I think you make a great point here. What does Bitcoin do? What is the problem that Bitcoin solves? And when you look at the dollar, this is really interesting. And maybe I'll share the answer first. What does Bitcoin solve for? Trust. Okay. Now, what's the problem with the dollar? What's really amazing, and some of you guys know I'm a Bitcoin maxi, and if you don't, well, there you go. I'm a Bitcoin maxi. However, you have to look at the world at how it is, and you have to look at the systems at what they do. If the U.S. government was not spending $2 trillion plus more than they were taking in taxes. In other words, if they were not deficit spending, the value of the dollar would actually go up and the economy would experience deflation. So it's not that the dollar is actually shitty or broken. It's that the people and system who are leveraging the dollar are abusing the system and therefore abusing the trust. If we had, I don't know if I can use this word, if we had competent leaders who had economic sense, we could fix the problems like this. When we had an inflation problem after COVID, and the Federal Reserve comes out and says, you know what? We need to fight inflation. And you know how we're going to fight inflation? We're going to raise interest rates. We are going to punish the economy for the sins of government spending. You could have fixed inflation by simply saying, you can only spend as many dollars as we bring in taxes. You wouldn't have had to raise interest rates at all. So there's a balancing mechanism within the system, and the people who are in control of the system are abusing the system. And therefore, I'll just ask you this question. You trust the government more today or more yesterday, right? Where's the trust trend going? That trust trend is going down, and that's what people understand in simple terms. I cannot trust the budget of the United States government. I cannot trust that they are not going to continue to deficit spend. We got to replace. The thing is we don't owe dollar liabilities. We got some knees, we got some hips, and the price of those, they keep going up, and they keep going up radically. And because of that, we have to keep printing more and more money. We might be $38 trillion in debt, but we have over $200 trillion of unfunded liabilities. And that's going to continue to grow as they continue to abuse the currency system. So what does Bitcoin do? Bitcoin says, you can trust me because it's a mathematical-based protocol. You do not have to trust a human. You can trust the math. And we leverage that cryptography for absolute digital scarcity. And then we tie that scarcity to energy. And then that is what you can trust. So it's the trust component that blockchain itself and Bitcoin, blockchain was created for Bitcoin because blockchain it's like an Excel spreadsheet. Why not just use a banking Excel spreadsheet? Because you can trust and you have transparency. So it's trust and transparency. That's the problem that Bitcoin solves for. And yeah, the dollar would work fine if it weren't being abused. But we'd be very naive to believe after watching all of world history and monetary history that the governments wouldn't continue to abuse the printers and to extract value. Bitcoin does what nothing else can do by preventing the powers that be from extracting value from you. That's why Grant wants to take that cash flow and store it in Bitcoin, because he knows when he stores it in Bitcoin, it can't be ripped from him. But he still needs the dollars to operate. We still need the dollars to spend. It's a spending technology. But I just wanted to address that's the real solution. It's a trust
I had
solution.
somebody say, hey, do you take rent in Bitcoin? I'm like, I wouldn't even trust the tenant that would want to pay their rent in Bitcoin. I'd be like, go back and look at the application. Something's wrong with this person.
Explain yourself. Why? Why is this?
Well,
no, wait. That was to Grant.
what was
Explain
that?
What is this?
Well,
why aren't you going to trust them if they want to pay you in Bitcoin?
I mean, it doesn't make any sense, man. Go out and get the.
Why?
Because you can't replace the Bitcoin as easily as you can replace the paper. Look, I don't have a problem with the government printing. I have a problem with the government taxing. Okay? Don't tax me and just hit that printer as much as you want. Just don't tax me. I like printing, okay? Print it. I hope Donald Trump prints $10 trillion in March or May of next year. I hope he just hits it and bang, prints it. You know why? Because I'm a hustler. I'm a hustler, and I'm going to be right there at that goddamn printer the day they hit the print button, and I'm going to get my goddamn fiat. I'm going to stack it, rack it, and I'm going to convert it into better assets, and that's the game. You got you family offices, okay? How do I get money? Where do I put it? And how do I multiply it? Because you cannot save it. This idea that you're going to save money is impossible. It has never been possible. It's indoctrination by the banks. Save your money here. It's a great ad. If I was a bank, I'd say save your money here. But it's impossible to save anything. Energy, money, love, anything. You have to create. And so I get it, and then I want to construct something that's bigger and better and that can multiply.
That's inflation. Inflation is a hidden tax.
Inflation is great.
It's
Inflation
tax.
is awesome.
It is a version of tax.
But I love it. I love inflation. I just don't like both of them. I don't like the printing and the taxes because I feel like I'm at a Diddy party.
Okay, so I didn't see this panel going this way. Let's talk about some solutions and ways you can integrate Bitcoin and digital assets into your portfolios. Just about everybody up here has some product or service that does something like that. Let's talk about the spectrum of it. Let's start out down on the end. Let's go with Jay and then John and come this way.
Great. Yeah, just to give you a simple analogy, there's a hole in the bucket, dear Liza. You know, there's a hole in the bucket, and you can't save money in something that inflates out because the government printer's going brr. Okay, so if you got a hole in the bucket, you can keep on
Okay.
putting that savings. It
We got
doesn't work.
5 minutes.
All right.
Stop trying to convince Grant. Leave him alone. Solutions.
Solutions. So number one, we talk about Bitcoin preserving value better than almost any asset class that we know. In fact, we have people who are pulling out money out of their home equity and buying Bitcoin because they believe that it's a short the dollar, long the Bitcoin play all day long, because home equity is going to keep decreasing potentially, or there's a risk to it, whereas over here they're able to take their labor, their hard-earned money, their hard-earned equity, which they have paid for over years and years, and putting it and transferring that asset very simply into a more sound money, right? So that's a very simple product which we have, which our members of our club constantly use and do. So you're holding an asset, you're diversifying your portfolio, and potentially getting an appreciation of up to, if all the projections are what they are, at least 30% a year. So even if you're paying a 5-6% interest to pull the home equity out, you're still making 24%.
Okay,
Right.
time's up. Lightning round.
All right, so
John Devine,
yeah,
talk to us about
I'm going to
options.
talk. I'm going to talk about selling insurance. Okay, so we're going to sell insurance on Bitcoin. That's what I'm going to get in here. Let's say you've gotten there. You want to allocate 1 to 3% of your family office into Bitcoin. What do? You can go buy spot Bitcoin. Done. All right, but I'm going to say, what if you could sell insurance into Bitcoin, get paid on dollars, annualize like 10% on US dollars for the obligation to buy Bitcoin? The exact example I'll talk about is the March 2026 options market. The 80,000 strike put, which is just about the production cost for Bitcoin right now, that's paying 10% on cash. So you sell the 80,000 strike put option, you are now obligated to buy Bitcoin at $80,000, and you get paid 10% on that cash. You can take the premium in Bitcoin if you want. So like when I talk to a family office, I say, look, don't just go buy spot. Come in and sell insurance to the market. I'll pay you a premium for it, and now you have an obligation to buy Bitcoin. And there's no leverage. It's all cash secured. You have the dollars behind that insurance policy or behind that put option. That's my biggest message to any serious investor who's coming into Bitcoin, because it's very easy to chase this market, and that gets you into trouble. The second thing I'll say is, once you have Bitcoin, once that insurance policy obligates you to buy Bitcoin, now we want to talk about liquidity. How do we access dollars from pristine collateral to operate in our daily life against that Bitcoin holding? And so what we do now, we lend dollars against Bitcoin collateral, typically at 65, maybe 70 LTV. And what we do in that case, or what I would talk about there, is buying insurance so that there's no liquidation on the loan. So you have Bitcoin collateral, you're borrowing US dollars, you're paying 8.5%, something like that. You attach insurance to that product so there's no liquidation risk on the collateral. Those are two routes into this market. First, selling insurance. Second, borrowing against it and buying insurance. Of course, we can generate cash flow by selling call options against Bitcoin. Bitcoin is just like any other commodity or stock. You can sell upside insurance, which that's what a covered call is. And if you think about that, when you sell a covered call, you can generate a yield. You can then take that premium to finance your insurance at zero cost. So you own Bitcoin, you borrow dollars against it, you sell a call option, and you pay for your insurance. So those are the three routes that I like best for a family office coming into Bitcoin.
Very good.
That's a no-brainer, by the way. If you're coming into this market with size, get paid to buy. That's common sense. What I see the future of what's happening here is that Bitcoiners will become the risk-free lenders. So if you're looking for exposure, someone like Grant comes to People's Reserve and says, look, I got a luxury property. I need $350 million. We know there's a Bitcoin component there. He's buying it at a discounted rate. He's integrating Bitcoin into the property. That means it's not just the real estate that's securing the loan. Bitcoin is securing the loan as well. And because Bitcoin is an engineered money, and on the earlier panel I was on, turning that duration risk into a duration benefit, I will let this man borrow money as much as he wants, infinity, because he's integrating Bitcoin as a collateral component. That reduces my risk as a lender, and that means when you're looking for exposure for cash flow, you don't want to go to the guy who's going to promise you that this luxury property is going to bring down those people from New York. You want to go to the guy who's going to integrate Bitcoin into the property, and that extra layer of security reduces risk, it reduces cost of capital, and that is really the future of finance.
All right. Grant Cardone, you get the final
No,
word.
I mean,
1 minute.
exactly. In 3 years, in less than 3 years, you will have a model where the debt market will give me a loan. Fannie, Freddie, CMBS loan will give me a long-term 10 or 20-year loan on that asset because I have that much Bitcoin, because it provides liquidity 24/7 on an asset that's not liquid, but the cash flows. You got the two combinations of two superpowers putting those two things together.
Fantastic. Thank you, gentlemen.
All right, Mia, you got a track? Well, that was interesting. I love the fire. Great conversation. Oh, look at me in the way.
Nice job up there.
All right, we're going to do a quick reset. And thanks, everybody, for making it here to the afternoon.
Everyone should be able to save and protect their wealth across generations. We built this company so billions of people around the world can take control of their financial lives. We've reimagined savings and protection from the ground up with digital money and modern technology. We're the world's first Bitcoin life insurer. For the first time, people can save, protect, and pass on their wealth entirely in Bitcoin. 4 years ago, we started working directly with individuals. Today, as the Bitcoin economy has grown, some of the world's largest and most conservative institutions are joining us in our vision. Every economy is built on patient, long-term capital. Bitcoin is the foundation of the next phase of global
Finishing
finance.
strong this afternoon, and I might say we have finally arrived right where we began this morning. The era of transformation, the digital transformation of money and wealth. And of course, today we're joined by a gentleman, in fact, two of our gentlemen you're about to see on stage, who personify the conviction and boldness and courage that it has taken to forge the greatest monetary transformation in history. And I'm so glad you're all here to be a part of it. Who is right? All right, well, without further ado, everybody, please welcome the executive chairman, of course, of Strategy, Michael Saylor, and our interviewer, Kareem Moji.
You guys are wired up?
We're all set.
Have fun.
Thanks, Jack. Welcome, Michael.
Here we are. A lot of orange in the room. We appreciate that. It's the orange state, orange room.
So, Michael, you've said we're living through the greatest monetary transformation in history. What precisely is changing in global finance?
You know, if you trace the arc of human history, right, we use lots of things for money. We use seashells, we use glass beads, we use copper tokens, we use gold coins, we use all sorts of credit networks. If you think about capital, that is long-term economic energy, wealth. In the 20th century, capital was either equity capital markets, so private equity and especially public equity, and the money, the long-term money in equity capital markets is the Vanguard 500, which became the S&P 500, became the S&P, the equity index. And then you have real estate capital, New York City, London, the Gulf Coast, Florida, right, the West Coast, scarce desirable real estate, and you know, that drove the mortgage industry and it drove the commercial real estate industry. And then you have fiat capital, sovereign debt, and credit, and then you have corporate debt as capital. Do I own corporate shares? And if you're wealthy in the 20th century, you owned a sports team, a trophy asset, equity, private equity, public equity, maybe some bonds, a lot of real estate, most likely, and a little bit of art. So that was the capital markets in the 20th century. Now we have digital capital. Satoshi's breakthrough, the singularity of Satoshi was the idea that perhaps by knowing a secret, if the secret was a private key that gave you access to a monetary network or a piece of a monetary network, then you could hold wealth in your head. So for the first time in human history, we could tightly bind economic energy to the individual or the corporation through something that they knew. And that solved a problem that the pharaohs couldn't solve. How do you take your money with you? It's a problem that you would like to have solved if you were a Protestant in Catholic Germany or a Catholic in Protestant North Europe, or if you were Jewish anywhere ever in the history of the world, or if you were a Muslim when the Catholics took over, or if you were a pilgrim or a Puritan, or if you look at the entire history of the United States, it was always some group of people fleeing some other group of people pursuing property rights. And the one commonality in human history is there's 100,000 incidences of one group fleeing another group, and it's very difficult to take your money with you. Very, very difficult. You can't take the building with you. You can't take your stock portfolio with you. If you get out of favor, let's take Roman Abramovich, got very out of favor. The West took his sports team, took his buildings in London, took his villa in the south of France, seized his yachts, impounded his equity portfolio, impounded his bond portfolio, took all of his credit instruments, and the only thing you have left is your Bitcoin, right? Which is interesting. So what is Bitcoin? It's basically economic energy that you can carry with you to the grave, that you can control, that no one can take from you. And so the inflection point is the point where you could own something without the permission of someone more powerful than you. And that's an inversion. And it's an inversion of property rights. It's a singularity. It's a revolution. It's a paradigm shift. And of course, it starts as this ideological paradigm shift. Am I libertarian, or am I an Austrian economist, or do I believe in freedom and the like? But what follows is the spontaneous formation of a global network, and that network right now has 750 million people that believe in it. The crypto industry has 400 million people that believe or hold some form of Bitcoin. It is a global viral protocol which is manifesting property rights and economic empowerment. So the digital transformation of money wouldn't be possible without the creation of digital property or digital energy. That is something conservative in cyberspace, that if I send you $1 billion of Bitcoin by transferring a cryptographic approval to you, I lose it, you have it. If I send 1 billion videos or 1 billion songs, I have it and you have it. Information is non-conservative. Energy is conservative. The conservation of energy is necessary to create anything of substance, of matter. And so Satoshi marks the singularity where energy flows into cyberspace and then digital networks come to life. And what's the killer use of energy? In this case, the killer use of energy is something that matters, the creation of matter and the creation of capital. So we formed a digital capital network, if you want a simple semantic representation, call it digital gold if you like, but digital gold understates it so much. It really was the spontaneous creation of a network to move capital and the capital asset. Call it a bank in cyberspace, if you will. And a bank in cyberspace where you could put your money and store it forever. But the breakthrough is, how do I move capital through time and space? And it's one thing to take, you know, what's the value of every building in Naples, Florida? It's one thing to move the value of every building from here to Tokyo in 10 minutes. That's interesting, moving money through space. But it's an altogether different thing to how do I move the money in time 100 years forward. So the transformation of economic energy through time and space, that is the big idea. And of course, it only works to the extent that people buy into the protocol. Like if I had English language and it had a word for everything, but only you and me spoke it and nobody else spoke it, the protocol's not so valuable. If that table uses Arabic numerals, but everybody else uses Roman numerals, right? It's a protocol that's 100 times better, but no one uses it. So Bitcoin is this viral protocol. It's spreading, and how important was it in 2009? Not very. How important was it when I got involved 5 years ago? It was like a $150 billion network. How important is it today? It's a $2.5 trillion network. How important will it be in time? Well, when it's 25 trillion or 250 trillion, all of a sudden it starts to be very meaningful. So I think we're very fortunate. We're living in a time where we have created digital capital. And now, what do you call it? Well, some people think of it as digital money. It's not money like a medium of exchange. It's money like a store of value. It's long-term capital. Some people call it digital capital. It's a long-term store of value. But the network itself is a digital network. You can move it around. And what's most interesting to me, I think, is in the last 12 months, we're like, what's the date? November 6th?
November 6th.
1 year anniversary from the red sweep. So 1 year ago, there was a red sweep, and one of the things that got settled was, is Bitcoin a digital commodity? Yes. Is it digital gold? Yes. Is it digital capital? Yes. Will the banking system of the entire world embrace it? Yes. All of those things were settled a year ago today with the red sweep. You now have the Secretary of Treasury, Scott Bessent, last Friday, tweeted Bitcoin's been running uninterrupted for 17 years. Right? That's the Secretary of Treasury. 4 years ago, people said, oh, well, basically we went through this evolution. Bitcoin is tulip bulbs, it's a scam, it's a criminal enterprise. That was the hyper haters. And then we got to well, I admit it's better than gold, it's better than everything else, but it's too good to be true, so the government's going to take it away from you. Right? We lived through that stage from 2020 to 2024. It's like, well, I get it, but the government's going to take it away from you because it threatens the establishment. It threatens the dollar, it threatens the banks, it threatens the United States. And that got settled a year ago, and what's happened in the last 12 months is the President of the United States said, we're going to be the Bitcoin superpower, we're going to be the crypto capital of the world. Secretary of Treasury says, we're not taking away from you. In fact, it's good for the dollar, it's good for the United States, it's good for the world. Not only are we not taking it away, we want to be the leaders and we want to own it. So I think this is a very exciting year because at this point, you can see the market spoken. You've got $2.5 trillion of economic energy in this thing. You can see that the political sentiment has shifted, the Overton window has shifted, and now we're not at the end of Satoshi's experiment. We're in the first year of institutional adoption of digital capital and everything that flows from digital capital.
So we've talked a lot about portability, store of value, ability to actually transfer wealth. What would you say is the opportunity for wealth creation associated with this?
Yeah, that's very exciting. I think, so first of all, we'll just take some simple numbers, right? Like Bitcoin's been going up 50% a year for the past 5 years, 80% a year for the past 8 years. I anticipate it will appreciate about 30% a year for the next 20 years. So you want a simple number in your head. In US dollar terms, 30% ARR for the next 20 years. When you get to the out 20 years, probably you're 20% a year. So the terminal velocity of this thing is 20% ARR, 20 vol type asset think in that terms. Now, once you think about that, you put yourself in the position of, I'm an individual, I'm a corporation, I'm a government, how do I cash in on this? Well, I joke about it, but it's a simple mnemonic. If you want to 10x your money, you just buy Bitcoin and wait. If you want 100x your money, you buy Bitcoin with somebody else's money, right? And if you want 1,000x your money, you buy Bitcoin with someone else's money, and then you lever that, right? And so what does that mean now? Well, you can simply just take your long-term portfolio, which is probably divided between equity and some bonds and some real estate, and you can start to allocate some to digital capital. And the portion you allocate will grow 30% a year, and what is real estate's 5, 6, 7% a year. The S&P is like 14% a year. Gold's about 14% a year. Money market funds are giving you 2% after tax, or about 2%, less in Europe, a little bit more in the U.S., but on a tax basis. So you're not getting rich by holding money market funds, for sure. So you could just allocate some or all to digital capital. But if you knew that something was going to go up 30% a year, then that means that any money you can borrow at less than 30% a year is going to be accretive, right? So you could, you can just go ahead and take a mortgage on your house, draw the money out of your home equity, buy Bitcoin. You're paying 5% or 6%, or When I first suggested that, people thought I was crazy, and the mortgage rate was 2.75%. So. Right? If the government wants to give you a subsidized mortgage, then you just draw down debt against a long duration real estate asset, and you invest it at 30%, and you scrape the difference, and that's kind of not that complicated. It turns out that the most creditworthy organizations are companies. Right? So you want to make a lot of money, you form a corporation. Corporation's a great wealth creation vehicle. So if you're a private company, how do you do it? Well, the world's full of people that have to buy private equity. So instead of raising $5 million to launch your whatever company, raise $50 million and put $5 million in the company and $45 million in Bitcoin. And the average company is growing 1%, 2%, 3% a year. And the 45 million Bitcoin component is a digital monopoly growing 30% a year, right? The VC will give you the money because the VC want to buy preferred equity, in a private organization. So if I had a private startup, I would just overfund it, and I would capitalize the treasury in Bitcoin and raise more, right? You raise $500 million in capital, you buy Bitcoin, you have a $500 million business. It's monopoly growing 30% a year. If you do nothing the rest of your life, you're going to be a mega billionaire. Actually, you probably only need to raise about $20 million to be a billionaire. If you raise $20 million, put it all in Bitcoin and wait, you'll be a billionaire in 10 years at the rate it's compounding. So not complicated, right? Let me say it a different way. You can raise money to launch a restaurant or a hotel chain or one of 18,000 software companies, and they're all very competitive businesses, or the next one of 5,000 banks or 5,000 insurance companies or whatever you want. The failure rate on a business is 95 to 99% over a decade. Eventually, if you're not Microsoft or Google or Amazon or Meta, if you're not a digital monopoly, you're running up against them. 27,000 retailers fail. Walmart powers forward. Amazon wins. That's the story of retail, right? Hotel. Every hotel company is a failure, right? Marriott doesn't own hotels. Four Seasons doesn't own hotels. Hilton doesn't own hotels. They all have management contracts. Why? Because the hotel business doesn't make money. Right? Restaurant, McDonald's is a REIT. They don't run restaurants. Their business consists of getting other people to invest in the restaurant because they know it's not going to work. You're a software business, you're competing against Microsoft. They have a monopoly. Microsoft's more powerful than the United States is. You could more easily leave the United States than you could exit the Microsoft network of your corporation. It's sad, but true. If you have to choose between American citizenship and giving up your passport or getting cut off by Microsoft, and once you look down at your Apple phone and figure out whether you're more afraid of being kicked out of Florida or having your iCloud account canceled by Tim Cook. Think about it, right? What happens if Apple just says, we canceled you? You'd rather be canceled by any city, any state, or any country than be canceled by Apple if you have an iPhone. So if you're running an operating business, it's very, very difficult. So what do you want? You want a monopoly. You want a digital monopoly. Okay, Bitcoin is a digital monopoly. It's a digital monopoly on money. It's the most powerful digital monopoly. So anytime you buy Bitcoin, you're merging your company with the digital monopoly growing 30% a year, unstoppable, that's global, right, with no attack surface. So if I'm a private company and I'm small, I want to raise venture capital, capitalize on Bitcoin, and then bolt it to the balance sheet. If I'm a big private company, I want to sweep my cash flows into Bitcoin because your big private company is growing 0 to 5% a year and Bitcoin's growing 30% a year. It's not complicated. You can either take all your cash. By the way, what do companies do with money? They give it away. They give it back to the shareholders, right? You can give your cash away via stock buyback. You can pay a dividend, or you can put it in a money market instrument that yields 2%, or you can invest it at 30% plus, tax deferred forever. Which of those makes the most sense? Corporate finance, and this applies to public and private companies. The conventional corporate finance theory for the last 50 years is, I want to run on minimal working capital. I want to buy back my stock, lever up, probably pay dividends, and if I have excess capital, I put it in treasury bills, short-dated ones, between 0 and 3 years out. I don't want to gamble the corporate money on equities. I don't want to buy long bonds, et cetera. I want to run working capital light. And if I do borrow money, I want to borrow the minimum amount. So that's corporate finance. And what does every big bank do? Every big successful bank, they beat earnings estimates, they raise their dividend, and they announce a bigger buyback. Everyone. Citi, JP Morgan, B of A, et cetera. What does every big tech company do? They beat earnings, they raise their buyback, they announce a dividend. Huh? Every well-run company in the United States is in the business of surrendering capital. Think about it. Here's my suggestion for your family. You have a lot of money, and you have it in stocks, and they go up and they down, and it's volatile. So why don't you just give all your money away to charity and have nothing, and your family net worth will not be volatile anymore. You see how stupid that is? It's literally the most moronic suggestion. Give all your money away, and your family's net worth will not be volatile anymore. That's what companies do. That's what public companies and especially public companies in the United States, that is the corporate playbook they teach you at Harvard or Stanford or Yale. And think about it. It's just literally the stupidest thing imaginable. NVIDIA became the greatest company in the world. They'll generate $300 billion in cash flow. How many companies in the history of the world have done that? One. How many companies are there today? 400 million. You're the most successful company out of 400 million companies. You generate $250 billion in cash flow in 3 years. And what is your finance strategy? Give it away. So what? So you just won the lottery, 1 out of 400 million, and you're going to give away the winnings, and then you're going to roll the dice again, hoping that you're again the 1 out of 400 million. Now you've got to ask the question, why is Xerox gone? Why is Kodak gone? Why is Intel in trouble? The company I worked for when I started my career was DuPont, right? It turns out in like 4 years, my own company created 4 times as much value as DuPont is worth. And when you look at it, DuPont gave away more capital in dividends and buybacks than they're worth today, right? And Intel gave away $100 billion of capital. And now the line is, well, we can't afford to build a chip fabrication or compete in the AI industry. Why? You gave away all the money, okay? Corporations are like type 2 diabetics. Sorry, type 1 diabetics. A type 1 diabetic is someone that cannot form fat cells, so you can eat yourself to death. And a corporation that surrenders its capital via dividends and buybacks as fast as it can becomes a Toys R Us, becomes one of the 19,000 bankrupt companies that are roadkill on the information superhighway. They cannot store economic energy. What is your life expectancy if you cannot store energy, right? It's weeks, months. The reason the companies last 10 years or 15 years on average, it's not because they're defective ideas. It's because they don't have any capital. They decapitalize as a process. So how do you make money? Well, if you want to make money, I'd say first you start a company. It's obvious. Second, you raise, remember I said buy Bitcoin with somebody else's money? Raise capital. Raise venture capital, equity capital, private equity. You have something that's, you have 20 million in cash flows. Well, go to a bank, get a $100 million loan, buy 100 million of Bitcoin, let it appreciate 30% tax deferred. You'll have $10 billion of capital by leveraging the 20 million of cash flows, right? Or you can just take the 20 million in cash flows and give it away as dividends, and you have nothing in 10 years. Or you can invest it in money markets, and the money is losing 7 to 10% of its value a year, and you're getting 2-3%, so you're like minus 5% at best. The cost of capital is 14%. That's the S&P index. So if you're not accreting capital faster than 14% a year, you're getting poorer. You're not getting richer in real wealth terms. And you can judge that, you know, an acre of land in Miami Beach was $10,000 in 1930. It's $10 million today. That's, someone's telling you, right, 2% is enough. It's not enough, right? I mean, think about 10,000 to 1,000x more expensive in 90 years, right? That's 7% a year, by the way, 7-8% a year, so that works out. So I think if you want to make money, right, as a corporation, if you're private, you find a way to raise capital and you buy digital capital with it, and as long as you're paying less than, if you're paying 10% or less and investing it at 30%, you're capturing the 20% spread. It becomes a finance exercise of how much capital can you raise and under what terms. By the way, good capital, equity, you know, equity is forever money. Preferred equity that has a dividend is Macaulay duration of 10 to 20 years. That's 10 to 20 year money. Debt that comes due in 5 years is 5-year money. A margin loan is 1 week money, 2 days, 3-day money. You go on a crypto exchange and you lever up 30 to 1. That's a flash loan. That's 3-minute money. Like you can literally be forced, you could have $1 billion of capital in the market and be forced liquidated in 3 minutes. So when you think about this, not all leverage is equal, right? Having the money for 20 years versus having the money for 20 minutes is different. A lot of crypto bros, they want to go and lever up 10 to 1, 20 to 1 and catch the dip and ride it up. And it's not the wrong idea. The problem is their capital is 10-minute capital. And it's very seductive because you can have $1 billion of capital if you want to get liquidated in 10 minutes. Having $1 billion of capital for the next 100 years is a little bit more difficult, right? It's more challenging. So I think you want a company, there's a hierarchy, right, of these things, right? I laid out the hierarchy of capital from flash loans to permanent equity. What's the hierarchy of companies? Family business, partnership, private, small private company, big private company, you know, small public company, mid-sized public company, big public company, right, in the U.S. capital market. And every single, you know, every single step up, right, you create a vehicle that can create more wealth. If you had a $500 million business holding slow real estate, I would say, well, bolt on 500 million of Bitcoin, wrap the thing together, take it all public, sell the equity, right? And now you've got a digital real estate business, right? You're creating value by creating growth and volatility, and then also liquidity in the equity. And those are all things that are possible. Maybe I should change subjects to maybe the most interesting new developments, right? Because Bitcoin is digital capital. I'm describing all the ways you can capitalize. You capitalize your private fund, your private company, your public company, et cetera, your endowment. You can capitalize with digital capital. It's going to outperform the S&P by a factor of 3, right? That's very simple. But the other things that are paradigm shifts right now are digital credit. For 300 years, the Western world ran on gold-backed credit. all the sovereign debt from France, Germany, the UK, it was all gold-backed credit. The currency, the United States currency, $20 to an ounce. The US dollar was gold-backed credit. US bonds were gold-backed credit. So that's the status for 300 years in the Western world. Now we're moving to a world of digital gold-backed credit, digital credit. So what does that mean? If I know that Bitcoin's going up 30% a year, I can sell you a credit instrument that gives you 10% dividend yield. I can over-collateralize at 5 to 1. I can strip 95%. A lot of people aren't sure whether Bitcoin's going down 10% in the next year, but the likelihood is going down 90% in the next year statistically is 1/100th of that. I can strip 99% of the risk off the instrument by over-collateralizing it. I can hand you 10% of the yield. I can keep the other 20%. So you issued credit, which meets the need of a credit investor. And then you get the capital back. The credit is long duration. Like when we sell a credit instrument, we could sell $1 billion of a credit instrument. The creditors give us $1 billion. We give them back $100 million a year. We buy Bitcoin. It goes up 30%. We generate $300 million a year in operating income tax deferred. It compounds. We end up with $10 billion on the back end. You're looking 10 years out. We have $100 million of dividend obligation. We make $1 billion up front. We make $9 billion on the back end. We make $10 billion by selling. Think about this. You sell $1 billion of credit, you just made $10 billion. Think hard about that. What other business can you sell $1 million of a product and make $10 million? Right?
Michael, let me ask you a question.
Yeah.
We have about 5 minutes left.
Sure.
The number 30% has come up a lot.
Right.
In terms of 10-year annualized return. Can you talk a little bit about what assumptions are built into that? 30% is a fantastic return. You're doubling your money every 2 1/3 to almost 2.5 years. So talk about what has to happen in order for people to make 30% a year.
The reason that people don't have appreciation is because the capital they're invested in is depreciating or decaying, right? So think about every way you ever lost money in an investment. The warehouse caught fire, NVIDIA gets banned from China, Apple gets sued by the EU, Microsoft gets sued for antitrust, COVID lockdowns destroy your hotel, people don't come to your restaurant, the mayor reroutes the traffic around your business district, a crooked CEO takes over and loots the money, you invested in the world's best business in Argentina and the currency collapse, you own a monopoly on Russian bakeries and the war takes place, trade wars, tariff wars, acts of God. All of these things are degrading risk factors to physical capital or to equity capital. Bitcoin doesn't have them. It has no counterparty risk. It doesn't. There is no CEO to rip you off, right? There is nothing in the real world. So the reason that Bitcoin outperforms the S&P index is because there's 50 pages of risk factors for every company in the S&P index, and we strip them all away, and we just keep the raw asset. The reason it outperforms gold is because gold inflates at 2% a year, and Bitcoin inflates at 0% a year. You might think that's a small number. The difference between 2% inflation and 0% inflation is the half-life of your wealth at 2% is 36 years. The half-life of your wealth at 0% is forever. It's the difference between you'll live 70 years or you'll live for 1 billion years. 2%. When people tell you 2% doesn't matter, it matters a lot. So the real breakthrough of Bitcoin is it is perfect money. It is the first perfect commodity which there's zero inflation, without the attack surfaces of a corporation, without the physical presence of a building. You want me to tell you every single way you can lose money investing in real estate in New York City? Who just got elected mayor? Think about it. What happens when the politician decides to rent control your building and then just maybe they'll just take it? The nicest hotel in I think in Cannes was the brainchild of a great developer, and he managed to finish the hotel in 1913. In 1914, a war broke out. The French government seized the hotel, turned it into an army hospital. The guy went bankrupt, died destitute. Oops. Don't want to own something that's desirable at the point when someone more powerful than you wants to take it away from you. And that's pretty much the story of most things. So Bitcoin is all the good things about property without all the physical liabilities, all the good things about a monopoly. What do you like about Apple and Google? They're monopolies. What does the EU not like? They're monopolies. The EU, right? The point is the Chinese don't like that. You think the Chinese want an American monopoly operating in China? Right, so the problem with monopolies operated by human beings is you can subpoena them and you can arrest the CEO of the monopoly. And by the way, it's illegal, right? Monopolies are illegal, right? If you form a cartel and restrain a trade to cut, if you actually organized all the gold miners and they all agreed they just stopped mining gold forever, that's illegal. You go to jail. How do you actually create a scarce, desirable asset on a global basis that's not illegal? You need to create a protocol, and you need to instantiate the protocol virally without a counterparty or a company involved. So Bitcoin just happens to be a perfect monetary protocol that was spawned by an immaculate conception. And as such, it's always going to outperform other capital assets because it has none of their defects, right? It just, you've stripped away. The idea of Bitcoin is what? I want to own 1/21 millionth of all the money in the world forever. Okay, tell me the problem with that idea. You want to own 1/21 millionth of all the money in the world forever. When will that be obsolete? 10,000 years ago, people were murdering each other to own the money in the world. 10,000 years from now, they'll still want it. So, you know, I'm on the iPhone 17 Pro Max, okay? The second best idea has gone through 37 different iterations, right? It obsolesces. But 1/21 millionth of all the money in the world forever? That will outlast every country. That'll outlast your language. That'll outlast every company. So we can, by the way, we can differ about, you might not think 30% is the right number. It's just, it's my view based upon all the statistics of the last 17 years. But what I would say to you there is, if you don't think it's the right number, I'm willing to do a swap for you. If you go by STRC, STRC pays 10.5% dividend yield with no volatility, and it's tax deferred. So you can have the first 10.5% risk-free, and I'll take the rest. And if I'm wrong, then you got 10.5% guarantee. And if you actually believe me, then you shouldn't take that deal, right? But as a practical matter, if you don't need the money for the next 4 years, you should buy Bitcoin. If you're industrious, you could create a company to raise capital to buy 10x more or 100x more Bitcoin. But if you're skeptical, then you should just determine whether Bitcoin's going to zero tomorrow forever. If it is, don't buy Bitcoin, don't buy anything related to Bitcoin. But if you think, well, it's kind of volatile and I don't know whether it's going up 10% or 20% or 5% or going down or whatever, then you just ought to go buy STRC because that's digital credit. That's a guaranteed 10.5% dividend, tax deferred. That's a tax equivalent bank account of 20% if you're a New Yorker.
Thank you, Michael.
Right? And so that's the big idea.
Thank you, Michael.
Happy to take questions from the audience if you guys
That's what I was
have
just
any.
going to ask. Do we have a microphone, Jack?
Yes.
We can probably hear everybody, but small room.
Barbara?
The way to think about the crypto industry is there are two sides to it. There's digital finance and there's digital capital. Digital capital means digital gold, long-term store of value. Okay, Bitcoin is one that. In order to have digital capital, you need a proof of work network that's energy intensive. Bitcoin is 99% dominant in that space. What's the killer use case of digital capital? Digital credit, right? Digital credit on top of digital capital, that will be a $100 trillion type side. There's another side of the industry, digital finance. That means moving stable coin, digital tokenized currency, tokenized security, tokenized bonds, tokenized real world assets, tokenized brands, you know, Trump coin, meme coin, Katy Perry token, tokenized country club memberships, tokenized restaurant memberships, Joe Rogan coin, tokenized Apple stock. I mean, it's not all jokey. I mean, it's like $10 trillion of tokenized US currency. It's a serious industry. That business will be dominated by proof-of-stake networks. Ethereum, Solana, BNB are the big three, and there's a bunch of others that are competing. And the crypto exchanges, and that's in and of itself, there's $100 trillion of stuff to get tokenized. I don't know if there's $100 trillion of wealth that'll be created, but there'll be trillions of dollars of wealth created. When you're investing in that industry, you're a tech investor. There's some regulatory gray zone. When the market structure bill, the Clarity Act, gets passed either later this year or early next year, you will have bright lines as to what assets you can tokenize and what are the risks and then what are the opportunities. Right now it's in the gray zone. There's general political consensus that we should do it, that we want the United States to lead it, but it's really 100 different opportunities and they're all very competitive. And the question is, are we going to move $1 trillion of tokenized US currency on the Solana network or on the BNB network or on some other network? And, you know, I can give you investment advice the same way if you would ask me, what about the 500 companies in the S&P? Who are the winners? Who are the losers? I'm like, that's very complicated. Spend 100 hours studying each company and form an investment thesis. And I would say in digital finance, it's the same thing. The reason I'm waxing philosophical about Bitcoin is not complicated, right? There's a winning language called the English language. There's a winning math protocol. It's Arabic numerals, 0, 1, 2, 3, 4, 5, 7, 8, 9, right? There's a winner. There's a winning digital capital network. It's Bitcoin. There's a winning world reserve currency. It's the dollar. There's a winning superpowers, the United States, right? There are certain winners. There's a winning metallic money. It's called gold. The gold standard. So it wasn't clear it was the winner 17 years ago, but after $1 trillion of votes and after hundreds of millions of people have decided, the smart money has decided that's the winner. Once you know there's a winner, like I'm telling you New York City is going to win and the year is 1750 and you have the chance to buy New York City at a higher price than anybody ever paid in the history of New York City, is it a good investment? And the answer is yeah. It's going to be a good investment every decade for the next 250 years. We'll see if it continues to be a good investment.
All right, so we have.
Let's go one more question right over there.
Actually, we're going to go two more questions.
Ooh.
Two more questions, and then we have to clear the room. So, and then after that, we have a reception open bar at in the lobby behind us.
Thanks.
Okay.
Hey, Michael. So much of Bitcoin's use as a store of value is currently driven by the halving mechanism to the block reward. A lot of the early talk in the Bitcoin Talk forums was imagining a world where there would be enough transaction volume so that miners would be competing less for the block reward and more for transaction fees. If and to the extent Bitcoin is and only is an immaculate store of value asset, at what point does that present some type of existential risk to Bitcoin mining activity on the network?
Yeah, there is no existential risk to it. I think that's not something to worry about. The 4-year cycles were meaningful for the first 12 years. They became less meaningful, by the end of the 16th year. Right now, you're talking about a halving that's coming that will reduce the supply of Bitcoin by $25 million a day. Bitcoin's trading $60 billion a day. 25 million is not even a second order issue. It's a third order issue with liquidity. So the 4-year cycles have disappeared for all practical purposes because they're an order or 2 orders of magnitude less than the amount of capital in the market. With regard to the second point you make on security, the security of the network is because of mining. The hash rate of Bitcoin miners was about 100 exahash in 2020, and it dipped to 70 or 80 exahash in 2021 after the China lockdowns. It's 1,200 exahash today. It has increased by a factor of 10. The mining activity will continue to increase, and the hash rate is going to go up forever. And the reason it's going up forever is because the cost to mine, the hardware is getting exponentially cheaper. And so it's like, think about how much it costs to buy a 386 chip today, or a 40, it used to be there was a $300 chip, and then it became a 30-cent chip, and people put it in postage cards as a gag. And that's the same with Bitcoin ASICs. The hardware is getting exponentially cheaper. They're going to sell it at a dramatically reduced rate. And you would say, well, it doesn't seem like the miners are making much money. That's true, but restaurants aren't making any money, and hotels aren't making any money. And you know what? You can't make it. There's no successful person making money selling guns in the United States either. And yet somehow we have infinite restaurants, infinite hotels, and infinite guns. So think about that for a little bit. What is the market telling you? The answer is people mine Bitcoin with stranded energy and stranded capital. And that means there's a lot of money in the world that is stranded and it wants to get unstranded. And the people in China, the Chinese were mining Bitcoin because they had Three Gorges Dam, which generates 10 gigawatts of free electricity. And it's like, I can either use it to mine Bitcoin and monetize it, or I cannot, but I'm stuck with dams and they're not moving, right? So the world's 30% of the energy in the world is stranded. It's excess, and the only place to sell it is the Bitcoin network. But on the other hand, if you're Chinese or Russian or Ukrainian or Iranian or North Korean or Cuban or Venezuelan right now, how do you actually get money, right? Like at the end of the day, you're going to have Siberian natural gas fields, and they're flaring natural gas. They're going to convert into Bitcoin hashes. So no matter what the block reward goes to, the network is just getting more secure. It's a one-way ratchet exponentially up forever. It's like, one more point. Bitcoin's secured by hardware. If everybody in this room is a billionaire, you've got economic energy, and I've got the gun, who's the most powerful person in the room? Me. The gun costs $200. When you actually use hardware to secure money, right, the cost of the security falls exponentially. I can literally stand outside the door with a $200 device, right, and depend $200 billion worth of money. What's going on with Bitcoin is they're using hardware. They're using the computer hash rate to defend the network. And there's always stranded energy and stranded capital. And after that, it's like, well, you think the United States will stop making guns if it's not profitable? I don't think so, right? Why do we make guns if no one makes any money? The answer is because we don't want the enemies to shoot us, right? So at the end of the day, Bitcoin will be mined by nation states, right? If I have $100 trillion of money on the network, you think I'm not going to actually defend the network? Of course, I'm just like the bank has a guy making minimum wage standing outside the bank with a gun, right? That's how you defend the $100 billion in the bank, right? So the network's not getting insecure. The network's getting more secure for a bunch of different political and economic and physical reasons. It's a thing of beauty, because how are you going to defend $100 trillion of capital using computer power that gets exponentially cheaper, right? Satoshi discovered it, and we're the beneficiaries of it.
Okay, wonderful. All right, one last question, and then Michael is going to stay with us for the reception for a little while, so if you have any other questions, maybe you can grab him one-on-one at the reception. Madison.
Hi, Michael. I wanted to talk about Satoshi's 1 million coins. Some people have been talking about them as a security risk. Do you see any scenario where those coins being moved or not moved actually impacts Bitcoin's integrity?
No, I'm not that worried about that. I don't think they'll move. I think generally they mention that in the context of a quantum threat. If sometime 10, 20, 30 years out, there's a quantum computer that's powerful enough, we'll upgrade the software and upgrade the hardware and upgrade the nodes running the network with quantum-resistant algorithms. When that happens, people will address the issue of what they do about Satoshi's coins. And again, it's like, if everybody in the world had their money in a bank, and it turns out that there was 5% of the money in the bank that was left by an account of a long dead person, you think the people with all the money in the bank would figure out how to deal with the account? I think they would. I think in this particular case, there won't be a problem generating consensus when there's a genuine threat. So Bitcoin's all the smart money in the world, right? All of the smart people that are rich in the world that wanted to put their money in cyberspace chose Bitcoin. The smart rich people will figure out the solution because all the money in cyberspace depends on it. Everybody else will worry about it, but they won't have any money, so what does it matter? Yeah. Yeah, thank you.
All right, all right.
Thank you, Michael.
Thank you, Michael. Thank you, Kareem. Thank you, everybody, for enjoying this wonderful day with us. Naples Symposium moves on out to the reception phase of the day. Place your bets. All right. Thanks, everyone. Thanks, of course, special thanks out there to Roxanne for starting us